SQE prep. Preparing for the SQE is like climbing a mountain.
But you don't have to climb alone. This video explains everything you need to know.
Let's do FLK2!
Congratulations on buying your first house. Or, well, thinking you have.
What are you doing here? Who are you?
You've found the property, agreed the price,
What are you doing in my house?
instructed solicitors, and transferred £470,000 for completion.
Your house? You better call your solicitors, boy.
Contracts are exchanged, the money goes through, the deal is done. Except there is just one small problem. The person who sold you the house doesn't actually own it. This really happened in England in the case Paransing v. Accourt & Co. A fraudster impersonated the owner of a house in Wimbledon, convinced solicitors he was the seller, and the buyer transferred the entire purchase price before anyone realised the truth. By the time the fraud was discovered, the money had been transferred overseas and disappeared. The buyer had paid nearly £500,000, and legally, he didn't own the house. Cases like this remind us that conveyancing is not just paperwork. Every search, every title investigation, every identity check exists to prevent exactly this kind of disaster. In this video, Dr. Yannis is going to walk you through property law and practice for SQE FLK2, following the SRA syllabus and explaining the real work a solicitor does in property transactions, from investigating title and raising inquiries all the way to exchange of contracts, completion, commercial leases, and property taxes. Introduction to the professional standard. When we begin studying property practice for the SQE, it is useful to imagine the everyday work of a solicitor in a conveyancing transaction. The SRA assessment specification requires candidates to demonstrate the ability to act honestly and with integrity, applying the law at the level of a competent, newly qualified solicitor. This is a high bar. It requires more than the memorization of statutes. It requires a deep understanding of the procedural architecture that underpins the transfer of land in England and Wales. A client walks into the office and says they want to buy a property. From this initial instruction, the solicitor's primary function is risk management. At that moment, the solicitor's role becomes one of investigation. The solicitor must ensure that the seller actually owns the property and that the buyer will receive good title once the transaction completes. If a solicitor fails in this duty, if they miss a restrictive covenant that prevents the client's intended use, or if they fail to secure a valid mortgage charge for the lender, they expose themselves to negligence claims and their client to financial ruin. Therefore, we must approach this topic with rigorous attention to detail. Section 1. Freehold real estate. The investigation of title. In England and Wales, land ownership is largely governed by the system of title registration administered by HM Land Registry. The Land Registration Act 2002 is the governing statute, aiming to create a mirror of the title, where the register accurately reflects the state of ownership. Most land is now registered, meaning that ownership is recorded on a central register. However, a competent solicitor must recognize that the mirror is not always perfect. There are cracks in the mirror, interests that bind the land despite not appearing on the register, known as overriding interests. Furthermore, some land remains unregistered, particularly property that has been in the same family ownership for decades. A solicitor must therefore be able to investigate both registered and unregistered titles with equal facility. The registered title investigation. In a registered title investigation, the starting point is the official copies entries obtained from the land registry. These entries replace the historic title deeds and are treated as definitive evidence of ownership. When you download these from the Land Registry portal, you are looking at the state of the title at that precise timestamp. The official copies consist of 3 parts, each serving a distinct legal function. First is the property register. The property register describes the property and identifies the land included in the title. It usually refers to a title plan. As a solicitor, you must verify that the address matches the client's expectations. Crucially, this register also states the estate held. Is it freehold or leasehold? It may also list the benefits of any easements, such as a right-of-way over a neighbour's driveway to access a garage. If the property benefits from such a right, you must check that the benefit is expressed clearly and acts in perpetuity. Second is the proprietorship register. The proprietorship register identifies the owner and may also contain restrictions affecting how the property can be transferred. You must check the class of title. Ideally, this will be title absolute, the highest class of guarantee. However, you may encounter possessory title, often granted where deeds were lost or title is based on adverse possession. This is risky and may require indemnity insurance. You may also see qualified title, where a specific defect exists. This register also lists restrictions in the standard Form A, Form P, or similar. A Form A restriction, for example, indicates a trust of land, requiring purchase money to be paid to at least 2 trustees to overreach any beneficial interests. If you miss this, your client takes the land subject to the rights of beneficiaries, a catastrophic error. Third is the charges register. The charges register lists financial charges, such as mortgages, and may also include restrictive covenants, easements, or other encumbrances affecting the property. This is the burden section of the title. The solicitor analysing these entries must check that the seller is the registered proprietor and that the title being transferred corresponds with the property being sold. If a mortgage is registered, the solicitor must ensure it will be discharged on completion. This is typically done by obtaining an undertaking from the seller's solicitor. You will also see restrictive covenants here, promises not to do something, like not to use the premises for the sale of alcohol. If there are restrictive covenants or easements, the buyer must be informed, because these obligations may affect how the property can be used.
The unregistered title investigation. Unregistered land requires a different approach. Because ownership is not recorded centrally, title must be deduced through a chain of title deeds, usually covering at least 15 years. This 15-year period is statutory, set by the Law of Property Act 1969. The seller must produce an epitome of title, a schedule of documents. This collection of documents is known as an epitome of title. The critical first step is identifying the root of title. A good root of title must meet 4 criteria. It must be at least 15 years old, it must deal with the whole legal and equitable interest, it must cast no doubt on the validity of the title, and it must contain an adequate description of the property. The most common route is a conveyance on sale. The solicitor reviews the deeds to confirm that ownership has passed lawfully from one owner to another until it reaches the current seller. You are checking the chain of ownership. If a link in the chain is missing, for example, if a previous owner died and there is no grant of probate attached to the deed proving the transfer to the executor, the title is defective. Each transfer must be properly executed and any mortgages or charges must be discharged. Furthermore, in unregistered land, third-party rights are not on a central register attached to the property. Instead, they are registered against a name of the landowner at the Central Land Charges Department in Plymouth. You must perform a K-15 land charges search against every owner named in the chain of title for the period of their ownership. This search reveals Class C-IV estate contracts, Class D-2 restrictive covenants, and Class F matrimonial home rights. The purpose of this investigation is to ensure that the seller has good title and that the buyer will acquire ownership free from undisclosed risks. If problems arise, the solicitor must decide what further action is required. For example, there may be missing documents, unresolved charges, or rights affecting the property. If a deed is lost, can secondary evidence be provided? If a restrictive covenant is breached, can we obtain a retrospective consent or insurance? The solicitor might require additional evidence, obtain indemnity insurance, or raise further inquiries with the seller's solicitor. Once the investigation is complete, the solicitor prepares a report on title for the client. This document explains the legal status of the property, identifies any risks, and confirms whether the buyer can safely proceed with the purchase. Reporting to the client is a crucial professional duty, because it ensures that the client understands both the benefits and the risks of the transaction.
Section 2. Pre-contract searches and inquiries. Investigating the legal title is only part of the solicitor's role. Title deeds do not tell you if a motorway is planned next door or if the land is contaminated.
the buyer must also discover whether there are external factors affecting the property that may not appear on the title itself. This is the purpose of searches and inquiries. Searches are formal requests for information from public authorities or other organizations. The suite of searches you order depends on the location and nature of the property, but 3 are considered mandatory in almost all purchases: the local authority search, the water and drainage search, and the environmental search. One of the most important is the local authority search. This is actually 2 searches: the LLC-1, Local Land Charges Register, and the CON-29, Inquiries of the Local Authority. The LLC-1 reveals legally binding charges like tree preservation orders, conservation area designations, or financial charges for street works. The CON-29 reveals planning history, building regulations, and highway status. This reveals matters such as planning permissions, building regulation approvals, compulsory purchase proposals, or enforcement notices affecting the property. A property may look attractive to a buyer, but if the local authority has served an enforcement notice requiring alterations or demolition, that fact could fundamentally affect the decision to proceed. For example, if a previous owner built an extension without building regulations approval, the local authority could prosecute or demand rectification. Environmental searches are also common. These searches reveal whether the property may be contaminated land, located in a flood risk zone, or affected by historic industrial activity. Under the Environmental Protection Act 1990, local authorities can designate land as contaminated. The remediation costs fall on the Class A person, the polluter. If they cannot be found, liability passes to the Class B person, the current owner. In modern conveyancing practice, these searches are essential because environmental liability can sometimes pass to the current owner of land. If the search result is failed, further investigation is needed. Water and drainage searches confirm whether the property is connected to mains water and sewer systems and whether any public drains run beneath the land. This is conducted via the CON-29DW form. This matters because building over a sewer may require special permission and can create legal complications. If a public sewer runs under the garden, the water company has statutory rights of access. Depending on location, you may also need a mining search, Coal Authority CON-29M, or a chancel repair search. Chancel repair liability is an ancient right, allowing the church to demand funds for repairs from local landowners. While its status as an overriding interest changed in 2013, it can still bind purchases in specific circumstances if a notice has been entered on the title. Alongside searches, the buyer's solicitor raises inquiries with the seller's solicitor. For residential property, this is done via the TA6 Property Information Form. These inquiries request additional information about the property, such as disputes with neighbours, alterations carried out to the property, or guarantees relating to building works. The principle of caveat emptor, buyer beware, applies to the physical state of the property, but the seller must answer inquiries truthfully. A false answer can lead to a claim for misrepresentation. The seller responds through standard forms and additional correspondence. The solicitor must then review the results of both searches and inquiries. If issues arise, further investigation may be required. For example, if the local search reveals that a road serving the property is not publicly adopted, the buyer must consider whether maintenance obligations will fall on the property owner. Modern conveyancing practice is guided by the Law Society Conveyancing Protocol, which sets out best practice standards for residential transactions. The protocol encourages cooperation between solicitors, transparency in communication, and efficient progression of the transaction. While it does not replace legal rules, it reflects professional expectations of good conveyancing practice.
Section 3. Finance and the role of the lender. Most property transactions involve some form of finance. For many buyers, purchasing property without borrowing would be impossible. A solicitor therefore needs to understand the main sources of finance used in property transactions. The most common form of finance is a mortgage loan from a bank or building society. In a mortgage transaction, the lender provides funds to the buyer and receives security over the property. This security allows the lender to take possession of the property and sell it if the borrower fails to repay the loan. This right of possession arises immediately upon the creation of the mortgage term, though in practice it is only exercised upon default. There are different types of mortgage products. A repayment mortgage involves the borrower making regular payments that gradually repay both the capital and interest. An interest-only mortgage requires the borrower to pay only interest during the term, with the capital repaid at the end. From a solicitor's perspective, the key issue is not the financial structure of the loan, but the legal security created over the property. The lender's security usually takes the form of a legal charge registered against the title. Once registered, this charge gives the lender priority over later interests and protects its right to recover the loan. In many transactions, the buyer solicitor also acts for the lender. This dual representation is permitted provided there is no conflict of interest. This is a specific exception to the general SRA rules on conflict, justified by the standard nature of mortgages. However, if a conflict arises, for example, if the buyer asks you not to tell the lender about a cashback incentive from the seller, you must cease acting. When acting for the lender, the solicitor must follow the lender's specific instructions, often set out in the UK Finance Mortgage Lender's Handbook. One of the most important responsibilities is providing the certificate of title. This is usually part of the report on title form. This document confirms to the lender that the property offers good security for the loan. By issuing the certificate of title, the solicitor effectively assures the lender that the property has good title, that all necessary searches have been carried out, and that the lender's charge will be properly registered. Because the lender relies heavily on the solicitor's certification, accuracy and professional diligence are essential. Any negligence in investigating title could expose the solicitor to liability if the lender suffers loss.
Section 4. Exchange of contracts. Once title investigations, searches, and finance arrangements are complete, the transaction moves towards exchange of contracts. This is the watershed moment. Before exchange, either party can walk away without penalty. After exchange, the deal is binding. At this stage, the parties negotiate and agree the terms of the sale contract. Most residential transactions incorporate the Standard Conditions of Sale, SCS, published by the Law Society. Currently, the SCS 5th edition is standard. Commercial transactions often rely on the Standard Commercial Property Conditions, SCPC. These standard conditions provide a consistent framework for issues such as completion dates, deposit arrangements, and remedies for breach. However, the parties may also include special conditions in the contract. Special conditions address matters specific to the transaction, such as completion deadlines linked to a related purchase or obligations to remedy defects in the property before completion. A common special condition involves vacant possession, ensuring the seller removes all chattels and rubbish. One important practical issue concerns the deposit. Usually the buyer pays a deposit of 10% of the purchase price on exchange of contracts. The deposit may be held by the seller's solicitor either as stakeholder or as agent. Under the standard conditions, it is typically held as stakeholder. If held as stakeholder, the solicitor holds the money independently until completion. This protects the buyer. If the seller goes bust before completion, the money is safe. If held as agent, the solicitor holds it on behalf of the seller and it may be released immediately. This is rare in residential cases but common in new-build developer sales where the developer uses the cash to fund construction. Insurance and risk are also addressed in the contract. Under traditional rules and Standard Condition 5.1, risk passes to the buyer upon exchange of contracts, meaning the buyer should insure the property from that moment. If the house burns down between exchange and completion, the buyer must still complete the purchase. In practice, many buyers arrange insurance immediately after exchange to protect against damage before completion. Another matter that sometimes arises is VAT. Residential property is usually exempt. However, certain commercial property transactions may attract value-added tax if the seller has opted to tax the property. The contract must therefore specify whether VAT is payable in addition to the purchase price. The exchange of contracts itself is usually carried out by telephone between the solicitors. The Law Society provides formulas for exchange. Formula A is where one solicitor holds both signed parts. Formula B is where each holds their client's signed part, most common. Formula C is for chains. Once contracts are exchanged, the agreement becomes legally binding. The buyer is obliged to purchase the property and the seller is obliged to transfer it on the agreed completion date. If either party withdraws after exchange, they risk significant financial consequences, including loss of deposit and damages.
Section 5. Pre-completion and completion. Between exchange of contracts and completion, there is a period during which final preparations are made. This stage is known as pre-completion. One key task is preparing the transfer deed, usually in the form known as TR1 for registered land. The transfer deed formally transfers ownership of the property from the seller to the buyer. While the contract is the promise to sell, the TR1 is the document that actually moves the legal estate. It must be properly executed as a deed, meaning it must be signed and witnessed according to legal formalities. The buyer's solicitor also conducts pre-completion searches. One of these is the OS1 priority search at the land registry, which protects the buyer's priority during the registration process. This search freezes the register for 30 working days. If a hostile creditor tries to register a charging order during this window, the buyer takes priority. Another is a bankruptcy search, Case 16, against the buyer if the purchase is financed by a mortgage, ensuring that the buyer is not bankrupt before the lender releases funds. At the same time, the solicitor arranges for mortgage funds to be drawn down from the lender. The solicitor sends a certificate on title or report on title to the bank, requesting the cash for the completion day. The completion statement is prepared, showing the balance required from the buyer after taking account of the deposit and mortgage advance. Completion is the moment when ownership of the property legally passes from seller to buyer. This occurs when the purchase money is transferred to the seller's solicitor, and the seller's solicitor releases the executed transfer deed. In modern conveyancing practice, completion usually takes place electronically through the banking system via CHAPS. Once funds are received, the seller's solicitor confirms completion and authorizes the buyer to take possession of the property. The keys are released, usually via the estate agent. After completion, the solicitor must carry out several post-completion tasks. These are strictly time-critical. First, paying any stamp duty land tax due and submitting the necessary return to HM Revenue and Customs. This must be done within 14 days of completion. Failure incurs automatic penalties. Second, the solicitor must apply to the land registry to register the buyer as the new owner and register any mortgage charge. Registration is crucial because in registered land systems, the register determines legal ownership. Until registration occurs, the buyer holds only an equitable interest. If the application is not made within the OS1 priority period, the buyer risks third-party interests taking precedence. Occasionally, a party fails to complete the transaction on the agreed date. When this happens, the law provides several remedies. Time is not automatically of the essence in property contracts unless stated. Therefore, a notice to complete can be served by the innocent party. This notice makes time of the essence and gives the defaulting party a short period, usually 10 working days, to complete the transaction. If completion still does not occur, the innocent party may rescind the contract. Rescission brings the contract to an end and allows the innocent party to recover the deposit if the seller is at fault or forfeit the deposit if the buyer is at fault. Damages may also be claimed to compensate for losses caused by the delay.
Section 6. Leasehold Real Estate Law and Practice. We now turn to the more complex area of leasehold law. Unlike freehold, where you own the land forever, leasehold property involves the grant of exclusive possession for a defined period of time in exchange for rent. This creates an ongoing relationship. The lease sets out the contractual relationship between landlord and tenant. Commercial leases typically contain a series of covenants governing the use and management of the property. A competent solicitor must understand the holy trinity of lease covenants: repair, user, and alienation. Repair obligations determine which party is responsible for maintaining the premises. In a full repairing and insuring (FRI) lease, the tenant is liable for all repairs. A trap for the unwary is the obligation to keep in repair, which implies an obligation to put the property into repair as if it is dilapidated at the start. Insurance clauses allocate responsibility for insuring the building and paying the insurance rent. Usually the landlord insures and the tenant pays the insurance rent. Alteration clauses regulate whether the tenant may modify the property. Some leases prohibit structural alterations without landlord consent, while allowing minor internal changes. User clauses restrict the permitted use of the premises. For example, a lease might allow use as retail premises but prohibit residential use. This is distinct from planning permission. A use might be legal under planning law but banned by the lease. Commercial leasing practice is influenced by the Code for Leasing Business Premises, which promotes fairness and transparency in commercial leasing negotiations.
Procedures: grant and assignment. The grant of a commercial lease follows a process similar to that used in property sales. The parties negotiate the terms and may first enter into an agreement for lease. This preliminary contract obliges the parties to grant the lease once certain conditions are met, such as the landlord completing construction of the unit. Before the lease is granted, the tenant's solicitor investigates the landlord's title to ensure the landlord has the legal right to grant the lease. Assignment occurs when an existing tenant transfers the lease to a new tenant. The new tenant becomes responsible for the obligations under the lease. The incoming tenant's solicitor investigates the lease terms and the landlord's title. Landlord consent may be required if the lease contains restrictions on assignment. Where landlord consent is required, it is documented through a license to assign or license to underlet. This document records the landlord's consent and sets out conditions attached to the transaction. It establishes a direct contractual link or privity of contract between the landlord and the incoming assignee. Sometimes the landlord requires an authorized guarantee agreement, often called an AGA. This agreement obliges the outgoing tenant to guarantee the performance of the new tenant's obligations under the lease. This is a crucial concept deriving from the Landlord and Tenant Act 1995. Liability and remedies. The liability of tenants and landlords under lease covenants depends partly on the date the lease was granted. For old leases granted before 1 January 1996, the doctrine of privity of contract meant that original tenants could remain liable for lease obligations even after assigning the lease for the entire 99 years, regardless of who was in occupation. For new leases granted on or after that date, the Landlord and Tenant Covenants 1995 changed the position. Under this legislation, liability generally passes to the assignee when the lease is transferred, though the AGA mechanism allows the landlord to hook the immediate predecessor back in if the new tenant defaults. If a tenant breaches a lease covenant, the landlord has several possible remedies. One option is an action in debt to recover unpaid rent. Another is forfeiture, which allows the landlord to terminate the lease if the tenant seriously breaches its obligations. Forfeiture is a draconian remedy and usually requires a peaceable re-entry or changing the locks or court proceedings. However, the landlord must be careful not to waive the right to forfeit by accepting rent after knowing of the breach. Commercial Rent Arrears Recovery, or CARR, allows landlords to seize goods belonging to the tenant to recover unpaid rent. This replaces the old law of distress. Some leases include a Jervis v. Harris clause, allowing landlords to enter the property and carry out repairs themselves if the tenant fails to do so, recovering the cost as a debt. Termination and security of tenure. A lease may end by affliction of time, surrender, or merger. However, commercial tenants may benefit from statutory protection under the Landlord and Tenant Act 1954. This legislation grants business tenants security of tenure, meaning they have the right to request a new lease when the existing lease expires. The lease doesn't just end, it holds over until a statutory notice is served. To terminate a protected tenancy, a landlord must serve a Section 25 notice stating a ground of opposition. The landlord may oppose renewal on certain statutory grounds, such as redevelopment plans, ground F, or persistent breaches of the lease, grounds A, B, C. If renewal is granted, the court may determine the terms of the new lease, including rent levels, usually based on open market rent. In some cases, tenants may also receive compensation if the landlord successfully opposes renewal, particularly under no-fault grounds like redevelopment. Section 7. Planning, Law and Taxation. Finally, we touch upon the regulatory and fiscal framework. Planning law regulates how land may be developed and used. The statutory definition of development generally includes building operations and material changes in the use of land.
Not all development requires planning permission. Some activities fall within permitted development rights, such as small home extensions. However, if you breach planning control, the local authority can issue an enforcement notice. It is vital to note that under the Levelling Up and Regeneration Act 2023, the time limits for enforcement have been unified to 10 years for all breaches in England, effectively abolishing the old 4-year rule. On the fiscal side, property transactions are subject to taxation. Stamp duty land tax (SDLT) in England and land transaction tax (LTT) in Wales are charged on the consideration. These taxes are calculated using a slice system, where different rates apply to different portions of the price. Residential purchases often involve progressive tax bands, and surcharges apply for second homes, an extra 3%, or non-resident buyers, an extra 2%. Value-added tax, VAT, may apply to commercial property. Most commercial property transactions are exempt from VAT, but if the seller has exercised an option to tax, VAT at 20% is added to the price. Sometimes clients choose to opt to tax in order to recover VAT incurred on property development. Lastly, capital gains tax, CGT, arises when a person disposes of an asset and realizes a gain. For individuals, this is charged at rates of 18 or 24% for residential property. However, private residence relief allows individuals to avoid capital gains tax on the sale of their main residence. The unfortunate story we started with captures the entire point of property law and practice in the SQE. Every step we studied, from the SRA specification, investigating title, analysing land registry entries, carrying out searches, raising inquiries, dealing with lenders, exchanging contracts, completing the transfer, registering the title, understanding leases, planning controls and property taxes, exists to make sure that when someone buys land, the law recognises that they truly own it. I hope this video helped make the system behind property transactions clearer for your FLK2 preparation. Thank you for watching, and good luck with your SQE preparation.
Can a crazy man create a valid will? In 1870, the English courts answered that very question.
Time to update my will.
Meet John Banks, wealthy, eccentric, and completely convinced he was being haunted by the ghost of a long-dead man named Mr. Featherstone.
I'm not crazy. I am possessed.
Banks believed this ghost was persecuting him, using mesmerism no less to manipulate his thoughts. Now, you might think that someone tormented by spectral mind control wouldn't be trusted to decide who should inherit their estate. But when Banks died and his will was challenged, the court took a different view. Yes, he had a bizarre delusion, but crucially, that delusion had nothing to do with the contents of his will. He understood that he was making a will, he knew what property he had, and he knew who the natural beneficiaries were, in this case, his beloved niece. The ghostly obsession didn't influence his choices, and so the court said his will stood. Banks v. Goodfellow became the cornerstone case for testamentary capacity, still good law over 150 years later. So, can a crazy man make a valid will? If he meets the test, absolutely yes. This lecture, prepared by Dr. Yannis, takes you through everything you need to know for FLK2 wills and estates, from validity to probate, tax, and beyond. The aim is to help you revise for this part of the SQE without going crazy.
Validity of wills and codicils. In England and Wales, a will is not merely a personal expression of wishes, it is a legal instrument governed by strict formalities. The validity of a will rests on 3 central pillars: the mental capacity of the person making the will, the absence of improper pressure or influence, and compliance with formal statutory requirements. Together, these ensure that the testator's instructions are genuine, deliberate, and legally effective. The starting point is testamentary capacity, which is assessed using the well-established criteria from Banks v. Goodfellow 1870. According to this authority, the testator must understand the nature and effect of making a will. They must comprehend the extent of their estate and be able to evaluate the legitimate claims of others, such as family members and dependents. The testator must also be free of mental illness or delusions that could distort their decision-making.
It is not enough that a person has been diagnosed with a cognitive condition such as dementia. The court will consider whether the person had a lucid interval, a period of mental clarity, at the time of executing the will. A quick note for your exam: you might assume the Mental Capacity Act 2005 applies here. It generally does not for retrospective challenges to a will. The High Court confirmed in Clitheroe v. Bond 2021 that the specific common law test from Banks v. Goodfellow remains the prevailing authority for testamentary capacity, distinct from the general test in the 2005 Act. While newer cases like Baker v. Houston 2023 suggest the Act can be a useful cross-check, Banks remains the primary test you must cite. The second major consideration is the testator's freedom from undue influence. The law protects individuals from being manipulated into making dispositions they do not truly intend. This is particularly relevant in cases involving vulnerable or elderly individuals, where a caregiver, relative, or friend may exploit a position of trust. English law recognizes that persuasion is permissible, but coercion is not. A will procured by undue influence is void. The burden of proving undue influence lies with the person alleging it, and the standard is high. Courts will look for suspicious circumstances, such as the exclusion of close family members without explanation, or a radical departure from a previous will in favor of a recently introduced individual. The third pillar is formality. Section 9 of the Wills Act 1837, as amended, outlines the essential requirements. A valid will must be in writing and signed by the testator or by someone else at their direction and in their presence. The signature must appear intended to give effect to the will. Furthermore, the signature must be made or acknowledged in the presence of 2 or more witnesses present at the same time. These witnesses must also sign the will in the presence of the testator, although not necessarily in each other's presence. Witnesses should not be beneficiaries or the spouses of beneficiaries, as this will invalidate any gift to them under Section 15 of the same Act. There is no requirement for the will to be dated, although this is strongly advised to avoid disputes about which version of the will is the most recent. All parties must sign with a clear and conscious understanding of what they are doing, and it is best practice to include an attestation clause, a formal statement confirming the observance of the statutory signing requirements. Failure to comply with any of these requirements can invalidate the will, even where the testator's intentions are otherwise clear. This highlights the importance of ensuring all formal steps are followed precisely and underscores the risks of using DIY will kits or informal documents without legal advice.
Personal representatives' appointment, renunciation, and reservation of power. The role of personal representatives is central to the administration of a deceased person's estate. They are responsible for carrying out the terms of the will or for managing the estate under the rules of intestacy if no valid will exists. When appointed under a will, these individuals are called executors. When appointed by the court in the absence of a will, they are known as administrators. Collectively, the term personal representatives applies to both. Under Section 25 of the Administration of Estates Act 1925, personal representatives are charged with a range of legal and practical duties. These include collecting and safeguarding the assets of the estate, paying debts and liabilities, applying for probate or letters of administration, handling inheritance tax, and distributing the net estate to beneficiaries. A will typically names 1 or more executors. There is no maximum number of executors who may be appointed, but only up to 4 can act at one time due to practical considerations. Executors may be family members, trusted friends, professionals such as solicitors or accountants, or a combination. Where a trust arises, for instance where minor beneficiaries inherit, at least 2 trustees are required. The appointment of executors takes effect from the moment of death. However, they do not have legal authority to deal with the estate until they have obtained a grant of probate. This legal document, issued by the probate registry, confirms their authority and gives them access to the deceased's assets. Nonetheless, some preliminary steps can be taken before probate is granted, such as securing property and arranging the funeral.
Sometimes a named executor may not wish or be able to act. They may renounce the role entirely by executing a formal deed of renunciation, provided they have not intermeddled, that is, taken any substantive steps in administering the estate. Once renounced, the role cannot be resumed. This often happens when the named executor is elderly, unwell, or lives abroad and finds the responsibilities too burdensome. Alternatively, an executor may reserve their power. This is more flexible. By doing so, they allow other executors to act while retaining the right to step in later. For example, if there are 3 named executors, one might choose to reserve power and allow the remaining 2 to take out the grant and administer the estate. Reserved power can later be brought into effect if one of the acting executors dies, is removed, or requires assistance. In circumstances where no executor is willing or able to act, a person entitled under the rules of intestacy, usually the residuary beneficiary, may apply for letters of administration with the will. This ensures the estate is still managed even where the will maker's choice of executor cannot be followed through. The flexibility to renounce or reserve ensures that the administration process is not unduly delayed by personal circumstances. However, those taking on the role must appreciate the seriousness of their legal duties. Executors and administrators act in a fiduciary capacity. This means they must act in good faith, avoid conflicts of interest, and not profit from their role unless authorized by the will or the court. Choosing the right executor is a critical part of estate planning. The individual should be trustworthy, reliable, and capable of handling both paperwork and interpersonal dynamics. In complex estates, appointing a solicitor or professional executor may be prudent, especially where there is potential for family conflict, tax issues, or ongoing trusts.
Alterations and amendments to a will. A will is a legal document that reflects a person's intentions at a particular moment in time. However, life changes, relationships evolve, assets are acquired or disposed of, and new family members may arrive. Consequently, it is often necessary to amend or update a will. The law provides mechanisms for doing so, but these must be used correctly to avoid confusion, inconsistency, or invalidity. Alterations to a will can be made in 2 principal ways, either by editing the existing will directly or by executing a codicil. However, the timing and manner in which those changes are made are crucial. If changes are made before the will has been executed, that is, before it has been signed and witnessed in accordance with Section 9 of the Wills Act 1837, they are treated as part of the original will and will be valid if they are clearly incorporated into the document and the final version is executed correctly. For instance, if the testator alters a bequest before signing and the witnesses see and sign that altered version, the change is valid. On the other hand, alterations made after execution are subject to more stringent scrutiny. To be valid, such changes must themselves comply with the formalities of execution. This means that the alteration must be signed by the testator and witnessed by 2 witnesses, in the same manner as the will itself. This rarely happens in practice. As a result, many post-execution alterations are found to be invalid and ignored by the probate court. Worse still, unauthorized alterations can cast doubt over the entire document, potentially leading to partial or total intestacy. A safer and more common method of changing a will is through a codicil. A codicil is a supplementary document that amends, revokes, or adds to a previously executed will. It does not replace the original will, but operates in conjunction with it. Codicils are particularly useful for minor changes, such as changing executors, updating a gift, or modifying funeral wishes, without the need to rewrite the entire document. To be valid, a codicil must meet the same formalities as a will. It must be in writing, signed by the testator, and witnessed by 2 witnesses who are present at the same time. While it is not legally necessary to use the same witnesses as for the original will, doing so can reduce the likelihood of disputes. If a codicil materially alters the distribution of the estate or contains significant changes, best practice is to prepare a new will to avoid confusion or inconsistent provisions. It is possible to have multiple codicils, but each one increases the complexity of interpreting the testator's intentions.
If a testator has executed several codicils over time, there is a greater risk of contradiction or ambiguity. Courts must then construe the documents together to give effect to the testator's overall wishes. Another consideration is the physical condition of the will and any codicils. If changes appear to have been made informally, for example handwritten amendments without witnesses or items crossed out, questions may arise about whether the changes were intentional and whether they comply with legal formalities. This can lead to costly litigation or unintended distributions. For this reason, testators are strongly advised never to mark or alter their will themselves without professional legal guidance. In summary, although a will can be amended, doing so must follow prescribed legal routes. Informal edits are unlikely to be valid and may even undermine the clarity or enforceability of the original will. Codicils are an effective and lawful way to make modest changes, but when changes are substantial or numerous, making a new will is almost always preferable.
Revocation of wills. Just as a testator has the legal freedom to make a will, they also have the power to revoke it at any time, provided they retain the mental capacity to do so. The revocation of a will can be a deliberate act, a consequence of changing life circumstances, or the result of certain legal events. Understanding the methods and consequences of revocation is essential for ensuring a person's testamentary wishes are properly respected and updated. There are several ways a will may be revoked: by the execution of a subsequent will or codicil, by physical destruction with the intent to revoke, by written declaration, or by operation of law, particularly following marriage or civil partnership. The most straightforward method is by creating a new will that includes an express revocation clause. Most professionally drafted wills begin with language such as, "I revoke all former wills and testamentary dispositions." This leaves no doubt that the new document is intended to replace earlier ones. Even in the absence of such a clause, a new will that is wholly inconsistent with an earlier one may be treated as an implied revocation. However, this can lead to ambiguity, particularly if the new will omits certain gifts or does not deal with the whole estate. A testator may also revoke a will by physical destruction, as set out in Section 20 of the Wills Act 1837. This includes burning, tearing, or otherwise destroying the will with the intention of revoking it. Crucially, both the act and the intent must be present. Accidental destruction, for example by fire or water damage, does not constitute revocation. Similarly, if another person destroys the will on the testator's instructions, the testator must be present and the destruction must still reflect their deliberate intention. If the only copy of a will was last known to be in the possession of the testator and cannot be found at death, there is a legal presumption that it was intentionally destroyed and revoked. This presumption can be rebutted with sufficient evidence, such as testimony that the will was misplaced or removed by another party without authority. Nonetheless, the loss of the original will creates significant evidential challenges and may result in partial or total intestacy. It is important to note that partial revocation, removing one part of a will while leaving the rest intact, is not permitted by physical means alone. If a testator attempts to cross out a specific gift without following the proper formalities for alteration, that gift may still stand. To validly revoke a portion of a will, the testator should either execute a codicil or make a new will that replaces the relevant section. These rules illustrate the delicate balance between upholding a testator's autonomy and ensuring clarity and certainty in succession. Legal advice is essential when contemplating revocation, especially if the estate is large, complex, or the testator is vulnerable. Revocation should always be documented in a clear and legally compliant manner to avoid disputes and unintended outcomes. The interpretation of wills, effect of different types of gift and failure of gifts. The primary goal in interpreting a will is to give effect to the testator's intentions. This principle underpins much of the case law and statutory guidance in this area. However, the words used in a will may not always be clear, and circumstances may have changed between the time the will was made and the time of death. Courts must therefore interpret wills in a way that is legally sound and practically workable, relying on established principles and tools of construction. There are several types of testamentary gifts, and each behaves differently in terms of priority, enforceability, and susceptibility to failure. These include specific gifts, general gifts, demonstrative gifts, and residuary gifts.
A specific gift is one that identifies a particular asset, for example, my Rolex watch to my nephew, or the property known as Rose Cottage to my daughter. The hallmark of a specific gift is that it can be precisely identified from the testator's estate. If that item no longer exists at the date of death, the gift is said to have adeemed, that is, it fails entirely and the intended recipient gets nothing in its place. For example, if Rose Cottage was sold before the testator dies, the gift of that property fails, and the beneficiary has no right to the sales proceeds unless the will expressly states otherwise. A general gift is less precise. It refers to an amount or item not tied to a specific asset, such as £5,000 to my cousin. If there are insufficient funds in a particular account, the executors may raise the money from other assets. These gifts are not subject to redemption in the same way as specific gifts. A demonstrative gift straddles both categories. It is a general gift, but with a direction to pay it from a specified source. For example, £5,000 from my HSBC savings account to my niece. If that account contains less than £5,000 at death, the balance is paid from other estate assets to make up the shortfall. Demonstrative gifts are not redeemed by the absence or depletion of the named fund. The residuary gift deals with what remains in the estate after all debts, taxes, costs and other gifts have been paid. It is expressed as the residue of my estate and is often left to one or more main beneficiaries. If a gift fails and the will does not say where it should go instead, it typically falls into the residue. If the residuary gift itself fails, for instance if the named beneficiary predeceases the testator and no substitution is made, then that portion passes according to the intestacy rules. Sometimes a gift fails for reasons other than redemption. The doctrine of lapse provides that a gift to a beneficiary who dies before the testator fails unless a substitution clause or the statutory exception applies. Section 33 of the Wills Act 1837 provides that if a gift is made to a child or remoter descendant of the testator and that person dies before the testator, leaving issue who survive the testator, the gift will not lapse, but instead passes to that issue. This statutory provision can save many gifts that might otherwise fail. Another concept is class gifts, for example to my grandchildren. The law assumes that only grandchildren living at the date of the testator's death are included unless a contrary intention is shown. This becomes particularly important if the testator's family grows after the will is made or if members of the class predecease the testator. Courts interpret class gifts using rules of construction and, where necessary, extrinsic evidence to determine who qualifies. Ambiguities in a will, for example where the wording is unclear or inconsistent, can be addressed using the principles of construction. Courts aim to interpret the will as a whole and resolve ambiguities in a way that makes practical and legal sense. If ambiguity remains, extrinsic evidence may be admitted under Section 21 of the Administration of Justice Act 1982, including statements made by the testator about their intentions. Courts may also rectify a will under Section 20 of the same Act, where the will fails to carry out the testator's intentions due to clerical error or a failure by the drafter to understand instructions. The applicant must provide strong evidence and the claim must be brought within 6 months of the grant of representation, although the court may allow later applications in exceptional cases. The law of interpretation also includes the armchair principle, where the court puts itself in the testator's position at the time the will was made, considering their knowledge, circumstances and relationships. This helps clarify unclear provisions and is especially useful where family structures are complex or where names are used inconsistently. In short, interpreting a will is not simply a matter of reading its words. It requires a holistic approach that respects the testator's intentions, adheres to legal principles, and addresses any practical or evidential difficulties. A properly drafted and regularly updated will can greatly reduce the risk of misinterpretation or the failure of gifts.
The Intestacy Rules, Section 46 of the Administration of Estates Act 1925, and the Statutory Trusts. When a person dies without leaving a valid will, or when part of their estate is not effectively disposed of by a will, their estate, or the undisposed portion, is distributed according to the statutory rules of intestacy. These rules are set out in Section 46 of the Administration of Estates Act 1925, as amended, and they provide a strict order of priority among surviving family members. Importantly, the rules apply regardless of the deceased's actual wishes or the closeness of their emotional relationships.
The structure of intestate succession aims to reflect a presumed order of entitlement, with priority generally given to spouses, civil partners, and blood relatives. Cohabiting partners who were not married or in a civil partnership with the deceased have no automatic right under the intestacy rules, even if they lived together for many years. If the deceased leaves a surviving spouse or civil partner but no children, the entire estate passes to that surviving partner. However, if there are children or other descendants, the estate is divided. The surviving spouse or civil partner receives all the deceased's personal chattels, defined broadly as personal possessions not used for business purposes or held as investments, a statutory legacy, currently set at £322,000 as of 2023, free of inheritance tax and interest bearing from the date of death until payment, 1/2 of the remainder of the estate, after the above two items are satisfied, absolutely. The other half of the remaining estate is divided equally between the surviving children of the deceased. Where a child has died before the deceased but left children of their own, i.e. the deceased's grandchildren, those grandchildren will inherit that child's share per stirpes by representation of their parents' entitlement. In the absence of a surviving spouse or civil partner, the whole estate passes to the other relatives in a strict order of priority. 1. Parents. 2. Whole blood siblings or their children. 3. Half-blood siblings or their children. 4. Grandparents. 5. Uncles and aunts of the whole blood or their children. 6. Uncles and aunts of the half-blood or their children. If no such relatives can be found, the estate becomes bona vacantia. It passes to the Crown. In practice, the Treasury Solicitors Bona Vacantia Division manages such estates, and it may distribute some funds to those who can show a moral, though not legal, claim. Under intestacy, the property passing to children or remoter descendants is held on a statutory trust until they reach the age of 18. During this period, the trustees, often the administrators of the estate, hold the assets for the benefit of the minor beneficiary. They have the power to advance capital or pay income for the minor's maintenance, education, or benefit. This statutory trust protects the minor from mismanaging an inheritance and ensures oversight until they reach legal adulthood. However, it also means that the assets cannot be freely accessed or controlled by the child or their guardians until the legal age is reached, unless the trustees exercise discretion to make advances earlier. The same structure applies to more remote beneficiaries, for example nieces or nephews inheriting under the intestacy rules in the absence of closer relatives. Each class of beneficiary receives their share subject to the trust, which continues until the legal age is attained. It is important to note that the statutory rules make no allowance for individual circumstances, such as financial dependence, estrangement, or the testator's actual preferences. Consequently, they can produce outcomes that seem unfair or contrary to what the deceased might have intended. This rigidity underscores the importance of making a valid will to avoid unwanted distributions and to provide for non-entitled individuals, such as unmarried partners, stepchildren, or friends. While claims under the Inheritance Provision for Family and Dependents Act 1975 can sometimes rectify the harshness of intestacy, these claims are not automatic and they require time, evidence, and legal expense. The best way to avoid such disputes is for individuals to take control of their estate planning by executing a legally valid and regularly reviewed will.
Property passing outside the estate. Joint property, life policies, pension scheme benefits, and trust property. Not all of a deceased person's wealth forms part of their estate for the purposes of inheritance, probate, or taxation. Some types of property pass outside the estate automatically by operation of law or contract. It is essential for both practitioners and personal representatives to recognize these types of property as they affect who inherits, whether a grant of probate is needed, and how inheritance tax is calculated. Joint property. The most common form of property that passes outside the estate is jointly owned property held as joint tenants. Under this arrangement, two or more people hold the property with no distinct shares. Instead, each owns the whole together. Upon the death of one joint tenant, the property passes automatically to the surviving joint tenants by the right of survivorship, regardless of what is stated in the deceased's will or the intestacy rules.
This principle applies most commonly to joint bank accounts, savings, and homes owned in joint names. The legal mechanism is automatic and does not require probate. However, it does not apply to property held as tenants in common, where each party owns a defined share. In such cases, the deceasor's share passes under their will or the intestacy rules. It is important for testators to understand the nature of their co-ownership. For example, a person may assume that they can leave their share of the family home to someone else by will, only to find that their joint tenancy means it automatically passes to their co-owner. Severance of the joint tenancy, converting it into a tenancy in common, is therefore an important step where a different succession plan is intended. For inheritance tax purposes, jointly owned assets are still relevant. Half the value of jointly owned property may be included in the deceased's estate, depending on how the asset was structured and who provided the funds. This affects tax liability even if the asset does not pass under the will. Life policies. Life insurance policies can either form part of the estate or pass outside it, depending on how they're structured. If the policy is written in trust, which is a common estate planning tool, the proceeds are paid directly to the named trustees for the benefit of designated beneficiaries. In such cases, the funds bypass the estate entirely, do not require probate, and are not subject to the deceased's debts or will. This provides a powerful tool for testators who wish to make immediate provision for dependents or reduce the inheritance tax burden on their estate. Trust-based life policies can be set up during lifetime, often with the assistance of financial advisors, and offer flexibility in how proceeds are applied. If the policy is not in trust, the proceeds usually fall into the estate and are distributed under the terms of the will or intestacy. These proceeds are also potentially liable for inheritance tax, increasing the estate's tax burden.
Pension scheme benefits. Pension death benefits are another significant form of wealth that may pass outside the estate. Many pension schemes, particularly occupational and personal pensions, include a discretionary death-in-service benefit or a lump sum payable upon death. These are usually governed by the scheme's rules and do not automatically form part of the estate. Instead, the pension scheme trustees have discretion over who receives the benefit. Most schemes allow the member to nominate preferred beneficiaries, but these nominations are not binding. Nonetheless, trustees usually follow them unless there is a good reason not to. Because the benefit does not form part of the estate, it is not governed by the will or intestacy rules, nor is it typically subject to inheritance tax. This makes pensions a tax-efficient way to pass on wealth. However, it also means that care must be taken to keep beneficiary nominations up to date. A failure to do so can result in delays or unintended recipients. It is also worth noting that pension pots held in drawdown or as uncrystallized funds can be left to beneficiaries, and if the deceased was under 75 at death, these may be inherited tax-free. Trust property. If the deceased was a trustee of a trust, the assets of that trust are not part of their estate. The legal title to the trust property vests in the continuing or replacement trustees. However, steps must be taken to vest that title formally in the remaining trustees, typically through a deed or formal resolution. If the deceased had a beneficial interest in a trust, for example a life interest or a share in capital, then that interest may pass under their will or intestacy, and it may form part of their taxable estate. But the trust assets themselves remain separate and are not part of the estate for succession purposes. Trusts are often used in estate planning to ring-fence assets, protect beneficiaries, and reduce tax exposure. Common examples include discretionary trusts, life interest trusts, and pilot trusts. Each operates according to its own terms, which may dictate what happens to the assets upon the death of the beneficiary or settler. It is vital for personal representatives to identify whether the deceased had any involvement with trusts, either as a trustee or beneficiary. Trust documentation, solicitor correspondence, and tax records can help determine this. Ignoring trust property can lead to breaches of duty or tax miscalculations.
Grants of representation.
A grant of representation is the legal document that authorizes an individual to deal with the estate of a deceased person. Without it, financial institutions, government departments, and others will typically refuse to release the deceased's assets. Whether the deceased died testate with a valid will or intestate without a valid will, some form of grant is usually required to administer their estate. The need for a grant arises when the estate contains assets that cannot be accessed without legal authority. This typically includes real property, bank accounts above a certain threshold, shares and investments. If the estate is small, usually below £5,000 to £15,000, depending on the institution, a grant may not be required. Likewise, assets that pass outside the estate, such as joint property or nominated pensions, do not require a grant to be transferred. When a valid will exists and appoints executors who are willing and able to act, they apply for a grant of probate. If no will is available, or if the executors are unable or unwilling to act, then a grant of letters of administration is issued instead. Where there is a will but no executor willing to act, the court may issue a grant of letters of administration with will. The non-contentious probate rules and application procedure. The process for obtaining a grant is governed by the Non-Contentious Probate Rules 1987. These rules set out the procedural steps, documents required, and forms to be used in applications for probate or administration. Applications can be made by post, online, or through a solicitor. In more complex cases, such as where there is uncertainty about the will or disputes between beneficiaries, the application may need to be handled in the probate registry or, occasionally, in the family division of the High Court. The key steps in the application process include assembling the necessary documents, including the original will, death certificate, and completed inheritance tax forms, valuing the estate, identifying all assets and liabilities, including property, bank accounts, debts, and other interests, submitting an inheritance tax return, either a short form IHT 205 for accepted estates or a full IHT 400 for taxable or complex estates, swearing an oath or making a legal statement confirming the truth of the application, paying any inheritance tax due, at least in part, before the grant is issued. Once the application is approved and all documents are in order, the grant is issued to the personal representatives. This gives them the legal authority to collect and deal with the deceased's assets. Valuation of assets and liabilities. Accurate valuation is essential for probate and tax purposes. Assets must be valued as at the date of death. This includes real property, based on open market value, bank balances, investments, personal possessions, and business interests. Liabilities such as mortgages, loans, unpaid taxes, and outstanding bills must also be recorded. Over- or undervaluation can affect the tax payable and expose the personal representatives to legal liability. For property, a professional valuation or agent estimation is used. Shares must be valued using stock exchange prices on the date of death. For unusual assets, such as antiques, intellectual property, or cryptocurrency, specialist advice may be needed. Accepted estates. An estate may be classified as an accepted estate if it meets certain criteria, such as having a value below the inheritance tax threshold, being left entirely to an exempt beneficiary, e.g. spouse or charity, or if the deceased was domiciled abroad with limited UK assets. In such cases, a simplified inheritance tax return, IHT 205, can be used, and there is no need to submit a full account to HMRC. This streamlined process speeds up the grant application and reduces administrative burden. However, the rules for accepted estates are strict, and any error can result in delays or penalties. It is therefore important to check eligibility carefully. Methods of funding inheritance tax. Inheritance tax, IHT, must be paid, at least in part, before the grant is issued. This presents a practical difficulty. The funds to pay the tax may be locked in the deceased's assets, which cannot be accessed without the grant. To address this, HMRC allows the tax due on certain assets, particularly land and shares, to be paid by installments over 10 years. Interest is charged, but this allows flexibility in managing cash flow. Additionally, many banks will release funds directly to HMRC to settle the IHT liability, provided the appropriate forms are completed. Alternatively, personal representatives may use their own funds, take out loans, or sell certain assets early with caution to fund the tax payment. Specialist probate lending services also exist to assist with this issue. Burden and incidence of inheritance tax. The burden of inheritance tax refers to who ultimately pays the tax. Generally, it falls on the estate, that is, it is paid before any distributions are made to beneficiaries. However, the incidence of tax, which assets are used to fund the payment, is governed by the will or the rules of intestacy. If the will is silent, the general rule is that specific and demonstrative legacies are paid in full and the residuary estate bears the tax. If a gift is made free of tax, the tax is paid from the estate. If it is not, the beneficiary bears the tax.
These distinctions can have significant implications for beneficiaries, especially if gifts are large or if there are multiple classes of legacy. Executors must ensure that tax is correctly apportioned and paid in accordance with both legal principles and the wording of the will. Errors can result in personal liability, disputes between beneficiaries, or HMRC investigations.
Administration of estates, duties, liabilities and distribution. Once the grant of representation is obtained, the personal representatives, whether executors or administrators, are empowered to administer the estate. This is a detailed and often time-consuming process that must be carried out with diligence, impartiality and adherence to legal standards. The personal representatives act in a fiduciary capacity, meaning they must act in the best interests of the estate and its beneficiaries, and can be held personally liable for breaches of duty. Duties of personal representatives. The duties of personal representatives can be broadly categorized into 4 key phases: collect, administer, account, and distribute. 1. Collect. The representatives must identify, locate, and gather all the deceased's assets. This includes closing bank accounts, selling property, redeeming investments, and recovering debts owed to the estate. They must also secure physical assets, such as properties or valuable items, to prevent loss or damage. 2. Administer. The estate's liabilities must be settled. This includes paying funeral expenses, outstanding bills, taxes, including inheritance tax, income tax, and capital gains tax, and debts. If the estate is insolvent or marginal, careful management and possibly professional advice are needed to avoid distributing assets prematurely. 3. Account. Representatives must maintain detailed financial records throughout the process. This includes preparing estate accounts showing assets received, expenses paid, and the calculation of net distributions. Beneficiaries have the right to see relevant information and, in some cases, a full account of the administration. 4. Distribute. After all liabilities and expenses are paid, the remaining assets can be distributed in accordance with the will or intestacy rules. This may involve transferring property, paying legacies, or setting up trusts. Distributions must reflect the terms of the will and the correct shares under the law. Liabilities of personal representatives and their protection. The role of personal representative carries significant legal responsibility. If they make errors, for example by failing to pay debts before distributing assets or by misinterpreting the will, they can be held personally liable to creditors or disgruntled beneficiaries. To mitigate this risk, personal representatives can protect themselves in several ways. Statutory notices. Under Section 27 of the Trustee Act 1925, representatives can place notices in the London Gazette and a local newspaper, giving creditors 2 months to come forward. If no claims are made within that time, the representatives may distribute the estate without being personally liable for unknown debts. Professional advice. Where the estate is complex, contentious, or involves tax planning, representatives should seek advice from solicitors, tax specialists, or accountants. Acting on competent professional advice can be a defense to certain claims. Indemnities. In some cases, representatives may require beneficiaries to sign indemnities before distribution, particularly where issues of uncertainty remain. Insurance. Executors' insurance is available and can provide cover for legal costs and claims arising from mistakes in administration. Failure to act properly can lead to removal by the court, compensation claims, or proceedings under the Inheritance Provision for Family and Dependents Act 1975. Sale of assets to pay expenses, tax, debts, and legacies. Where the estate lacks liquid funds, personal representatives may need to sell assets to meet obligations. This can include selling shares, real property, or valuable items. The power to do so arises either from the will itself or from statute, particularly under the Administration of Estates Act 1925 and the Trustee Act 1925. Care must be taken to ensure fair value is obtained for assets, especially if beneficiaries challenge the sale. If land or a family home must be sold, this may require sensitive handling and clear communication with beneficiaries, particularly where the property is occupied. Representatives must also determine the correct order of payment.
1. Funeral expenses. 2. Testamentary expenses, for example, probate fees or professional fees. 3. Secured debts. 4. Unsecured debts. 5. Legacies, in the order specific, demonstrative, and general. 6. Residuary bequests. If the estate is insolvent, the rules of bankruptcy apply to the order of distribution, and professional advice is essential to avoid missteps. Distribution of the estate. After all liabilities are paid, the estate is ready for distribution. The representatives must ensure that each beneficiary receives their correct entitlement. This may be a fixed sum, a pecuniary legacy, a specific item, a specific legacy, or a share of the residue. Before distributing, the representatives should verify the identity and legal capacity of each beneficiary. In the case of minors or vulnerable beneficiaries, funds may be held on trust or paid to a parent or guardian, depending on the circumstances and the terms of the will or statutory trust. Where the will establishes ongoing trusts, such as for a life interest or discretionary trust, the administration does not end with distribution. The ongoing role of trustees must be established and assets properly transferred into trust with supporting documentation. Upon completion of the administration, personal representatives often provide a final estate account to the beneficiaries, setting out receipts, payments, and distributions. This serves as a record of their administration and may help preempt disputes or challenges.
Claims against estates under the Inheritance for Family and Dependents Act 1975. Although English law respects the principle of testamentary freedom, the right of individuals to dispose of their estate as they wish, that freedom is not absolute. In some circumstances, the law allows disappointed or excluded individuals to claim that the deceased's will, or the effect of the intestacy rules, fails to make reasonable financial provision for them. These claims are made under the Inheritance for Family and Dependents Act 1975. This legislation provides an important safety net, particularly for those who were financially dependent on the deceased or had a strong personal connection but no entitlement under the will or intestacy. It balances personal freedom with social responsibility. Time limit. An application under the 1975 Act must normally be brought within 6 months of the date on which the grant of representation is issued. This is a strict time limit. However, the court has discretion to allow late applications in exceptional circumstances, especially where the delay was short and there is a strong case on the merits. Applicants must show that it is just and equitable to extend time. Late applications are more likely to succeed where the estate has not yet been distributed or where the claimant was unaware of their entitlement or the existence of the grant. However, the longer the delay, the harder it becomes to justify an extension. Eligible applicants. Only certain categories of individuals have the right to apply under the Act. These are 1. The spouse or civil partner of the deceased, entitled to a higher standard of provision, similar to what they might expect in a divorce proceedings under the Matrimonial Causes Act 1973. This includes factors such as the length of the marriage, the standard of living enjoyed, and the applicant's financial needs. For all other applicants, including adult children and cohabitants, the standard is lower. They must show that their maintenance is reasonable rather than that they are entitled to share in the estate more broadly. Factors considered by the court include the applicant's current and future financial needs and resources, the financial needs and resources of other beneficiaries, the size and nature of the estate, the obligations and responsibilities the deceased had towards the applicant and others, any physical or mental disability of the applicant, any other relevant circumstance, including the conduct of the parties. For example, a financially dependent adult child with a disability may be awarded provision, whereas a financially secure adult child estranged from the deceased may not. The court retains broad discretion. In Illott v. the Blue Cross and others 2017, the Supreme Court upheld a modest award to an estranged adult daughter who had been excluded from her mother's will in favor of charities. The case reaffirmed the testator's freedom to choose beneficiaries, but confirmed that maintenance-based claims could succeed in limited circumstances. If successful, the court may vary the distribution of the estate to make appropriate provision. This can include lump sums, property transfers, or ongoing maintenance payments. Awards may be made from specific assets or from the estate as a whole, depending on what is just and practical.
These claims can have a significant impact on beneficiaries and may result in delays, costs, or changes in distribution. Executors must take care not to distribute the estate prematurely if a claim is pending or likely. If a claim is made, the estate administration may be paused while the parties negotiate or the court makes a determination. Personal representatives who distribute the estate in ignorance of a pending claim may be liable if the court later finds that provision should have been made. Therefore, it is often advisable for representatives to delay final distributions until the claim period has passed or a deed of variation or settlement is agreed.
Taxation, wills and the administration of estates. The taxation of estates involves three main areas: inheritance tax, IHT, income tax, and capital gains tax, CGT. Understanding these obligations is essential for personal representatives and beneficiaries alike, as tax liabilities can significantly affect the value of the estate and the timing of distributions. Inheritance tax, lifetime transfers and transfers on death. Inheritance tax is primarily governed by the Inheritance Tax Act 1984. It is charged on the value of a person's estate at death, as well on certain gifts made during their lifetime. The standard nil rate band is £325,000 as of 2023, and any part of the estate above this threshold is taxed at 40% unless exemptions or reliefs apply. Lifetime transfers fall into two categories: immediately chargeable transfers and potentially exempt transfers, PETs. Immediately chargeable transfers typically involve gifts into most trusts, excluding certain bare trusts or disabled persons trusts. These are subject to IHT at 20% lifetime rate if they exceed the nil rate band. If the donor dies within 7 years of the transfer, a further 20% may be payable to bring the total up to 40%. Potentially exempt transfers are outright gifts made to individuals. They are only taxable if the donor dies within 7 years. If death occurs within this period, the gift is added back into the estate for IHT purposes. Taper relief may reduce the tax payable if the gift was made more than 3 years before death. The longer the interval, the greater the relief. Importantly, if the donor retained a benefit from the gift, for example by continuing to live in a property they had given away, the gift is treated as a gift with reservation of benefit. In such cases, it remains part of the estate for tax purposes under anti-avoidance rules. On death, the value of the estate is assessed, including lifetime gifts made within 7 years. Personal representatives must report these gifts using the IHT 400 form if the estate is not an accepted estate. The timing of gifts and the availability of reliefs, such as taper relief or business relief, must be carefully considered. Exemptions and reliefs. Several important exemptions and reliefs can reduce the IHT liability. Spouse or civil partner exemption. Gifts to a UK-domiciled spouse or civil partner, whether made during life or on death, are entirely exempt from IHT. Charity exemption. Gifts to UK-registered charities are also exempt. Annual exemption. Individuals may give away up to £3,000 per tax year free of IHT. If unused, it can be carried forward 1 year. Small gift exemption. Gifts of up to £250 per person per year to any number of individuals are exempt. Wedding gifts. Gifts made on the occasion of a marriage or civil partnership are exempt up to £5,000 from a parent, £2,500 from a grandparent, or £1,000 from others. Business relief. Up to 100% relief is available for certain business assets held for at least 2 years. Agricultural relief. Similar relief applies to qualifying agricultural property. The residence nil rate band is an additional allowance where a residence is left to a direct descendant. The allowance is currently £175,000 and tapers away for estates exceeding £2 million. Unused portions of both the standard and residence nil rate bands can be transferred between spouses or civil partners on death. Anti-avoidance provisions.
The tax regime includes various anti-avoidance measures to prevent individuals from artificially reducing their estates for tax purposes. Gifts with reservation of benefit, as noted, gifts where the donor continues to benefit from the asset are not effective for tax mitigation and are taxed as part of the estate. Pre-owned asset tax, PAOT, introduced to catch arrangements that fall outside the reservation of benefit rules. POAT imposes an annual income tax charge where a donor continues to enjoy the benefit of an asset they previously owned. Settlements and trusts. Transfers into discretionary or interest in possession trusts may attract lifetime or periodic charges unless structured correctly. Personal representatives must be alert to these provisions when reviewing the deceased's finances and planning any distributions. Income and capital gains tax in respect of the period of the administration of an estate. In addition to inheritance tax, the administration of an estate may give rise to further tax liabilities, namely income tax and capital gains tax, CGT. These taxes apply to the estate as it generates income or realizes gains between the date of death and the final distribution to beneficiaries. The personal representatives, PRs, are responsible for managing and paying these taxes during the administration period. The personal representative's liability to income tax and capital gains tax. The estate becomes a taxable entity upon death. During the period of administration, it may continue to earn income from interest on savings, dividends from shares, rental income from properties or other sources. This income must be declared to HMRNC, and the estate is taxed at the applicable rates. Personal representatives are treated as a single taxable person and are responsible for filing tax returns if the estate earns significant income or realizes taxable gains. Smaller estates may benefit from the informal payment procedures, whereby PRs can settle tax without filing full returns, provided the tax liability is minor. For larger or more complex estates, formal self-assessment tax returns are required. For income tax purposes, interest is taxed at 20%. Dividends are taxed at 8.75%. Rental income and other trading income are taxed at the basic rate of 20%. PRs are not entitled to the personal allowance, unlike individual taxpayers, but they may deduct allowable expenses related to estate management, such as agents' fees, insurance, or repairs on a lead property in calculating taxable income. For capital gains tax purposes, PRs may realize gains if they sell estate assets that have increased in value since the date of death. For example, if shares appreciated between death and their sale, the gain is taxable. Similarly, if a property increases in value before being sold, CGT may apply. PRs benefit from a reduced annual CGT exemption during the administration period. As of 2023-24, the allowance is £6,000 per tax year, compared to £12,300 for individuals, reducing further to £3,000 from April 2024. Any gains above this amount are taxed at 10% for most assets, 18% for residential property, basic rate, 20% and 28% respectively for higher rate gains depending on the asset. Losses on asset sales may be used to offset gains within the same year or carried forward to future years of administration. The administration period is generally treated as ending when all assets are distributed or vested in a continuing trust. CGT planning is important. If the estate holds appreciating assets, PRs may consider appropriating assets to beneficiaries before sale, allowing those beneficiaries to use their own CGT allowances and potentially lower rates. Beneficiaries' liability to CGT on inherited assets. When beneficiaries inherit assets from the estate, they receive them at their market value as at the date of death, known as the probate value or base cost for tax purposes. This is a key distinction from gifts during life, which transfer the donor's original acquisition cost. If a beneficiary later disposes of an inherited asset, such as selling inherited shares, property, or a valuable item, they may realize a capital gain. The gain is calculated as the difference between the probate value and the sale price. The beneficiary is liable for CGT on this amount, subject to their annual allowance and applicable rates. For example, if an individual inherits a property worth £300,000 at the date of death and later sells it for £350,000, the £50,000 gain may be subject to CGT. If the property was the beneficiary's main residence, principal private residence relief may apply. Otherwise, standard CGT rules determine the liability. Beneficiaries are not liable for CGT or income tax at the point of inheritance itself, only if and when they dispose of the asset. They should therefore keep accurate records of the probate value and any costs incurred in maintaining or selling the asset, as these may affect their tax position. Income received by a beneficiary from the estate, for example, income from an interest in possession trust or from income-producing assets during the administration period, is also potentially taxable. PRs must provide the beneficiaries with the appropriate tax certificates, Form R185, to allow them to declare and, if applicable, claim tax credits or refunds. In estates with ongoing trusts, tax liabilities may continue well beyond the administration period. Trustees then become responsible for tax compliance and reporting, and beneficiaries may need to complete annual tax returns depending on the trust income they receive.
Conclusion. So can a crazy man make a valid will? As we saw at the start, yes, if he meets the test. Banks v. Goodfellow reminds us that testamentary capacity isn't about being eccentric or even delusional. It's about understanding what a will does, what property you own, and who has a claim on your estate. That principle still underpins everything we've explored. Over the course of this guide, we've covered the full landscape of wills and estates for FLK2. You've seen what makes a will valid, testamentary capacity, freedom from undue influence, and strict formalities. We explored how wills can be altered, revoked, or interpreted, and what happens when they fail or gifts lapse. We looked at what happens when there is no will, and how the intestacy rules distribute estates according to strict legal priorities, not emotional ones. We've examined the role and duties of personal representatives, how they're appointed, what powers they hold, and how they manage debts, taxes, and distributions. We've broken down the mechanics of probate, the purpose of grants of representation, and what property passes outside the estate, from joint assets to pensions and trusts. We've looked at claims under the Inheritance for Provision for Family and Dependents Act 1975, who can bring them, what they must prove, and how the court balances fairness with freedom. And finally, we've unpacked the complex but vital world of taxation, from inheritance tax to income and capital gains tax during the administration period. Together, these topics make up the wills and estates component of FLK2, a subject that's as much about people as it is about law. Because when someone dies, what they leave behind and how it's handled can be one of the most meaningful legal moments in a person's life and legacy. Thanks for watching, and good luck with your revision. The solicitor didn't steal. No client complained, no one lost any money, and he was still struck off. Because under the Solicitors Accounts rules, intent does not matter. If a solicitor uses client money temporarily to keep his firm going, even if he plans to replace it, even if he sees it as short-term cash flow, the SRA sees something else. Client money is not your piggy bank. The moment you treat it as your own, even briefly, integrity is lost.
In this lecture, prepared by Dr. Yannis, we are going to explore in detail how the SRA accounts rules operate, what they require of authorized firms and individuals, why they are enforced the way they are, and how anti-money laundering obligations intersect with the handling of client money. This is not just about technical accounting, it is about professional conduct, public protection, and the very foundations of trust on which legal practice in England and Wales depends. Client money, public confidence, and regulatory context. To understand the regulatory landscape governing solicitor accounts in England and Wales, it is necessary to recognise the dual purpose of the SRA accounts rules, protecting clients' funds and maintaining public confidence in the legal profession. The SRA's accounts rules are not optional guidance, they are regulatory requirements that apply mandatorily to all firms and individuals authorised by the SRA. These rules govern every stage of dealing with client money, from receipt, record-keeping and reconciliation, through to withdrawal, return and reporting. At their core is a principle that client funds must be protected, segregated and appropriately administered. The regulatory environment in 2026 is defined by a significant paradigm shift in supervision and enforcement precipitated largely by the catastrophic collapse of Axiom Inc. in late 2023. Which resulted in a client money shortfall of approximately £60 million.
This event, along with the failures of other accumulative firms like the SSB Group, exposed systemic vulnerabilities in the SRA's risk detection capabilities and led to a rigorous intervention by the Legal Services Board. These obligations sit alongside and interact with the SRA's anti-money laundering framework. Firms must design and implement systems that not only comply with the accounts rules themselves, but also address wider financial crime risks. The result is a regulatory regime in which the handling of client money is both a technical accounting exercise and an ethical duty aligned with professional conduct expectations. This report explains these rules in detail, covering key definitions, operational requirements, statutory expectations, AML linkages, enforcement approaches, and common compliance challenges. It reflects both the current regulatory text and the interpretation and enforcement context in 2026.
The post-Axiom Ince regulatory landscape. The aftermath of the Axiom Ince intervention has fundamentally altered the SRA's approach to client money. Following an independent review commissioned by the LSB, the regulator was issued binding directions to strengthen its oversight mechanisms. The review highlighted that the SRA had failed to act adequately or effectively in identifying risks posed by firms growing rapidly through mergers, accumulator firms, and those where compliance roles, COLP or COFA, were concentrated in a single individual. In response, the SRA's 2025-2026 business plan prioritizes the protection of client money through several key initiatives. Enhanced monitoring, the use of sophisticated data analytics to identify irregular financial patterns, such as unusual fluctuations in client account balances or rapid increases in turnover that do not match the firm's profile. Stricter accountants reports. Proposals introduced in late 2025 aim to require all firms, not just those with qualified reports, to submit their annual accountants reports to the SRA. This allows for a comprehensive market-wide view of compliance. Consumer Protection Review. A broad review of the consumer protection framework is underway, examining whether the model of solicitors holding client money remains viable in the long term or whether alternatives like third-party managed accounts, TPMAs, should become mandatory for high-risk transactions. For candidates preparing for the SQE, understanding this context is vital. Exam scenarios may test not just the mechanics of the rules, but the risk implications of non-compliance. A failure to reconcile accounts is no longer just a breach of Rule 8.3, it is a red flag for potential insolvency or theft that triggers immediate regulatory escalation.
Who must comply and what client money means? The SRA accounts rules apply to all authorized firms and individuals regulated by the SRA, including sole traders, partnerships, incorporated practices, LLPs and limited companies, and alternative business structures, ABS. These rules operate across a variety of contexts and require firms to implement systems and controls appropriate to the volume and nature of client money handled. The regulatory design recognizes that the scale of client transactions may vary, but the obligation to protect client funds remains consistent. The definition of client money, Rule 2.1. Under Rule 2.1 of the SRA accounts rules, client money refers to any money received or held by a firm in connection with regulated legal services that is not yet due to be transferred to a third party or paid as fees following billing. Specifically, client money is money held or received, 1. relating to regulated services, money held for a client in the course of providing legal advice or representation, 2. on behalf of a third party, funds held as an agent, stakeholder, or to the sender's order in connection with regulated services, 3. as a trustee or office holder, money held where the solicitor acts as a trustee, court of protection deputy, or donee of a power of attorney, 4. in respect of fees and unpaid disbursements. Crucially, this includes money received for fees and disbursements prior to the delivery of a bill or written notification of costs. This fourth category is a common area of confusion. Money received on account of costs is client money because the firm has not yet earned it by delivering the service and issuing a bill. It must be held in the client account. It only becomes business money, funds belonging to the firm, once a bill has been validly delivered to the client and the specific sum identified in the bill is transferred. Distinguishing client money from business money. It is crucial to note that not all money received by a firm is automatically client money. For example, funds that are clearly attributable to the firm's business income, once properly billed and due, are not treated as client money. Reimbursements. If a firm has already paid a disbursement, aka a search fee, using its own business funds, any money received from the client to reimburse that specific expense is business money. Agreed fees. Historically, agreed fees could be paid into the office account. Under the 2019 rules as applied in 2026, money for fixed fees is generally client money until the work is done and a bill is sent. However, Rule 2.1d creates a nuance. If a bill is delivered before the money is received, the receipt can be treated as business money. The SRA guidance on taking money for your firm's costs clarifies that firms can bill for work not yet done, aka an agreed fixed fee, and pay this into the business account, provided the client is informed and the risks are managed. However, if there is any doubt whether money belongs to a client or to the firm, the regulator expects firms to treat it as conservatively client money until it can be properly allocated. This ensures the protective purposes of the regulatory framework. Third-party managed accounts, TPMAs. Client money also includes money held in more complex arrangements, such as third-party managed accounts, TPMAs, provided that the firm controls or manages the handling of those funds in the context of delivering regulated services. Rule 11 allows firms to use a TPMA as an alternative to holding client money directly. Requirements. The TPMA provider must be regulated by the Financial Conduct Authority, FCA. The firm must inform the client of the arrangement, including who pays the fees and the client's right to terminate. Regulatory status. Funds in a TPMA are not held by the solicitor, so they do not fall under the SRA's compensation fund in the same way as money in a client account. Solicitors must ensure clients understand this distinction. Adoption. While adoption was initially slow, the SRA's 2025-26 consultations have actively encouraged TPMAs as a mechanism to de-risk the profession, reducing the temptation for dishonesty and the burden of holding millions in client funds. Client accounts and segregation of funds. Once money is determined to be client money, the accounts rules require it to be held in a designated client account, a bank or building society account in the name of the firm that clearly identifies it as a client account. The account must be held at a branch or head office in England and Wales. The principle of segregation. The account must be separate from the firm's own business or office account. This segregation is fundamental. It protects client funds from being mistaken for business funds, from being misused for purposes unrelated to the client, and from being caught up in insolvency processes affecting the firm. Insolvency protection. In the event of a law firm's failure, like Axiom Incy, funds in a properly designated client account are deemed to be held on trust. They do not form part of the firm's assets available to general creditors. If funds are improperly mixed in a business account, this protection is compromised, potentially leading to total loss for the client. Duty to monitor. Firms must monitor where their client accounts are held and take steps to ensure the institutions are financially sound and appropriately regulated. Prohibition on banking facilities. Rule 3.3. The segregation requirement is not merely procedural, it reflects the regulator's prioritization of trust and confidence. If firms commingle client money with business money, they erode that trust and create significant risk. For that reason, and because of associated money laundering concerns, the accounts rules prohibit firms from using their client account as a general banking facility for clients or third parties. Rule 3.3 states you must not use a client account to provide banking facilities to clients or third parties. Payments into and transfers or withdrawals from a client account must be in respect of the delivery by you of regulated services. This rule is a critical enforcement priority. The SRA has issued multiple warning notices emphasizing that the client account is not a bank account for the convenience of wealthy clients or corporations. The proper connection test. There must be a clear nexus between the money held and a specific legal transaction. For example, holding £1 million for a client pending investment opportunities without a specific property purchase or commercial deal in progress is a breach. Case law. SRA v. Clyde & Co. 2017.
The firm was fined £50,000, which was a record at the time, for allowing its client account to be used as a banking facility for clients who struggled to open UK bank accounts. The tribunal ruled that acting as an escrow agent in isolation without underlying legal work breached the rule. Case law, SRA versus Mishcon Derea, 2022. The firm was fined £232,500 for AML and banking facility breaches. It facilitated transactions where the legal work was minimal or non-existent compared to the volume of funds moved, effectively acting as a bank. A client account is not a deposit account for speculative or wide-ranging financial purposes. It must be used strictly in connection with the delivery of regulated legal services and only for the specific clients or third parties for whom the money is held. Funds held in these accounts must be traceable, reconcilable, and capable of being returned without unnecessary delay when the money is no longer required for its original purpose.
Receipt of client money and prompt payment. Under the accounts rules, when client money is received by a firm, it must be paid into the client account promptly, while the 2011 rules specified without delay, often interpreted as the next working day. The 2019 rules, applicable in 2026, use the term promptly, placing the onus on the firm to justify any delay. Operational expectations. Although the rules do not prescribe an exact number of days, the expectation in practice is that firms develop internal policies that minimize delay, such as ensuring client monies, whether received by check, electronic transfer, or cash, are deposited into the client account within 1 to 2 business days. Risk of delay. This prompt payment requirement helps to avoid situations where client funds remain in a business account or other non-segregated account for extended periods, which could lead to misappropriation, confusion in records, or regulatory breaches. Checks. Checks should be banked immediately. Holding a check on a file for weeks until the deal completes is a breach of the obligation to safeguard client assets. Handling mixed payments, Rule 4.2. The SRA recognizes that firms may receive mixed payments, that is, payments that include both client money and firm money in a single transaction. For example, a client pays a comprehensive sum of £5,000, comprising £3,000 for a settlement, client money, and £2,000 for professional fees, business money. In such cases, the firm must allocate funds promptly and correctly between the client account and the firm's business account. Best practice, the standard approach is to pay the entire mixed sum into the client account. Once the funds have cleared, the business money portion, £2,000 in the example, must be transferred out to the business account promptly, typically within 14 days. Alternative, firms may pay the mixed sum into the business account, but must then transfer the client money portion to the client account immediately. This approach carries higher risk if the firm's business account is overdrawn or frozen. If a firm receives money that is not genuinely client money, such as funds clearly attributable to third parties unrelated to regulated services, it should not be paid into a client account. Mistakes in allocation can lead to regulatory breaches and may undermine compliance with both the accounts rules and AML requirements. Note that a 14-day window for transferring business money out was a hard rule in 2011. Under the 2019 rules, now the requirement is simply promptly. Most firms still use 14 days as a safe harbour, but the SQE may use the word promptly in its correct answer options. Withdrawal of client money and notification of costs. One of the most critical aspects of the accounts rules is the requirement governing withdrawals from client accounts. Client money may only be withdrawn in specified circumstances, and even then strict procedural requirements must be observed. Permitted withdrawals, Rule 5.1. Under the accounts rules, client money may be withdrawn from a client account where it is 1. Used for the purpose for which it is held, e.g., paying stamp duty, a settlement sum, or a beneficiary; 2. Following the client's instruction; 3. On the SRA's prior written authorization, or in prescribed circumstances, such as a court order. Note that when needed, reasonable steps to trace a client include at least one letter to the last known address and potentially an electronic search even for amounts under £500. The sufficient funds requirement, Rule 5.3. Rule 5.3 contains a fundamental prohibition. A firm must not withdraw client money unless sufficient funds are held on behalf of the specific client or third party to make the payment. This rule prevents teaming and lading, using one client's money to pay another client's obligations.
Example: if client A has £500 in the client account, the firm cannot pay a £600 disbursement for client A, even if the general client account holds £1 million from other clients. The £100 shortfall would be funded by other clients' money, constituting a serious breach. Written notification of costs, Rule 4.3. Crucially, firms must provide written notification of costs, typically in the form of a bill of costs, to the client or paying party before transferring client money to settle costs or disbursements. Transparency. This requirement ensures that clients are fully informed about how much of their money is being used and for what purpose before the withdrawal occurs. It prevents firms from unilaterally applying client funds without the client's knowledge. Mechanism. The notification can be a formal invoice or another written notification, e.g. a completion statement in conveyancing. In practice, this means that no transfer for fees should occur until the bill has been issued and clients have had the opportunity to understand and, where appropriate, query the charges. Disbursements. The SRA has clarified that firms can reimburse themselves for paid disbursements, expenses already incurred by the firm from the business account, provided a bill or notification has been sent. For unpaid professional disbursements, e.g. counsel's fees, the money is client money and can be paid directly to the counsel from the client account without a prior bill to the client, provided it is for the purpose of the retainer. Authorization and supervision. Payments out of a client account must also be appropriately authorized and supervised. Firms must ensure that withdrawal instructions are reviewed and approved by qualified personnel, often senior fee earners or compliance officers, COFADs, to safeguard against errors and misuse. This is a key internal control tested during SRA inspections. A very narrow exception exists under Rule 5.1c of the Accounts Rules for withdrawal of very small residual balances, such as client account balances of £500 or less, paid to a nominated charity, provided certain conditions are met. Even this limited exception is tightly controlled and must comply with regulatory guidance.
AML, client money and regulatory risk controls. While the accounts rules and anti-money laundering regime are separate regulatory instruments, they intersect in practice because misuse of client accounts can facilitate financial crime. The SRA's guidance on improper client account use explicitly notes that allowing a client account to operate as a banking facility increases the risk of money laundering and undermines professional independence. The 2026 AML Framework. The AML framework applies to firms that provide services falling within the Money Laundering Regulations 2017, as amended, including transactional legal services, conveyancing, M&A, trust creation. Firms are expected to carry out practice-wide risk assessments, identifying risks inherent to their specific client base and services. Conduct client and matter risk assessments, assessing risk at the individual file level. Perform customer due diligence, CDD, verifying the identity of clients and beneficial owners. Monitor transactions, identifying suspicious activity, such as funds coming from unexpected sources or requests to return funds to a different account. Red flags in client accounting. Although a breach of an accounts rule does not require evidence of actual money laundering, regulatory guidance recognizes that weak controls over client accounts, such as inadequate reconciliation, improper transfers between client ledgers, or failure to verify the source of funds, create vulnerabilities that criminals can exploit. Source of funds, SOF. Legal cashiers and fee earners must verify the source of funds before accepting them into the client account. Accepting large sums without SOF evidence is a primary trigger for SRA fines. Rapid movement of funds. Money entering and leaving the account quickly without clear legal work being done is a classic money laundering typology, layering. Third-party payments. Requests to pay proceeds to a third party, for example, please pay my sale proceeds to my brother, are high risk and often prohibited under Rule 3.3 without robust justification and due diligence. Firms must therefore design their AML policies and client account controls to work together, ensuring that suspicious transactions are identified and that regulatory obligations are met in both regimes.
The SRA's AML guidance emphasizes proactive strategies for identifying and mitigating risk, including maintaining up-to-date risk profiles for clients and matters and ensuring staff understand and implement AML measures effectively. Accountancy records reconciliation and reporting. Accurate and detailed record keeping is at the center of compliance with the accounts rules. Firms must maintain separate client ledgers for each matter, record all receipts and payments, and ensure that client money is traceable from receipt to disbursement or return. Double-entry bookkeeping. The SRA requires accounting systems to be based on double-entry bookkeeping principles. Every transaction must be recorded twice, once as a debit, DR, and once as a credit, CR. Asset accounts, e.g. bank, debit to increase, credit to decrease. Liability accounts, e.g. client ledger, credit to increase, firm owes client, debit to decrease, firm pays client. Income accounts, e.g. profit costs, credit to increase. Expense accounts, debit to increase. Key SQE scenario. Billing a client. When a firm issues a bill for £1,000 plus £200 VAT, 1. Debit client ledger business section £1,200, asset client now owes the firm. 2. Credit profit costs ledger £1,000, income firm has earned revenue. 3. Credit HMRC/VAT ledger £200, liability firm owes VAT to HMRC. Key SQE scenario. Abatement, reducing a bill. If the bill is reduced by £100 plus £20 VAT, 1. Debit profit costs ledger £100, reducing income. 2. Debit HMRC/VAT ledger £20, reducing VAT liability. 3. Credit client ledger business section £120, reducing the amount the client owes. It's worth noting that if the disbursement being abated was a vatable service, the VAT ledger must also be debited.
Three-way reconciliation, Rule 8.3. One of the most important compliance processes is client account reconciliation. Under Rule 8.3, firms must obtain bank statements for all client accounts and reconcile them with the firm's internal records at least every 5 weeks. This is not just a comparison of the bank statement to the cash book, it is a three-way reconciliation that must agree. 1. Bank statement balance, the figure on the bank statement adjusted for unpresented checks or lodgements. 2. Cash book balance, the running total in the firm's internal cash log. 3. Client ledger total, the sum of all individual client ledger balances. Formula: adjusted bank balance equals cash book balance equals total of client ledgers. Note that adjusted bank balance means the statement balance minus unpresented checks plus outstanding lodgements. This regular reconciliation ensures that discrepancies are identified quickly, errors are corrected, and client money is properly accounted for. Firms are expected to document reconciliations comprehensively, showing evidence of who prepared and reviewed the process signed off by the CFOA. A lack of reconciliation or recurrent unreconciled differences can be interpreted by the SRA as a failure to maintain adequate systems and controls, attracting regulatory action.
Accountants Reports, Rule 12. In addition to internal reconciliation, many firms are required to obtain an accountant's report at the end of each accounting period. Reporting accountants review client money controls, reconciliation practices, and compliance with the accounts rules. Exemptions: firms are exempt if they hold only legal aid money or if their average client balance is less than or equal to £10,000 and the maximum balance is less than or equal to £250,000 during the accounting period. Qualified reports: if a report is qualified due to serious or persistent breaches, the firm must deliver that report to the SRA. 2026 proposals. Following the Axiom Ints review, the SRA has proposed requiring all accountants' reports, qualified or not, to be submitted to the SRA to improve market oversight alongside an annual declaration of compliance.
Residual balances and return of client money. A common area of compliance difficulty for firms involves residual client balances, amounts left in client accounts after a matter has concluded and fees, disbursements, and other liabilities have been satisfied. Under Rule 2.5 of the Accounts Rules, firms must return client money to the client or third party as soon as there is no longer a proper reason to hold it. The promptly requirement.
The regulatory expectation is that residual balances should not sit indefinitely in client accounts once the firm has completed its work. Just in case is not a valid reason to retain funds. Firms should maintain procedures for determining when residual money should be returned, for example, file closure checklists, and should take reasonable steps to trace clients or other payees if contact details are unavailable. Paying to charity, Rule 5.1c. Where clients cannot be traced, the rules provide a mechanism to clear these balances to charity. Balances of £500 or less, firms may withdraw these funds and pay them to a charity of their choice without SRA authorization, provided they have taken reasonable steps to trace the client and recorded those steps. Balances over £500, firms must apply to the SRA for prior written authorization to withdraw the funds. The SRA will require evidence of extensive tracing efforts, for example, use of tracing agents, DWP searches, before granting permission. Firms must keep a central register of all such withdrawals, detailing the client name, amount, steps taken to trace, and the charity receipt. These provisions balance the principle of returning client funds with pragmatic approaches to uncontrollable situations.
Enforcement sanctions and professional standards. Compliance with the accounts rules is not purely administrative, it is a professional duty rooted in the SRA's broader regulatory objectives, which include protecting consumers, upholding the rule of law, and maintaining confidence in the profession. Where firms breach the accounts rules, the SRA may take enforcement action under its disciplinary powers. The Enforcement Toolkit 2026. The SRA's enforcement powers have been significantly expanded by the Economic Crime and Corporate Transparency Act 2023. Unlimited fines. For breaches related to economic crime, which includes many serious accounts rules failures involving AML, the SRA can now impose unlimited fines without referring the matter to the Solicitors Disciplinary Tribunal. Increased cap. For other breaches, the SRA's internal fining cap for traditional firms has been raised to £25,000. Fixed penalties. A fixed penalty scheme has been introduced for lower-level administrative breaches, such as failure to submit diversity data or late delivery of accountants' reports. Sanctions and severity. Enforcement outcomes vary across firms and individuals, but common sanctions include formal warnings, financial penalties, conditions on practice, suspension, or even strike-off in serious cases involving client money misuse or persistent non-compliance. Dishonesty. As established in SRA against James and SRA against Beckwith, a finding of dishonesty regarding client money, e.g. using client funds to prop up the firm's cash flow, almost invariably leads to strike-off. Personal mitigation, stress, health is rarely sufficient to avoid this outcome in dishonesty cases. Banking facility. Breaches of Rule 3.3 are treated as strict liability offences. The SRA does not need to prove money laundering occurred. The risk created by the facility is sufficient for severe sanction. Duty to correct, Rule 6.1. When breaches are discovered, firms are expected to correct them promptly, returning improperly withheld or withdrawn money to client accounts as soon as possible. Under Rule 6.1, any shortfall must be replaced immediately, typically by transferring funds from the business account. Failure to rectify breaches immediately upon discovery is an aggravating factor that can escalate a negligent error into a disciplinary matter. Integrating compliance for protection and public trust. The SRA accounts rules represent a comprehensive regulatory regime that is central to the ethical and operational conduct of solicitors and firms in England and Wales. By establishing detailed obligations on handling client money, segregation requirements, reconciliation procedures, and withdrawal conditions, the regulatory framework ensures that client funds are protected, traceable, and only used for proper lawful purposes. For practitioners and aspiring solicitors preparing for FLK2 assessments, mastery of these rules is critical. It requires understanding not only the technical requirements, but also how they tie to professional duties, enforcement narratives, and wider regulatory strategy. The post-Axion INS landscape of 2026 demands a higher level of vigilance than ever before. Compliance is not a static checklist, it is an ongoing, proactive commitment to safeguarding client interests and maintaining the integrity of the profession. As we've seen in this presentation, the SRA accounts rules are not a set of abstract technicalities you can learn once and forget. They are a core part of professional responsibility.
Standards that safeguard client money uphold public confidence and define what it means to practice law ethically in England and Wales. Whether it's holding client funds, reconciling accounts every 5 weeks, understanding when and how money can be withdrawn, or integrating anti-money laundering controls into everyday practice, these obligations shape how solicitors operate at every stage of a matter. Understanding these rules doesn't just help you pass the FLK2 assessment, it prepares you for real accountability in practice, where the consequences of misunderstanding or misapplying them can extend well beyond poor marks. They can affect clients' lives, a firm's reputation, and, as illustrated, your own right to practice. If you found this video useful, practical, and thought-provoking, you're in the right place. In Dr. Yannis' channel, we explore key regulatory concepts in depth, linking professional standards with real-world application for aspiring solicitors and law professionals. Take some time to look around the channel for more content on regulatory frameworks, professional conduct, examination strategy, and the skills you need to succeed as a future legal practitioner. Thanks for watching, and I'll see you in the next lesson.
Picture this. You're house hunting, scrolling listings, and you see a cottage that looks almost too good to be true. Same street, same size, but for some reason it's miles cheaper than everything else. You ask the agent what the catch is, and they give you the line in that polite, careful voice. It's being sold subject to the occupier's rights. And then you meet him. An elderly man, living there, calm as you like, not moving, not temporarily staying, properly in occupation. The paperwork makes it clear he has the right to remain. The price suddenly makes sense. You haven't bought a cozy cottage with vacant possession. You've bought a cottage with a human timetable attached to it. But in your head, you do what people do. You start quietly running the numbers. You tell yourself, not out loud of course, that this is a bargain because, well, because he can't live forever. You think you've found the loophole listing, a property investment with a built-in just wait strategy. So you buy. And then time passes, and he's still there. A year goes by, then another. He's still there, still pottering about, still watching Netflix, still very much not cooperating with your unspoken business model. Eventually, you decide you want your house now. You convince yourself that whatever his arrangement is, it can't be that strong. Surely it's just a bit of informality. Maybe he's basically there by permission. Maybe you can push him out. That is the moment landlord turns from interesting academic detail into a judicial slap in the face. Because in Binions v. Evans, that is essentially what happened. Buyers purchased land at a reduced price because an elderly widow was in occupation and was meant to be able to stay. The purchasers then tried to treat her as removable once they had the legal title, and the Court of Appeal said, in effect, you don't get to take the discount that reflects her right to remain and then try to pretend that right isn't real. Equity will not let you play that game. That is your first lesson in land law for the SQE. This subject is not just about who has the deeds or whose name is on the register. It's about how rights in land are created, what makes them legal or equitable, how they bind third parties, and how the law stops people using technical ownership to behave unconscionably. And yes, sometimes it's about the uncomfortable truth that people try to build property strategies around waiting for someone to die, only to discover that land law has a long memory and equity has even longer patience.
How to think like a solicitor. This lecture takes you through the SRA FLK2 land law specification in full. The aim is not just to recite rules, but to help you spot the issues, apply the correct framework, and explain the result clearly the way a newly qualified solicitor would in practice. Throughout, keep one practical mindset. Land law is about priority. When multiple people claim rights over the same piece of land, who wins and why? Almost every problem question reduces to 3 disciplined steps. First, identify the right that is being claimed. Second, classify it as legal or equitable. Third, work out whether it binds the relevant person, usually a purchaser, lender, or successor in title, by applying the relevant protection and priority rules. Land problems also carry professional obligations. In practice, you must act honestly, with integrity, and in the best interests of each client, while still complying with duties to the court and the wider public interest. The SRA principles set out those baseline duties, including rule of law, public trust, independence, honesty, integrity, equality and inclusion, and acting in each client's best interests. The SRA's competence statement frames those ethical and professional behaviors as part of being competent, not optional extras. In SQE terms, that means you should be alive to conflicts of interest, undertakings, misleading the other side in sharp practice in completion, and fairness in advising vulnerable clients. Now we move item by item through the specification.
Distinction between real property and personal property. Real property is land and interests in land. It is real in the historical sense. It was recoverable by real actions, and it attracts a specialized system of estates, registration, and third-party priority. Personal property is everything else. It includes chattels, money, shares, intellectual property, and shows in action like debts. Personal property generally transfers by delivery, assignment, or contractual mechanisms. It does not carry the same registration-based priority structure as land. Why does the distinction matter for SQE questions? Because remedies, formalities, and enforcement differ. A dispute about a car is a dispute about personal property. A dispute about a right-of-way, a lease, or a beneficial interest in a home is land law. And the analysis is built around estates, interests, and whether the right binds third parties. How to acquire and transfer legal estates. In modern English land law, the menu of legal estates is deliberately narrow. The Law of Property 1925 reduces legal estates essentially to the fee simple absolute in possession and the term of years absolute. In plain English, that is freehold and leasehold. A legal estate is acquired either by original grant from the Crown in the distant past, which is not how we think about it today, or far more commonly by transfer from an existing owner. In registered land, a transfer of a registered freehold or registered lease is not complete at law until registration. This is one of the defining ideas of the Land Registration Act 2002. Title is conferred by registration, not merely evidenced by it. In practice, that means the signed transfer deed is essential, but the legal title moment comes when the land registry updates the register. In unregistered land, the legal estate can pass on completion of a valid deed of conveyance, assuming the correct formalities are met. But in modern practice, many dealings trigger compulsory first registration, so the unregistered system is shrinking, even though it remains examinable. Always connect this to the client-based scenario. If your client is buying a house and you are told it is registered land, you immediately think contract, transfer deed, completion, and registration. If you are told the title is unregistered, you think deducing title from deeds, investigating pre-root title, and the land charges system.
How to acquire and dispose of legal and equitable interests in land. Land law distinguishes between estates and interests. An estate is a time-limited slice of ownership, such as freehold or leasehold. An interest is a right affecting land, often held by someone other than the estate owner. Interests include easements, restrictive covenants, mortgages, and beneficial interests under a trust. Then you distinguish legal and equitable. Legal rights tend to be stronger and, crucially, are capable of binding the world without needing notice in the ordinary sense, because the law gives them proprietary force. Equitable rights are also proprietary in nature, but their enforceability against third parties is controlled by equitable doctrines and, in modern systems, by registration, overreaching, and priority rules. A legal interest is typically created by deed, and if it is registrable in registered land, it must also be completed by registration to take effect at law. An equitable interest can arise from a written disposition that does not meet the legal formalities, from a trust, from proprietary estoppel, or from other equitable doctrines. Disposal is the flip side. Many equitable interests must be disposed of in writing. Some equitable interests are overreachable, meaning they can be swept off the land and attached instead to the sale proceeds, so that the buyer takes the land free of them, provided the correct statutory conditions are met. In exam terms, when you see beneficial interest plus sale by trustees, you should hear the word overreaching in your mind.
Methods to protect and enforce third-party interests. Third-party interests are the heart of land law problems. A third-party interest is any right held by someone other than the person appearing to own the land, usually the registered proprietor or the legal owner in an unregistered title. Protection depends on whether the land is registered or unregistered. In registered land, the main tools are entry on the register by notice, entry by restriction, and the special category of overriding interests that can bind even though they are not entered. The priority rules in the Land Registration Act 2002 then decide whether the interest binds a purchaser or a lender. In unregistered land, protection is achieved through the Land Charges Act 1972 registration system for certain interests and through the doctrine of notice for other equitable interests. Enforcement means asking, can the holder of the interest assert it against the current holder of the estate? If yes, they can usually seek injunctions, damages, specific performance, or proprietary remedies depending on the interest. If no, the interest may still be enforceable personally against the original party, but not against successors. As a solicitor, you also enforce by good process. You carry out searches, inspect the property, ask the right inquiries, and advise on risks. That practical dimension is often what the SQE problem question is testing. Different ways in which land can be held. Held here means both the estate structure and the ownership structure. At the estate level, land is held either freehold or leasehold. A freehold is potentially indefinite in duration, a lease is time-limited, even if it is very long. At the ownership structure level, land can be held by a sole owner or by co-owners. Co-ownership operates through the Trust of Land framework. The legal title is held by trustees, and the beneficial interests are held in equity by the beneficiaries. Land can also be held subject to burdens and benefits. An owner may hold land that is benefited by an easement, such as a right-of-way, and burdened by a restrictive covenant, such as a ban on running a business from home. For SQE purposes, always treat ownership as a bundle of rights and liabilities rather than a single absolute concept.
Legal formalities required to create and transfer interests and estates in land. Formalities are not decorative. They decide whether a right exists at law, exists only in equity, or does not exist at all. Contracts for the sale or other disposition of an interest in land generally must comply with Section 2 of the Law of Property Miscellaneous Provisions Act 1989. That means the contract must be in writing, incorporate all the express terms, and be signed by or on behalf of each party. If Section 2 is not satisfied, the contract is generally unenforceable. A conveyance of a legal estate or a legal interest is generally done by deed. A deed must be in writing, make clear it is intended to be a deed, be validly executed, and be delivered as a deed. Dispositions of existing equitable interests are controlled by Section 53 of the Law of Property Act 1925. In particular, a disposition of an existing equitable interest must be in writing, signed by the person disposing on it, unless an exception applies. Express trusts of land also require evidence in writing. Equity can soften harsh formality results through doctrines like proprietary estoppel and constructive trusts, but you must be precise. Equity is not a general fairness override. It is a set of defined doctrines with defined elements. Registration of title to land. Registered land is now the default in England and Wales. The Land Registration Act 2002 governs the modern system, built around the register as the central source of title information. The register typically has three key sections. The property register describes the land and appurtenant rights. The proprietorship register shows who owns and the class of title. The charges register shows burdens such as mortgages and restrictive covenants. Three conceptual principles are often used to explain the system. The mirror principle is the aspiration that the register reflects the relevant rights. The curtain principle is the idea that certain equitable interests, especially beneficial interests under trusts, are kept off the register so buyers are not forced into family financial arrangements. The insurance principle is the state-backed indemnity scheme that compensates loss caused by certain registration mistakes. Those principles are ideals, not perfect truths, because overriding exists and because human behavior produces fraud and hidden realities. But they frame the reasoning. Estates that can be substantively registered. Substantive registration means the estate itself is registered, and the register is the source of legal title. In practice, the core substantively registrable estates you need for SQE are freehold estates and leasehold estates granted for more than 7 years. Legal mortgages over registered land are also protected and operate through registered charges. Compulsory first registration is triggered by certain dispositions, most notably transfers of a freehold, the grant of a lease for more than 7 years, and certain mortgages of unregistered land. The exam often signals this with words like "this is the first time the land has been registered" or "the title remains unregistered."
How to protect interests. In registered land, protection is mainly done by notices and restrictions. A notice on the register protects the priority of an interest, typically an equitable interest such as a restrictive covenant, an estate contract, or an equitable easement. If protected by notice, it will generally bind a purchaser. A restriction does not itself create priority in the same way, but it controls what can be registered. It is often used to protect beneficial interests under a trust by requiring, for example, that no disposition is registered unless there are at least 2 trustees, thereby facilitating overreaching. There are also situations where the law gives protection without entry through overriding interests. But overriding status is narrow and fact-sensitive. A prudent solicitor will generally aim to protect an interest on the register whenever possible, because relying on overriding status is risky. Interests that override registration and interests that need to be protected on the register. This is a high-yield SQE area. Overriding interests bind a purchaser even though they are not entered on the register, provided the statutory conditions are met. The Land Registration Act 2002 confines overriding interests largely to situations where it is unreasonable to expect entry on the register, or where the interest is obvious on inspection. The 3 overriding categories most commonly tested are short leases, interests of persons in actual occupation, and certain legal easements and profits. A legal lease for a term not exceeding 7 years can override. The practical message is that a buyer must ask who is in occupation and must read any tenancy arrangement, even if it is not on the register. An interest coupled with actual occupation can override. The classic example is a spouse with a beneficial interest under a trust who is in actual occupation. The leading authority is Williams and Glyn's Bank versus Boland, where the wife's beneficial interest coupled with her actual occupation could bind the bank. Purchasers and lenders respond with inspection and inquiries, and in practice with requiring overreaching by ensuring there are 2 trustees or a trust corporation to receive the purchase money. Actual occupation is fact-based and can include more than physical presence at the moment of completion. The courts look for a degree of permanence and continuity. Cases like Link Lending versus Bostard show that physical absence does not automatically defeat occupation if there is a continuing connection and an intention to return in appropriate circumstances. Legal easements can also override in some circumstances, especially those that are obvious on inspection or have been exercised within a relevant period, reflecting the policy that some rights are practically discoverable even if not entered. By contrast, many other interests need to be protected on the register by notice or restriction, otherwise they may be postponed to a purchaser for value. That includes restrictive covenants, estate contracts, equitable easements, and equitable mortgages. The examiner's common move is to give you an equitable interest, then tell you it was not protected, then introduce a purchase or mortgage and ask whether it binds.
Core principles of unregistered title to land. Unregistered title is deduced, not looked up. The owner proves title by producing a chain of deeds showing ownership, typically going back to a good root of title, traditionally at least 15 years, though practice and context matter.
Because there is no single state-backed register of title, the legal system historically relied on documentary investigation and on rules controlling third-party rights, notably the doctrine of notice and the land charges registration system. In unregistered land, the key question is often whether the purchaser is a bona fide purchaser of a legal estate for value without notice. If they are, they take free of certain equitable interests unless those interests are registrable as land charges and have been properly registered. Role of title deeds. Title deeds are evidence of title in the unregistered system. They show conveyances, mortgages, releases, and other dealings that reveal both ownership and burdens. A common exam twist is the buyer did not inspect the deeds carefully, or the solicitor failed to notice a restrictive covenant. In practice, professional negligence risk is high here, which is why registration has been so strongly promoted. Once land becomes registered, title deeds cease to be the primary proof of title, though historic deeds may still be relevant for interpretation or for rights not fully reflected on the register. Land charges. The Land Charges Act 1972 creates a registration system for certain interests affecting unregistered land, registered against the name of the estate owner. This is counterintuitive, so slow down. In unregistered land, some equitable rights are not protected by being in the deeds chain in a way that binds purchasers automatically. Instead, Parliament created registrable classes of land charges. If the charge is registrable and not registered, it can be void against a purchaser of the relevant kind, even if the purchaser actually knew about it. That is the crucial point. For registrable land charges, registration replaces the old notice analysis. Commonly examined land charges include estate contracts, restrictive covenants, and puisne mortgages. If you are told an equitable interest exists over unregistered land, always ask, is it registrable as a land charge and was it registered correctly against the correct name? Name errors can be fatal. Continuing role of doctrine of notice. The classic equitable rule is that equitable interests bind everyone except the bona fide purchaser of a legal estate for value without notice. Notice can be actual, constructive, or imputed. Actual notice is what the purchaser knows in reality. Constructive notice is what the purchaser would have discovered had they made the inspections and inquiries that a reasonable purchaser would make. Imputed notice is knowledge attributed to the purchaser because their agent, typically their solicitor, knew it. In exam terms, notice analysis often hinges on whether occupation was obvious, whether inquiries were made, and what the solicitor should have discovered.
Differences between joint tenants and tenants in common in law and in equity. Co-ownership is a staple of FLK2. Begin with the structural point. At law, co-owners hold as joint tenants only. The legal estate cannot be held as tenants in common. Equity, however, can recognize either joint tenancy or tenancy in common in the beneficial interest. Joint tenancy means each co-owner is treated as owning the whole together, not a distinct share. Tenancy in common means each co-owner has a distinct undivided share, such as 50% each or 70-30, even though the land is not physically divided. The four unities underpin joint tenancy: unity of possession, interest, title, and time. Tenancy in common requires unity of possession, but not necessarily the other three. Practically, many disputes arise because couples assume we own it together, but that phrase could point to either equitable joint tenancy or equitable tenancy in common, depending on intention and evidence. Rule of survivorship. The right of survivorship, or jus accrescendi, applies to joint tenancies. When one joint tenant dies, their interest vanishes and the survivors automatically own the whole, without the property passing under a will. This can produce outcomes that match some people's expectations in family homes, but it can also produce outcomes people dislike, for example in second marriages, where someone wants their share to pass to children from a first marriage. Tenants in common do not have survivorship. Their share passes under their will or intestacy. In exam problems, survivorship often appears after a death. The key question becomes, was the joint tenancy severed before death? If yes, survivorship does not apply. Severance of joint tenancies. Severance is the process by which an equitable joint tenancy is converted into an equitable tenancy in common, removing survivorship. Severance can be done unilaterally by notice in writing under Section 36(2) of the Law of Property Act 1925. The notice must show an immediate intention to sever, not merely a future possibility. Service rules matter, and cases show that even where the recipient does not read the notice, effective service can still sever. Severance can also occur by mutual agreement, or by a course of dealing showing that the parties treated their interests as separate shares, such as negotiating a split or acting in a way consistent with separate ownership. In exam terms, the easiest marks come from stating clearly what severance does and then applying the method to the facts. If the facts show a written notice served, you focus on statutory notice. If the facts show negotiations and treated shares as separate, you focus on agreement or course of dealing.
Solving disagreements between co-owners by reference to Sections 14 and 15 of Trusts of Land and Appointment of Trustees Act 1996. Tollata is the statute that modernizes co-ownership disputes. When co-owners disagree, for example, one wants to sell and the other wants to stay, the route is an application to court under Section 14 for an order relating to the exercise by the trustees of their functions, including an order for sale or an order regulating occupation. Section 15 tells the court what to consider. The court weighs the intentions of the persons who created the trust, the purposes for which the property is held, the welfare of any minor occupying or expected to occupy, and the interests of any secured creditor. This is a balancing exercise, not a mechanical test. If the home was bought as a family home for children, the purpose may support postponing sale while children are minors, though not indefinitely. If there is a secured creditor, especially a bank, the creditor's interest is powerful. Many exam answers gain marks by explicitly walking through each Section 15 factor in a calm, structured way. The wider co-ownership framework also involves determining what shares exist in equity, especially where legal title and beneficial ownership diverge. The modern approach in domestic contexts is strongly influenced by cases such as Stack v. Dowden and Jones v. Kernet, which emphasize looking at the parties' whole course of conduct to infer or impute intention as to shares, while starting with the presumption that equity follows the law where property is in joint names. Essential characteristics of easements. An easement is a proprietary right enjoyed by one piece of land over another. It benefits a dominant tenement and burdens a servient tenement. The classic statement of essential characteristics comes from re Ellenborough Park. There must be a dominant and a servient tenement. The easement must accommodate the dominant tenement, meaning it makes the dominant land more useful or enjoyable. The dominant and servient tenements must be owned or occupied by different persons at the time of creation. The right must be capable of forming the subject matter of a grant, meaning it is sufficiently definite, not too vague, and does not amount to giving the dominant owner exclusive possession of the servient land. Examples include rights of way, rights to light, rights to lay pipes, and rights of support. Whether a claimed right is an easement often turns on whether it is too extensive, too vague, or inconsistent with servient ownership. Methods for creation of easements. Easements can be created expressly or impliedly, and they can be legal or equitable. An express legal easement is usually created by deed. In registered land, it may also need registration to take effect at law, depending on the disposition rules. Implied easements arise through several doctrines. Easements of necessity are implied where without them the land cannot be used at all, such as a landlocked plot requiring access. Easements may be implied by common intention, where the parties clearly intended the land to be used in a particular way that requires the easement, such as a commercial lease requiring ventilation equipment. Wheeldon by boroughs implies certain quasi-easements on a sale, where the right was used by the owner over one part of the land for the benefit of another part, and on division it is continuous and apparent and necessary for the reasonable enjoyment of the part sold. Section 62 of the Law of Property Act 1925 can convert certain permissions, privileges or licenses into legal easements on conveyance, sometimes unexpectedly, which is why conveyancers draft carefully to exclude its effect when needed. Prescription is another route, where long use as of right over time can mature into an easement, subject to complex rules. For SQE, you usually need to recognize the concept and the requirement of long use without force, without secrecy, and without permission.
Rules for the passing of the benefit and burden of freehold covenants. Freehold covenants regulate land use between neighbours. They can be positive, requiring action, or restrictive, prohibiting action. The benefit of a covenant can pass to successors if certain conditions are met. Statutory mechanisms, particularly Section 78 of the Law of Property Act 1925, can operate to annex the benefit to the land so it passes automatically, provided the covenant touches and concerns the land and the parties intended it to run. The burden is harder. The common law rule, illustrated by cases such as Osterbury v. Oldham, is that the burden of a covenant does not run with freehold land. That rule is reaffirmed in Roan v. Stevens. Equity, however, allows the burden of restrictive covenants to run under the doctrine from Tulk v. Moxey. The conditions are that the covenant must be negative in substance, it must benefit the covenantee's land, and the successor to the burdened land must take with notice of the covenant. In registered land, notice is typically satisfied and formalized by entry on the charges register. In unregistered land, protection historically depended on notice and, for registrable covenants, on land charges registration. Positive covenants generally do not bind successors directly, but there are indirect techniques, such as chains of indemnity covenants or the doctrine of mutual benefit and burden, sometimes associated with Halsall v. Brazell, where a person cannot take a benefit under a deed while rejecting a corresponding burden, though this doctrine is narrow and fact-specific. For modification and discharge, Section 84 of the Law of Property Act 1925 allows the upper tribunal to discharge or modify restrictive covenants in certain circumstances, such as where the covenant is obsolete or impedes reasonable use without substantial benefit. Modern cases like Alexander Devine Children's Cancer Trust v. Housing Solutions show the court's concern with deliberate breach and proportionality. Mortgages, including enforceability of terms, priority of mortgages, lenders' powers and duties and protections. A mortgage is a security interest over land to secure repayment of a debt. In modern registered land, a legal mortgage is typically created by a charge rather than by transferring the title. Creation depends on formalities. A legal mortgage requires a deed and, in registered land, registration of the charge. If the formalities are not fully satisfied, the mortgage may exist only in equity, which then raises priority issues. Enforceability of terms is shaped by the equitable protection of the mortgagor's right to redeem. The mortgagor's equity of redemption means that once the debt is repaid, the mortgagor must be able to recover the property free of the mortgage. Clauses that prevent redemption, postpone it unreasonably, or impose oppressive conditions can be struck down as clogs on the equity of redemption. Authorities like Fairclough v. Swan Brewery illustrate the court's hostility to provisions that effectively make redemption illusory. Priority in registered land is heavily governed by the Land Registration Act 2002. The basic rule is that interests rank in the order they are protected and completed, and a registrable disposition for value generally takes subject only to interests that are protected on the register or overriding. A registered charge will usually have strong priority because it is visible and formally protected. Competing charges typically rank by the order of registration, though there are rules about postponement agreements and, in some contexts, tacking and further advances. Lenders' powers include the power of sale, the right to possession, foreclosure, and appointment of a receiver. The power of sale is rooted in the Law of Property Act 1925, notably Sections 101 and 103. Section 101 confers the power when the mortgage is made by deed, and Section 103 sets conditions for when it becomes exercisable, such as default continuing for a specified period. In practice, mortgage deeds often contractually extend or vary these powers, but statutory foundations are a common exam focus. When exercising the power of sale, the mortgagee owes duties. A central case is Cuckmere Brick versus Mutual Finance, which establishes that the mortgagee must act in good faith and take reasonable care to obtain the true market value at the time of sale. The mortgagee is not a trustee for the mortgagor, but cannot sacrifice the mortgagor's interests by selling at an undervalue through careless marketing. The right of possession is famously strong. In Formaids versus Dudley Marshall, the court stated that the mortgagee can take possession before the ink is dry, meaning possession is available once the mortgage is created unless the contract says otherwise. In practice, residential possession is constrained by statute and regulation, but the doctrinal rule is important. Protection of mortgagors include statutory interventions such as Section 36 of the Administration of Justice Act 1970, allowing the court to adjourn or suspend possession proceedings if the mortgagor can pay within a reasonable period. Cheltenham and Gloucester versus Norgan guides that reasonable period may be the remaining mortgage term depending on circumstances. Protection of third parties is critical, especially co-owners with beneficial interests. If a spouse or partner has a beneficial interest and actual occupation, that interest may override and bind a lender, as in Bolland. Lenders respond through overreaching and through obtaining consent. Undue influence is also central in mortgage contexts, where one partner pressures another into guaranteeing or charging the home for the other's debts. The lender may be fixed with constructive notice and required to take steps to ensure informed consent. Authorities like Royal Bank of Scotland versus Ettridge No. 2 set out the steps lenders should take, including ensuring independent legal advice. For SQE, you do not need every detail, but you must spot the risk, a non-commercial surety transaction, relationship of trust and confidence, and the lender's duty to take reasonable steps.
Relationship between landlord and tenant in a lease. A lease is both a contract and a property right. That dual nature is central. The lease creates contractual obligations between the original landlord and tenant, but it also creates a proprietary estate in land that can bind third parties, such as future owners. The landlord grants exclusive possession for a term, and in return the tenant pays rent and performs covenants, such as repair, user restrictions and payment of service charges. The landlord's key obligations may include quiet enjoyment, meaning the tenant's possession should not be substantially interfered with, and non-derogation from grant, meaning the landlord should not take back with one hand what it granted with the other. Essential characteristics of a lease, including the difference between a lease and a license. The leading case is Street v. Mountford. The core characteristics are exclusive possession for a term, usually at a rent, though rent is not strictly essential. Exclusive possession means the tenant can exclude the world, including the landlord, except to the extent entry rights are reserved. If the occupier lacks exclusive possession, it is usually a license, not a lease. A term means a certain duration. It can be fixed, like 5 years, or periodic, like monthly, provided it is sufficiently certain in law. A license is a personal permission to occupy. It does not create a proprietary estate, so it generally does not bind purchases in the same way. Courts look to substance, not labels. A document calling itself a license can still be a lease if the reality is exclusive possession for a term. Equally, courts can disregard sham clauses inserted to pretend the landlord retains control when it does not. Also note the concept of a Bruton tenancy from Bruton v. London and Quadrant, where a tenancy-like relationship can exist even if the landlord lacks a full proprietary estate, showing again that land law often reflects function and policy, not just formal labels. Privity of contract and privity of estate. Privity of contract refers to the original contractual relationship between the original landlord and the original tenant. Historically, that meant that even after assignment, the original tenant might remain liable on covenants because they promised in contract. Privity of estate refers to the relationship between whoever currently holds the lease and whoever currently holds the reversion. It creates mutual enforceability of covenants that touch and concern the land. Modern law has been significantly reshaped for new leases by the Landlord and Tenant Covenants Act 1995. For post-1996 leases, assignment generally releases the outgoing tenant from future liability, reflecting a policy of fairness and commercial reality, while still allowing authorized guarantee agreements in some circumstances. In SQE problems, the examiner may test whether a covenant can be enforced against an assignee, whether the original tenant remains liable, and whether the covenant is the sort that runs with the land.
Rules for the passing of the benefit and burden of leasehold covenants and enforceability. Leasehold covenants can run with the land through privity of estate, provided they touch and concern the land. A repairing covenant, a user covenant, or a rent covenant typically does. Statutory provisions in the Law of Property Act 1925, such as Sections 141 and 142, assist in transferring the benefit and burden of certain covenants on assignment of the reversion. But you must always check the date of the lease, because the Landlord and Tenant Covenants Act 1995 changes the framework for post-1996 leases, especially around release and continuing liability. The practical solicitor question is always who is the right defendant and who has the right to sue. Is it the original party in contract, the current landlord or tenant in estate, or both? That is where you pick up marks. Purpose and effect of an alienation covenant. Alienation covenants restrict the tenant's ability to assign, underlet, charge, or part with possession. Landlords use them to control who occupies the property and how it is used. Alienation covenants can take different forms. They might be absolute prohibitions, qualified covenants requiring consent, or fully permissive provisions. Where consent is required, landlord and tenant legislation can impose standards of reasonableness. In many commercial settings, landlords cannot unreasonably withhold consent, and they may have duties to respond within a reasonable time. The precise statutory route depends on the covenant wording and context, but for SQE, you should recognize the policy: tenants should not be trapped, and landlords should not be forced to accept unsuitable assignees. The effect of an alienation covenant is often tested through a breach scenario. The tenant assigns without consent or underlets in breach, and the landlord seeks remedies. Remedies for breach of leasehold covenants, including forfeiture. Remedies depend on the covenant and the breach. Landlords may seek damages, injunctions, specific performance for certain obligations, and importantly, forfeiture. Forfeiture is the landlord's right to bring the lease to an end for breach if the lease contains a forfeiture clause. For most breaches other than non-payment of rent, Section 146 of the Law of Property Act 1925 requires the landlord to serve a notice specifying the breach, requiring remedy if it can be remedied, and requiring compensation if appropriate before forfeiture can be enforced. Relief against forfeiture is an equitable remedy that can restore the lease if the tenant remedies the breach, or if it would be unjust to end the lease. Courts are often willing to grant relief, especially for breaches that are capable of remedy and where forfeiture would be disproportionate. For non-payment of rent, landlords may be able to forfeit without a Section 146 notice, depending on the lease and the statutory context, though modern residential law adds layers of protection. Tenants also have remedies against landlords for breach, such as damages for disrepair, injunctions, and in some contexts, rent suspension. Different ways a lease can be terminated. Leases end in several legally distinct ways. A fixed-term lease ends by a fluxion of time when the term expires, unless continued by statute or agreement. A periodic tenancy can be terminated by valid notice to quit, which must usually align with the period of the tenancy and comply with any statutory requirements. A lease can end by surrender, which is a mutual agreement to give up the lease. Surrender can be express, typically by deed, or implied by conduct that is unequivocally inconsistent with continuation, such as the tenant handing back the keys and the landlord taking possession and reletting. A lease can end by forfeiture following breach, subject to the legal and equitable controls we discussed. A lease can end by merger if the same person becomes both landlord and tenant in the same right, so the leasehold estate and freehold estate combine. A lease can also end by operation of a break clause if the clause is properly exercised in accordance with its conditions, which often include strict notice requirements and sometimes conditions such as payment of rent up to date. In answer exams, the mark-winning technique is to name the termination method and then apply its conditions to the facts carefully, especially around notices and Section 146. Putting the whole specification together. To finish, link the system back to the SQE mindset. When you are told land is registered, the default is that rights should be protected on the register and priority is controlled by the Land Registration Act 2002 with limited overriding interests. When you are told land is unregistered, you think deeds, land charges registration, and the doctrine of notice. When you are told there are co-owners, you think trust of land, legal joint tenancy, beneficial ownership in joint tenancy or tenancy in common, survivorship, severance, and tollata disputes. When you are told there is a neighbour dispute, you think easements and covenants, their creation, and whether they bind successors. When you are told there is a borrowing secured on the home, you think mortgage creation, priority, possession and sale, duties to obtain proper value, statutory protection for mortgagors, and the vulnerability issues around undue influence and actual occupation. When you are told there is a lease, you think lease versus license, formalities, registration if over 7 years, privity of contract and estate, how covenants run, alienation restrictions, remedies including forfeiture, and termination routes. And throughout, you keep your professional head. You act in the best interests of the client, but you do not cut corners, mislead, or ignore risks that can harm third parties or undermine trust in legal services. The SRA principles are not a separate ethics chapter. They are the baseline operating system for land transactions. Thank you for watching, and have a look around Dr. Yannis' channel for more.
Are you a wine drinker? Even if you aren't, you could still be an investor in wine. Yes, bottles of wine are assets that can be very expensive. Imagine, however, how you would feel if you had a certificate of ownership, you paid for storage and insurance, and you still discovered in insolvency that your Bordeaux is legally just part of someone else's pile. In London Wine, customers paid for specific quantities of wine and received certificates. The wine sat in the company's warehouse, insured and stored, and everyone behaved as if the customers owned it. Then the company went insolvent. The shock: because the bottles were never segregated or identified, the customers could not establish a trust over their wine, so they were left competing with unsecured creditors. Welcome to this lecture on English Trusts Law for SQE FLK2. The aim is practical. You are learning the rules, but you are also learning how to apply them as a newly qualified solicitor would. That means you read a fact pattern, you identify the trust or equitable relationship, you test validity, you work out beneficial entitlement, you assess duties and breaches, you consider third-party liability, and you finish with remedies. It also means you keep one eye on professional conduct. Even though the SQE Trusts Syllabus is doctrinal, the assessment objectives remind you that you must act honestly and with integrity, and in accordance with the SRA's standards and regulations, including the SRA's principles and the Code of Conduct. In a trusts scenario, that typically shows up in conflicts of interest, handling client money, disclosure duties, and the temptation to smooth over defects in formalities. Equity is obsessed with conscience, so are professional standards. A second framing point matters. Questions can combine topics. You might be asked about an imperfect transfer of shares into trust, a fiduciary who secretly profits, a family home dispute after a relationship breakdown, and a claimant trying to trace funds into property bought in someone else's name. The skill is to treat this as one joined-up problem. With that in mind, we will cover the SRA's specification for FLK Trusts Law in a structured way, helping you prepare for your exam in the best way possible.
Express trusts and implied trusts, the big picture. An express trust is intentionally created. A settlor decides that property should be held by a trustee for beneficiaries or for a charitable purpose. The defining idea is that the trustee holds legal title, but the beneficiaries hold equitable title, and equity will enforce that split. Implied trusts, in modern teaching language, are usually trusts that arise by operation of law rather than by a deliberate declaration. That category includes resulting trusts and constructive trusts. The word implied can be slippery because older materials sometimes use it to mean expressed inferred trust as well.
For SQE purposes, the safe approach is this. When the facts show a deliberate intention to create a trust, treat it as express. When the facts show equity stepping in because of contributions, failure of purpose, wrongdoing, or unconscionability, you are usually in resulting trust or constructive trust territory. Now we turn to the creation and requirements of express trusts, beginning with the foundation stone.
Creation and requirements of express private trusts, the three certainties. To create a valid express private trust, equity requires the three certainties, traditionally linked to Knight v. Knight. The trust must show certainty of intention, certainty of subject matter, and certainty of objects. Certainty of intention asks whether the settler meant to impose a binding obligation rather than make a request, express a hope, or offer a moral wish. Courts use an objective approach. What would a reasonable person understand from the words and context? In Re Adams and the Kensington Vestry, language that the wife was left property in full confidence that she would do the right thing for children was treated as non-binding. It was moral, not legal. By contrast, intention can be found without technical language. In Paul v. Constance, repeated statements that money in an account was as much yours as mine, combined with conduct, was enough to show intention to share beneficially. Intention also has a negative side. Equity will not let you relabel a failed gift as a trust just because the donor wishes it. Jones v. Locke is the classic warning. A father tried to give a cheque to a baby, and the court refused to treat it as a trust. The case is often explained as a policy point. The court will not rescue a defective gift by inventing an intention to declare a trust. Certainty of subject matter asks what property is held on trust and what are the shares or interests. If you cannot identify the trust property, you cannot administer the trust. If you cannot identify each beneficiary's share in a fixed trust, you cannot distribute. Uncertainty about the property can invalidate the trust. In Palmer v. Simmons, the bulk of my estate was too vague. In Re London Wine, purported trusts over unsegregated bottles of wine failed because you could not identify which bottles were trust property. The practical point is segregation. When property is part of a larger bulk, you often need it set aside. However, equity's approach differs depending on the asset. Shares of the same class are often treated as fungible. In Hunter v. Moss, a trust of a fixed number of shares out of a larger holding was upheld even without segregation. The reasoning is controversial, and you should not overgeneralize it, but for SQE-style questions, the exam often expects you to recognize the share fungibility logic and contrast it with Re London Wine. Certainty of objects is about identifying who can benefit. In a fixed trust, the complete list test applies. You must be able to draw up a complete list of beneficiaries. The traditional authority is IRC v. Broadway Cottages. In a discretionary trust, the test is more flexible. In MacPhail v. Dalton, the House of Lords accepted that a discretionary trust is valid if you can say of any given person whether they are on or aren't within the class, sometimes called the is or is not test, associated with Re-Gelbenkian settlements and developed in MacPhail. You also need to handle two additional validity controls that often appear in problem questions. One is conceptual uncertainty. If the concept defining the class is unclear, the trust fails. Words like friends can be dangerously vague. Another is administrative unworkability. Even if conceptually clear, a class can be so wide that trustees cannot sensibly perform the duty. The classic illustration is a trust for all the residents of Greater London. Courts have flagged this issue, and you often see it discussed alongside Re Manastis settlement, where capriciousness is also mentioned. The exam skill is to recognise when the class definition is so broad that administration collapses. With those foundations, we can now separate fixed interest trusts from discretionary trusts, because the rules and the litigation issues differ.
Fixed interest trusts. A fixed interest trust is one where the beneficial shares are fixed by the trust instrument. The trustees have no discretion about who gets what. Their job is to hold, manage, and distribute as directed. Fixed trusts are attractive because they are predictable. They can also be brittle. If the shares are uncertain, the trust fails. This is where you see cases about uncertainty of beneficial shares, and why subject matter is not only about what property, but also who gets what.
When advising in practice, fixed trusts often raise questions about vesting. A gift may be vested in interest, but not vested in possession. For example, to A for life, remainder to B, gives B a vested remainder from the start, even though B only possesses later. That matters for death, bankruptcy, and the ability to collapse the trust. A fixed trust also interacts strongly with the rule in Saunders v. Vautier. If all beneficiaries are adult, have capacity, and are absolutely entitled, they can demand the trust property and end the trust early. We will return to that rule under beneficial entitlement. Discretionary trusts. A discretionary trust gives trustees a discretion about who benefits and in what amounts within a defined class. The beneficiaries do not have fixed shares until trustees exercise their discretion. Instead, beneficiaries have a right to be considered and a right to enforce proper exercise of discretion. The validity test for objects is therefore less strict than in fixed trusts. The is or is not test from MacPhail v. Dalton reflects a practical reality. Trustees do not need a complete list to exercise discretion, but they must be able to decide whether a claimant is within the class. In problem questions, discretionary trusts frequently raise a different kind of dispute. A disappointed potential beneficiary challenges the trustee's decision as procedurally flawed. The court will not normally substitute its own discretion, but it can intervene if trustees act in bad faith, fail to consider relevant matters, consider irrelevant matters, or act outside of the scope of the trust. This is where equity's control of fiduciaries blends into trust administration. Trustees must exercise discretionary powers for proper purposes and with attention to the trust's aims. In a solicitor-style answer, you make that explicit. The discretion is wide, but not unlimited.
Formalities to create express inter vivos trusts. Formalities ask whether a particular form must be used for the trust to be valid or enforceable. For inter vivos trusts, you look first at the nature of the property. For land, Section 53(1)b of the Law of Property Act 1925 requires that a declaration of trust of land must be manifested and proved by some writing signed by the person able to declare it. This is an evidential requirement, not necessarily a validity requirement. In other words, an oral declaration may create a trust, but without signed written evidence, you cannot enforce it in court. That distinction matters in exam questions because it allows equity to say, in effect, the trust exists, but you cannot prove it in the required way. There is also an equitable safety valve. Equity will not allow a statute to be used as an instrument of fraud. Rochefoucauld versus Bousted is often cited for the idea that if someone obtains title on the understanding they will hold on trust, they cannot later rely on lack of writing to deny the trust. The reasoning is sometimes criticized, but for SQE you should recognize the principle and apply it carefully. For other property, formalities depend on the transaction, not on trusts law alone. Shares require proper transfer mechanisms, often involving stock transfer forms and registration. Shows in action may require written assignment under Section 136 of the Law of Property Act 1925 for a legal assignment, but equitable assignment can exist with less formality. The SQE question will usually tell you what steps were taken, and you match those steps to the relevant property type.
Constitution is different from formalities. Formalities ask whether the trust is in the right form. Constitution asks whether the trust property has actually been transferred or otherwise vested so that the trust is fully effective. If the settlor declares themselves trustee, the trust can be constituted without any transfer because legal title is already with the settlor. But if the trust requires transfer to third-party trustees or is structured as an outright gift to trustees on trust, then the transfer must be completed. The classic principle is from Milroy versus Lord. Equity will not perfect an imperfect gift. If the donor has not done what is necessary to transfer property, equity will not step in to complete it, because equity will not assist a volunteer. The intended beneficiary who gave no consideration cannot force completion. This is a harsh rule, so you need the recognized exceptions and edge cases.
One is the rule in re rose. If the donor has done everything in their power to transfer the property, then equity may treat the transfer as effective in equity, even if some administrative step remains, such as registration by a company. The logic is that it would be unconscionable for the donor to retract once they have put the transfer beyond their own control. Another is Strong versus Bird. If the donor intends to make an immediate gift and that intention continues, and the intended donee becomes the donor's executor, the gift can be perfected on death because the legal title vests in the donee as executor. The rule has been extended beyond its original narrow setting, and you should look for it in wills-style fact patterns where a donor promised a gift, then appointed the person as executor. Another is Donatio Mortis Causa, a deathbed gift. The donor must contemplate imminent death, make the gift conditional on death, and deliver dominion over the subject matter. Sen versus Headley is a leading modern case, including the idea that handing over keys to a box containing title deeds can sometimes amount to sufficient dominion. Deathbed gifts are exceptional and fact-sensitive. In SQE questions, the examiners often signal it by explicitly describing imminent death and conditional language. Then there is the controversial line of authority associated with Pennington versus Wayne, where the Court of Appeal focused on unconscionability. It treated an imperfect transfer of shares as effectively complete in equity because it was unconscionable for the donor to retract. The difficulty is that unconscionable can become vague. In exam answers, you acknowledge Pennington, but you also explain that it sits uneasily with Milroy versus Lord and Re Rose, and that courts have been cautious about expanding it. You should also be alive to Choithram versus Pagarani, where the Privy Council upheld a gift to a foundation when the donor was one of the trustees. The reasoning is sometimes explained as treating the donor as having declared himself a trustee of the property for the charitable foundation, even though the transfer mechanics were incomplete. Again, it illustrates equity's willingness to construe words to save a trust where possible, particularly in charity contexts, but without openly abandoning Milroy versus Lord. In a solicitor-style analysis, you do not merely recite cases, you classify the situation. If it's a self-declaration, constitution is not the problem. If it's a transfer to trustees, you check if transfer was completed. If not, you ask whether Re Rose applies, whether Strong versus Bird applies, whether a deathbed gift is plausible, and whether any unconscionability argument is likely.
Beneficial entitlement, fixed, discretionary, vested and contingent interests. Beneficial entitlement describes what the beneficiary owns in equity. Trusts law uses language that sounds technical, but the idea is intuitive. You ask, does the beneficiary have a defined share, or only a chance of benefiting? Has the interest vested, or is it still conditional? A fixed interest is straightforward. The trust instrument specifies the entitlement. If A is entitled to the income for life, A has a life interest. If B is entitled to the capital at age 25, B has an interest that may be contingent until the age condition is satisfied, depending on drafting. A discretionary interest is not a fixed share. A member of a discretionary class has a right to be considered and a right to challenge improper exercise, but not a right to demand distribution. This distinction matters when you advise on bankruptcy, divorce, creditor claims, and whether an interest can be assigned. Vested and contingent language can be confusing, so anchor it to enforceability. A vested interest is one that belongs to the beneficiary now, even if enjoyment is postponed. A contingent interest depends on a condition precedent. For example, to B if B marries is contingent until marriage happens. To B at 25 is often treated as contingent until 25, though some drafting can create a vested interest subject to divestment instead. In exam questions, the simplest approach is to treat age conditions as contingent unless the question gives you reasons to interpret differently. These distinctions connect directly to Saunders and Vautier, because only beneficiaries who are absolutely entitled can collapse the trust.
The rule in Saunders v. Vautier. Saunders v. Vautier established that if a beneficiary is of full age, has mental capacity, and is absolutely entitled to the trust property, they can demand that the trustees transfer it to them, ending the trust. The trustees cannot insist on continuing to administer merely because the settler wanted the property held until a later time. The most important practical extension is that if there are multiple beneficiaries, they can collectively do the same thing if they are all adult, have capacity, and together are absolutely entitled to the whole beneficial interest. If even one beneficiary is a minor, lacks capacity, or holds a contingent interest that has not yet vested, the rule will not allow collapse. This rule matters in client advice. A settler might think they can lock up assets until a child is 30, but if the drafting gives the child an absolute vested interest at 18, with only postponed enjoyment, the child may be able to force distribution. Conversely, careful drafting using contingent interests or discretionary structures can prevent early collapse. In exam answers, you state the rule, then you apply it to the facts by testing age, capacity, and whether the interest is absolute. If the trust is discretionary, Saunders v. Vautier usually does not apply because no one is absolutely entitled until trustees exercise the discretion.
The distinction between charitable trusts and non-charitable purpose trusts. This topic turns on a core principle of private trusts, the beneficiary principle. Morris v. Bishop of Durham is the classic statement: there must be identifiable beneficiaries who can enforce the trust. If a trust is for a purpose rather than for persons, it usually fails because no one has standing to enforce. Charitable trusts are the major exception. A charitable trust is a purpose trust, but it is valid because it serves purposes recognized as charitable and provides public benefit, and it is enforceable through public mechanisms, traditionally involving the Attorney General and, in modern administration, the Charity Commission. The Charities Act 2011 is the main statutory framework, describing recognized heads of charity and emphasizing public benefit. Non-charitable purpose trusts, meaning private purpose trusts, are generally void. Re Astor's settlement trusts is a well-known example, where vague purposes like promoting international understanding were held invalid. Re Endicott is another important authority, emphasizing that purpose trusts, outside narrow exceptions, are not allowed. There are, however, anomalous exceptions, often described as trusts of imperfect obligation. They include trusts for the maintenance of specific animals, often associated with Re Dean, and trusts for maintenance of graves in monuments in certain conditions. These exceptions are narrow, fact-specific, and constrained by perpetuity concerns. A more modern and exam-friendly way to handle borderline cases is through Re Endley's trust deed. The trust there was framed as a purpose, a recreation ground, but it directly benefited identifiable people, employees, who could enforce it. Many commentators treat Re Endley as not truly a purpose trust at all, but a trust for persons with a purpose attached. For SQE purposes, that is the key insight. If identifiable individuals benefit and can enforce, the trust may survive even if the drafting sounds purposive. So the distinction you should articulate is this. Charitable trusts are enforceable purpose trusts because of public benefit and public enforcement. Non-charitable purpose trusts are generally void because of the beneficiary principle, unless they fit into very narrow exceptions or are recharacterized as trusts for persons. Resulting trusts arise when the law concludes that the recipient should not take beneficially, so the beneficial interest results back to the transferor or the transferor's estate. The two main categories are presumed resulting trusts and automatic resulting trusts. A presumed resulting trust often arises where A transfers property to B gratuitously, or contributes to the purchase price of property put in B's name, and the law presumes A did not intend to make a gift. Dyer v. Dyer is a classic purchase money resulting trust authority. The presumption is evidential, meaning it can be rebutted by evidence that A intended a gift or loan. A major counter-presumption is the presumption of advancement. Historically, certain relationships, such as parent to child, could presume a gift rather than a trust. Modern law has heavily questioned and narrowed that presumption, and in many contexts, courts prefer to look at actual intention and the whole relationship, particularly in family home disputes, where Stack v. Dowden and Jones v. Kernot shape analysis.
An automatic resulting trust arises when an express trust fails in whole or in part. The settlor did intend a trust, but the trust does not effectively dispose of the beneficial interest. For example, if a trust is declared for a non-charitable purpose and is void, the property may return to the settlor on resulting trust. Similarly, if a trust is declared for life, but does not dispose of the remainder can result back. The theoretical explanation has been debated. In Westdeutsche Landesbank v. Islington LBC, the House of Lords discussed resulting trusts in the context of mistaken payments and a need for a sufficient equitable interest. Lord Brown-Wilkinson emphasized conscience and knowledge. Later, in Air Jamaica v. Charlton, Lord Millett described resulting trusts as arising because the recipient is not intended to benefit, emphasizing the absence of intention to benefit rather than any retained beneficial interest. For SQE, you do not need to master the jurisprudential debate, but you should be able to explain that resulting trusts often reflect the law's inference that beneficial entitlement has not passed. One special and frequently examined resulting trust type is the Quist-Close Trust from Barclays Bank v. Quist-Close Investments. Money is advanced for a specific purpose, such as paying creditors. If the purpose fails, the money is held on resulting trust for the lender. The issue is usually whether the money was meant to be at the free disposal of the borrower, which would create a debtor-creditor relationship, or whether it was segregated and purpose-limited, which supports a trust analysis. When advising, always ask, was there an intention to benefit the recipient? Was the transfer gratuitous? Was there a purpose that failed? Was the money segregated? Those factual levers typically decide the resulting trust outcome.
Trusts of the family home. Family home trusts are where trust's law meets real life. The dispute is usually between cohabitees or spouses after a relationship breakdown. One person may hold legal title, but the other claims a beneficial share. The modern framework is dominated by constructive trust analysis based on common intention and, in many cases, supplemented by proprietary estoppel principles. You must start with legal title. Is the legal title in joint names or in one name only? That choice changes presumptions and the path of reasoning. When legal title is in joint names, the starting presumption is that equity follows the law, meaning the beneficial interest is also joint. Stack v. Dowden established that the presumption can be rebutted if the party's whole course of conduct shows a different common intention. Jones v. Kernot developed the approach further, accepting that courts may infer or in some cases impute an intention to shares where it is clear the parties intended to share but unclear what the shares were. In practice, for joint legal title, you look at factors like contributions to purchase price, mortgage payments, arrangements for finances, children, and how the parties understood ownership. The modern approach resists a purely arithmetic analysis. It is contextual. When legal title is in one name only, the claimant must usually establish a common intention constructive trust by showing two things. First, that there was a common intention that the claimant should have a beneficial interest. Second, that the claimant acted to their detriment in reliance on that intention. This structure is strongly associated with Lloyds Bank v. Rossett, where Lord Bridge suggested that common intention can be shown either by an express agreement, arrangement, or understanding, or, in the absence of express discussion, by direct contributions to the purchase price. Rossett has been heavily criticised as too narrow, and later cases have softened it. But for SQE purposes, Rossett remains an anchor authority. You should recognise both routes and then apply later contextual reasoning where appropriate, especially when the facts show sustained financial integration beyond simple deposit payments.
Legal title in the name of both parties and in the name of a sole party. Joint legal title cases often begin with the presumption of equal beneficial shares, then move to rebuttal. Stack v. Dowden is the key authority, and it emphasises that the presumption is strong but not irrebuttable. Jones v. Kernot then shows how courts deal with changing intentions over time, including separation and divergent contributions. Sole legal title cases often begin with no presumption of shared beneficial ownership. The claimant must establish it. Cases like Grant v. Edwards and Eves v. Eves are classic illustrations of courts inferring common intention from conversations and conduct and then finding detriment through contributions and labour. The solicitor's task in these cases is evidence. What was said, when and in what terms? What was paid, by whom and from what source? Was there reliance and did it cause detriment? In exams, you narrate those questions and you answer them using the facts you are given. Express declaration or agreement as to equitable ownership. An express declaration of trust is a powerful piece of evidence. Where the parties execute a written declaration stating the beneficial shares, the courts generally treat that as conclusive, subject to limited exceptions like fraud, mistake, or undue influence. This is why conveyances take declarations of trust seriously, and why SQE scenarios sometimes include a TR1 form or similar document. If there is an express oral agreement but no formal declaration, the position is more complex. For sole name cases, an express agreement can establish common intention, but you still need detrimental reliance. The agreement must be sufficiently clear to infer that the claimant was meant to have an interest, not merely that the parties would share everything in a vague way. In exam answers, you quote or paraphrase the words, and you show how they meet or fail the common intention threshold.
Direct and indirect contributions. Direct contributions are the traditional Rosset route. These include paying the deposit, paying mortgage instalments, or paying significant sums directly linked to acquisition. Courts treat these as strong evidence of an intention to share beneficially. Indirect contributions are more contested. Paying household bills can free up the legal owner's income to pay the mortgage. Doing extensive renovations can increase value. Caring responsibilities can also affect financial arrangements. Modern case law shows greater willingness to view the relationship holistically, especially in joint name cases, and to recognize that families organize finances in diverse ways. However, you must be disciplined in how you apply this in an SQE answer. In sole legal title cases, if the claimant has only paid general household expenses with no clear link to acquisition, Rosset suggests difficulty. If the claimant has evidence of an express understanding, or if the expenditure is substantial and clearly connected to enabling acquisition or improvement, you can argue that the intention and detriment requirements are satisfied. If the claimant's contribution is mainly non-financial domestic labour, you should treat it as supporting evidence of reliance and detriment, but be cautious about presenting it as automatically sufficient without more, because courts vary and the exam expects measured reasoning. If the exam wants you to emphasise modern flexibility, you can reference that. Stack v. Dowden and Jones v. Kernot illustrate a broader evaluative approach, even though the strict Rosset language lingers. The safest exam posture is direct contributions are strongest. Indirect contributions can support a claim, especially with other evidence, but are more fact-sensitive. You must also be up to date with Hudson v. Hathaway 2022. This case clarified two vital points for practice. First, even in joint names cases where parties are arguing about changing their beneficial shares, the claimant must show detrimental reliance on the common intention. It is a core requirement of the constructive trust. Second, in our digital age, an email chain can sometimes amount to a signed disposition of an equitable interest. Typing your name at the bottom of an email can satisfy the statutory signature requirement, meaning parties might inadvertently settle their shares by email.
Requirements to establish proprietary estoppel. Proprietary estoppel is often described as equity's response to unconscionability, where one person has been led to believe they will have rights in property, acts to their detriment, and it would be unjust to deny them. The classic formulation uses three elements: an assurance, reliance, and detriment, with unconscionability as an overall control. Cases like Gillett v. Holt and Thorner v. Major show that the assurance can be implied from conduct and need not be a formal promise. It must, however, be sufficiently clear in context.
Cobb v. Yeoman's Row highlights that in commercial negotiations, proprietary estoppel is harder to establish if parties know they have not reached a binding agreement and still proceed. Detriment is interpreted broadly. It can include expenditure, labour, giving up opportunities, caring work, or otherwise changing one's position. The key is that it must be something substantial enough that it would be unjust to deny relief. Remedy in proprietary estoppel is flexible. The court aims to satisfy the equity, not necessarily to give the claimant everything promised. Jennings v. Rice is often used to show proportionality. In modern Supreme Court authority, like Guest v. Guest, the court again emphasized that remedies can range from transfer of property to monetary awards or life interests, depending on what is necessary to avoid unconscionable harm. In family home problems, proprietary estoppel can be pleaded alongside constructive trust. As a solicitor, you often plead both routes, and for SQE analysis, you explain both routes and conclude which is stronger on the facts. Liability of strangers to the trust. Establishing recipient liability. Trusts law is not only about trustees. A third party may receive trust property transferred in breach of trust. Equity may impose liability on that recipient. This is commonly called knowing receipt, and it is traditionally traced back to Barnes v. Addy. To establish recipient liability, you typically need a disposal of trust property in breach of trust, beneficial receipt by the defendant, and knowledge making it unconscionable for the defendant to retain the benefit. The language of unconscionability is prominent in BCCI v. Akindele, which sought to simplify earlier debates about 5 levels of knowledge. Older cases, like Re Montague's settlement, show a stricter approach, where mere notice of the trust may not be enough if the recipient did not appreciate the breach. The overall direction of travel is that equity asks whether, given what the recipient knew, it would be unconscionable to keep the property. The remedy can be proprietary or personal. If the recipient still holds the property, the claimant may seek a proprietary remedy to recover it, subject to defences like bona fide purchaser for value without notice. If the property has been dissipated or cannot be recovered, the claimant may seek a personal remedy, requiring the recipient to account for value. In exam answers, be careful with the bona fide purchaser defence. A purchaser for value without notice takes free of equitable interests, but this defence is not available to volunteers. This links back to the maxim that equity will not assist a volunteer. Equity is harsher to gratuitous recipients.
Liability of strangers to the trust. Establishing accessory liability. Accessory liability is also associated with Barnes v. Addy, traditionally known as knowing assistance. Here, the third party does not necessarily receive trust property. Instead, they assist in a breach of trust. The modern leading authority is Royal Brunei Airlines v. Tan, where the Privy Council emphasised dishonesty. A person is liable if they dishonestly assist a breach of trust. The focus is on the assistant's dishonesty, not on whether the trustee was dishonest. This is important because trustees can breach trust innocently through negligence, while a third party can still be dishonest in helping. Dishonesty has been refined through later cases. Twin Sectra v. Yardley discussed combined subjective and objective elements and created confusion. Later decisions, including Barlow Close v. Eurotrust and the modern criminal and civil dishonesty approach associated with Ivy v. Genting, have pushed towards an objective assessment based on the defendant's knowledge of facts and the standards of ordinary decent people. Following recent case law, the confusion of Twin Sectra is gone. Following Group 7 v. Nasir, the test mirrors Ivy v. Genting. You ascertain the defendant's actual state of knowledge, subjective, and then apply an objective standard. Would an ordinary decent person consider that conduct dishonest given what they knew? Dubai Aluminium v. Salam is important because it clarifies that constructive trustee language is sometimes misleading. The third party may be personally liable to account, even if they never became a trustee of property.
You should use precise language. Accessory liability is personal, arising from dishonest assistance, and it leads to an account of loss or profits depending on the claim. In problem questions, accessory liability often involves professionals. Accountants, solicitors, bankers, or advisors may be alleged to have assisted. The exam expects you to identify the relevant mental element and to apply it to what the professional knew and did.
The fiduciary relationship and its obligations. A fiduciary relationship is a relationship of trust and confidence where one party has undertaken to act for another and must act loyally. Trustees are fiduciaries, but fiduciary duties also apply to directors, agents, partners, and solicitors. Fiduciary obligations are not primarily about competence, they are about loyalty. That is why fiduciary duties are strict. A fiduciary must not profit from the position without informed consent. A fiduciary must avoid conflicts of interest. A fiduciary must not place themselves in a position where duty and interest conflict. These duties are often called the no-profit rule and the no-conflict rule. They overlap. They are also prophylactic. They apply even if the fiduciary acted honestly, even if the principal suffered no loss, and even if the fiduciary's conduct benefited the principal. The strictness is illustrated by Boardman v. Phipps. A fiduciary obtained information through their role, pursued an opportunity, and generated profit. Even though the trust benefited, the fiduciary had to account, subject to an allowance for skill and effort. The core message is that fiduciaries cannot unilaterally decide that profit-taking is acceptable. Now we apply these general principles to the specific fiduciary rules identified in the specification. Duty not to profit from a fiduciary position. The no-profit rule means that a fiduciary must account for unauthorized profits made because of the fiduciary position. The profit can be direct, like a commission, or indirect, like a business opportunity. FHR European Ventures v. Cedar Capital Partners is central in modern law. The Supreme Court held that bribes and secret commissions received by an agent are held on constructive trust for the principal. That matters hugely for remedies because a constructive trust enables proprietary claims and tracing. It also matters for insolvency because trust property is separated from the fiduciary's own assets. In exam scenarios, you will often be told that a trustee or advisor received a commission or took a referral fee or accepted a gift. Your analysis is, unless fully informed consent was obtained, this triggers fiduciary liability. The remedy can include an account of profit and sometimes a constructive trust over the profit.
Trustees not to purchase trust property. This is the self-dealing rule. Trustees must not buy trust property, either directly or indirectly, unless expressly authorized or unless fully informed consent is obtained from all beneficiaries who are competent and entitled. The key point is that the transaction is voidable at the instance of the beneficiaries. It can be set aside even if the price was fair. The concern is not only undervalue, it is the conflict of interest. There is also the fair dealing rule, which is related but distinct. It deals with trustees purchasing a beneficiary's interest in the trust, rather than purchasing trust property itself. That can be valid, but only if the trustee can prove full disclosure, absence of pressure, and a fair price. The burden is on the fiduciary. The underlying idea is again loyalty and protection against exploitation. In practice, solicitor advisors must be alert. If a trustee-client proposes to buy a trust asset, the conflict is immediate and independent advice is essential. Fiduciary not to put himself in a position where his interest and duty conflict. This is the no-conflict rule. It is broader than self-dealing. It captures situations where the fiduciary has a personal interest that might influence decisions, even if no profit has yet been made. For trustees, conflicts arise with investments, loans, contracts for services, and decisions about distributions if trustees are also beneficiaries. Many trust instruments authorize certain conflicts, such as allowing a trustee beneficiary to participate, but the trustee must still exercise powers in good faith for proper purposes. The key exam message is strictness.
The court's aim is to prevent temptation. Once conflict exists, the fiduciary must either avoid the transaction or obtain fully informed consent.
Trustees. Who can be a trustee, and appointment, removal, and retirement of trustees. A trustee can be an individual or a trust corporation. Capacity matters. Generally, an adult with mental capacity can be a trustee. Minors cannot act as trustees because trusteeship involves legal title and responsibilities that require capacity. Under S20 LPA 1925, the appointment of a minor as a trustee is void. Trust corporations are often appointed for professional administration. Appointment can be governed by the trust instrument. If the trust instrument is silent or the appointment mechanism fails, statutory powers fill the gap. The Trustees Act 1925 is central, particularly Section 36, for appointment of new trustees in specified events like death, incapacity, or refusal to act. The Court also has power under Section 41 of the Trustees Act 1925 to appoint trustees where it is expedient. Retirement is governed by the trust instrument or by statute. Section 39 of the Trustees Act 1925 allows a trustee to retire if the appropriate deed is executed and usually if there will remain the necessary number of trustees. Removal can occur through the trust instrument, statutory powers, or the court's inherent jurisdiction. The court's guiding principle is the welfare of beneficiaries and the proper administration of the trust. Letterstead v. Browers is commonly cited for that focus. The court does not remove trustees lightly, but it will remove them where conflicts, hostility, incompetence, or misconduct threatens proper administration. A modern practical point is that trusts of land often require at least 2 trustees to allow overreaching on sale, because overreaching under the Law of Property Act 1925 requires payment to at least 2 trustees or a trust corporation. In co-ownership disputes, the Trusts of Land and Appointment of Trustees Act 1996 often frames the litigation, but for FLK law you mainly need to recognize the trustee appointment structure and why trustee numbers matter. Trustees' duty of care. The Trustees Act 2000 modernized and clarified trustee duties, including a statutory duty of care. Section 1 of the Trustees Act 2000 sets the standard. A trustee must exercise such care and skill as is reasonable in the circumstances, having regard to any special knowledge or experience the trustee has or holds themselves out as having, and, if acting professionally, to the standards reasonably expected of a person acting in that professional capacity. That means professional trustees are judged by a higher standard. It also means that a trustee cannot hide behind inexperience if they hold themselves out as competent. The duty of care applies to many trustee functions, including investment, delegation, and management decisions. It does not necessarily apply to every discretionary distribution decision in the same way, but trustees must still act in good faith and for proper purposes in exercising dispositive powers. In exam answers, make the duty of care concrete. Ask what a reasonable trustee would do. Would they take advice? Would they document reasons? Would they review investments periodically? Would they avoid concentration risk? Would they comply with the trust instrument's constraints?
Trustees' duty to invest and powers in relation to investment. Investment is a core trustee function. Modern trusts often exist primarily to hold and invest assets. The Trustees Act 2000 gives trustees a general power of investment subject to any restriction in the trust instrument. Trustees must apply the statutory investment criteria, which include suitability and diversification. Trustees must consider whether a proposed investment is suitable for the trust, and they must consider the need for diversification insofar as appropriate. Trustees must also keep investments under review. Trustees are generally expected to obtain and consider proper advice unless it is unnecessary or inappropriate. The exam will often signal this by describing trustees investing in a friend's business, putting all funds into one speculative asset, or refusing to take advice. Those facts are designed to trigger breach analysis.
You should also be aware of the ethical investment debate. Cowan versus Scargill remains the starting point for private trusts. Maximize financial returns. However, for charitable trusts, the law has evolved. In Butler-Sloss versus Charity Commission 2022, the court clarified that charity trustees can decide to exclude investments that conflict with their charitable purposes. For example, an environmental charity excluding fossil fuel stocks, even if that risks a lower financial return. They must balance the financial loss against the reputational damage and conflict with their mission.
Trustees' statutory powers of maintenance and advancement. Trustees often manage trusts for children or young adults. Statutory powers address how trustees can use income or capital for the beneficiary before the beneficiary becomes entitled in possession. The Trustees Act 1925, particularly sections 31 and 32, is traditionally cited for maintenance and advancement. The maintenance power allows trustees to apply income for the maintenance, education, or benefit of a beneficiary who is a minor or otherwise not entitled to income outright. The advancement power allows trustees to apply capital for the advancement or benefit of a beneficiary, traditionally up to a proportion, subject to the terms of the trust instrument and any statutory modifications. In problem questions, you are often asked whether trustees can pay for school fees, university fees, housing deposits, or medical expenses. The analysis is, check the trust instrument first. If it grants express powers, apply them. If it is silent, consider statutory powers. Then apply trustee duties. Act in the beneficiary's best interests, act even-handedly where multiple beneficiaries are affected, and document decision-making. A common exam twist is that advancement may prejudice other beneficiaries, such as remainder beneficiaries. Trustee must consider that. Their discretion is not unlimited. They must weigh interests fairly.
Trustee's liability. Breach of trust. A breach of trust occurs when a trustee acts outside powers, fails to comply with duties, or misapplies trust property. Breach can be deliberate or negligent. Liability is usually strict in the sense that trustees are responsible even if they acted honestly, though relief mechanisms exist. Breaches include unauthorized investments, improper distributions, failure to safeguard assets, failure to obtain advice when required, and conflicts of interest leading to improper decisions. Breach also includes misapplication of trust property, such as paying trust money to the wrong person. When answering exam questions, classify the breach. Is it a breach of fiduciary duty, like conflict and unauthorized profit? Is it a breach of the duty of care, like negligent investment? Is it a breach of trust instrument terms, like distributing capital when only income distributions are permitted? The classification helps you identify remedies.
Trustees' liability. Measure of liability. The measure of liability depends on the remedy. Equity aims to restore the trust fund to the position it would have been in but for the breach, or to strip profits where fiduciary obligations were violated. For loss-based claims, trustees may be required to pay equitable compensation, sometimes discussed as reconstitution of the trust fund. Key modern cases include Target Holdings v. Redferns and AIB Group v. Mark Redler. These cases emphasize causation and the scope of duty. Equity does not automatically award the full sum involved in the transaction if the loss would have occurred anyway, or if the breach did not cause the loss in the relevant sense. This is a significant modern development because older descriptions of trustee liability sometimes sounded absolute. The current approach is more nuanced. Equity still protects the trust, but it aligns compensation with causal responsibility. For profit-based claims, trustees may have to account for profits, even if the trust suffered no loss. This is common for fiduciary breaches. The logic is deterrence and loyalty, not compensation. Boardman v. Phipps is a key illustration, and FHR strengthens the proprietary dimension where bribes and secret commissions are involved. In exam answers, be explicit. If trust property was misapplied and the trust lost money, you discuss equitable compensation and reconstitution. If the trustee made a profit through conflict or commission, you discuss account of profits and possibly constructive trust.
Trustees' liability. Protection of trustees. Trustees have protections, and exam questions frequently test them. One protection is beneficiary consent. If a fully informed beneficiary with capacity consents to a breach, they may be unable to complain later. But consent must be genuine, informed, and free from pressure. Consent also cannot usually bind beneficiaries who lack capacity, such as minors, unless a court approves. Another protection is exemption clauses in the trust instrument. Armitage versus Nurse is central. It held that an exemption clause can exclude liability for negligence and even gross negligence, but it cannot exclude liability for fraud. The irreducible core of trusteeship is honesty and good faith. That principle is regularly examined. A third protection is statutory relief under Section 61 of the Trustee Act 1925. The court may relieve a trustee from personal liability if the trustee acted honestly and reasonably and ought fairly to be excused. This is discretionary. Trustees cannot assume it will apply. But in exam questions where trustees made an innocent mistake after taking advice, Section 61 is a plausible argument. Professional trustees and solicitors should be cautious here. The more professional the trustee, the harder it is to argue that mistakes were reasonable. Documentation and advice-taking become key.
Trustees' liability. Limitation period. Limitation in trusts claims is governed by the Limitation Act 1980, with special rules for trusts claims. The headline point is that some breaches are not subject to ordinary limitation periods, especially where trustees are fraudulent or where they retain trust property. Section 21 of the Limitation Act 1980 is central. Claims against a trustee for fraud or to recover trust property or its proceeds in the trustee's possession are generally not barred by limitation. For other breaches, the normal limitation period, often 6 years, may apply. This matters in practice because beneficiaries sometimes discover problems long after the event. In exam questions, if time is mentioned, you should immediately consider whether the breach involved fraud or misappropriation and whether the trustee still holds the property or its traceable proceeds.
The nature of equitable remedies. Equitable remedies are distinctive because they are discretionary and conscience-based, even though they are applied through structured rules. They include proprietary remedies, personal remedies, and specific forms of relief like injunctions and specific performance. In trusts, the core equitable remedies include orders compelling trustees to account, orders to restore trust property, rescission of transactions tainted by breach of fiduciary duty, injunctions to prevent dissipation, and declarations of constructive trust. You should also be comfortable distinguishing common law damages from equitable compensation. Equitable compensation is the trust-focused remedy for breach of trust and breach of fiduciary duty leading to loss. It aims at reconstitution, but modern cases require attention to causation. Another distinctive equitable remedy is an account of profits used to strip unauthorized gains. This is central to fiduciary law and can be available even without loss. Rescission is important for self-dealing and conflict transactions. The beneficiary may set aside the transaction subject to bars such as affirmation, delay, or third-party rights. Equity's discretionary nature shows up here. Delay can be fatal if rescission would unfairly prejudice others. In injunction problems, equity can restrain conduct, including freezing injunctions in some contexts, though the detailed civil procedure is beyond this trust syllabus. Still, the exam may include a scenario where beneficiaries want urgent relief to stop dissipation. Your trust law contribution is to identify the equitable basis for restraining breach and preserving assets. The availability of tracing in equity. Tracing is not a remedy by itself, it is a process. It allows a claimant to identify what happened to property and to claim it in its substituted form or claim value from those who hold it. You should separate 3 ideas. Following tracks the same asset as it moves from person to person. Tracing tracks value as it changes form, for example when money is used to buy shares or land. Claiming is the step where the claimant asserts a right over the traced asset, such as a constructive trust or equitable lien. Equitable tracing is more flexible than common law tracing because equity allows tracing through mixtures. Common law tracing traditionally fails once money is mixed in a bank account because the original notes and coins are no longer identifiable. Equity, by contrast, treats the mixed fund through presumptions and rules. Re Hallett's estate is a leading authority. It created the presumption that a trustee who mixes trust funds with personal funds is presumed to spend their own money first. This protects beneficiaries by leaving trust money in the account as long as possible. Re Otway is another key case. It prevents a trustee from arguing that trust money was spent first where doing so would harm beneficiaries. If the trustee used mixed funds to buy an asset, beneficiaries may claim that asset as representing trust money, rather than being forced to accept whatever remains in the account. Where funds are mixed and then dissipated, the lowest intermediate balance rule limits recovery. The idea is that you cannot trace into an account more than the lowest balance after the misappropriation, because once money is spent, it is gone. This is often linked to cases like James Roscoe Bolton v. Winder. Where multiple innocent claimants' funds are mixed, different rules can apply, including pari passu sharing in some contexts or the rule in Clayton's case in others, though modern courts are cautious about Clayton because it can produce arbitrary outcomes. For SQE, the most common expectation is that you recognize the basic wrongdoer mixing rules from Re Hallett and Re Otway and the proportionality approach where multiple victims are involved. Foskett v. McEwen is an important modern case, illustrating choice of remedy when trust funds are used with other funds to acquire an asset, such as paying premiums on a life insurance policy. The beneficiaries could claim a proportionate share of the payout, reflecting their contribution. The key idea is that proprietary remedies are not limited to compensation. They give claimants a share in gains. Tracing also interacts with subrogation. If trust money is used to pay off a secured debt, such as a mortgage on a property, equity may allow the beneficiaries to be subrogated to the lender's security rights. In simple terms, the beneficiaries step into the lender's shoes to the extent necessary to prevent unjust enrichment. Finally, you should be aware of backward tracing, recognized in a more developed way in the Privy Council decision in Federal Republic of Brazil v. Durant International. The idea is that where there is a close causal link between the incurring of a debt used to acquire an asset and the later misappropriation used to pay that debt, tracing may operate backwards to connect the misappropriated funds to the asset. This is complex, but in exam questions it is usually signposted. If the scenario involves a chain of borrowing and later repayment with misappropriated funds, you mention backward tracing as a possible equitable approach where causally linked.
Conclusion: the exam approach that works. Trusts law for SQE is not about memorizing isolated rules. It is about moving through a structured analysis in a client-focused way. You begin with creation. Is there an express trust? Do the three certainties work? Are formalities satisfied? Is the trust constituted, or is it an imperfect transfer where equity may or may not assist? You then identify beneficial entitlement. Is it fixed or discretionary? Is it vested or contingent? Can the beneficiaries invoke Saunders v. Vautier? You then classify implied trusts when appropriate. Is there a resulting trust because beneficial entitlement did not pass or because a purpose failed? Is there a constructive trust because of common intention in a family home or because of wrongdoing? You then examine trusteeship. Who can be a trustee? How a trustee is appointed, retired, or removed? What duties and powers apply, especially duty of care, investment, maintenance, and advancement? You then examine liability. Was there breach of trust or breach of fiduciary duty? What is the measure, loss-based or profit-based? What protections exist, including exemption clauses, beneficiary consent, and statutory relief? Is limitation relevant? You finish with remedies. What equitable remedy is available? Can the claimant trace in equity, follow value through substitutions and mixtures, and make a proprietary claim? And through all of it, you keep one consistent theme in mind. Equity regulates conscience, and the solicitor's job is to translate conscience into structured legal analysis with honesty and integrity at every stage. Now you are in a better place to attempt the SQE. Invest in wine if you wish, and you definitely earned a glass for yourself. Thank you for watching, and have a look around Dr. Yannis' channel for more core FLK topics. You come out of the pub drunk one night and you're thinking, how about we show the whole village and do something grand, something everyone will talk about, something we can tell our friends back at the pub. Let's go like goblins in the night and cut down that big tree. And that, stripped of romance and bravado, is very close to how one of the most notorious criminal cases of recent years actually began. In the early hours of September 2023, the iconic Sycamore Gap tree, standing beside Hadrian's Wall and protected as a cultural landmark, was deliberately felled with a chainsaw. This was not an accident, not storm damage, not a misunderstanding about land ownership. It was a planned act. Two, admittedly not very bright men, carried out the cutting, filmed it, and returned to ordinary life, apparently assuming it would be treated as a drunken prank rather than a serious crime. The criminal law took a different view. Both men were charged with criminal damage, not only for destroying the tree itself, but also for damaging Hadrian's Wall, a scheduled ancient monument. At trial, the prosecution had to do exactly what we are about to practice in this lecture: identify the actus reus, prove the mens rea, establish causation, and rule out any possible lawful excuse. The jury convicted, and in July 2025, both defendants were sentenced to over 4 years imprisonment each, a punishment that shocked many who still thought of the incident as just vandalism. This is why criminal law matters and why it looks the way it does. Criminal law exists precisely to stop drunken bravado, group foolishness, and "it seemed like a good idea at the time" from becoming a defense. It is the legal system's way of saying that some acts, even if done for attention, even if done in jest, cross a line that society will enforce with real consequences. So, as we now turn to actus reus, mens rea, offences, defences and liability, keep that image in mind. Criminal law is not only about murderers and masterminds, it is very often about ordinary people making reckless choices and discovering, too late, that the law has been quietly waiting for them all along. In this lecture, we present everything you need to know for FLK criminal law in the exact areas specified by the SRA. The core principles of criminal liability, the main building block offences that appear repeatedly in practice questions, the general and partial defences, participation and attempts. We will also anchor each rule in its proper legal authority, so you can connect doctrine to statute and case law as you revise. A good way to think about criminal law is that it is a disciplined method for answering one central question: should the state condemn and punish this person for what happened? English criminal law does not answer that question by intuition or moral instinct. It answers it by analysing structured elements. In most offences, the prosecution must prove an external element and an internal element. We describe those as actus reus and mens rea. The classic maxim is actus non facit reum nisi mens sit rea, meaning an act does not make a person guilty unless the mind is also guilty. In practice, this means you should always ask, first, what precisely is the prohibited conduct or prohibited result, and second, what is the required mental state in relation to that conduct or result. Then you test whether any defense operates, either by negating one of the elements or by excusing or justifying the conduct despite the elements being present. The SRA specification emphasizes this competence point. Candidates must apply the core principles of criminal liability, including actus reus and mens rea, general and partial defenses, participation and attempts. That is the logic of the SQE. It is not about reciting rules in isolation. It is about deploying rules in a structured way. Actus reus. Actus reus is the external element of an offence. It can take different shapes. Sometimes it is conduct, like striking someone. Sometimes it is a consequence, like causing death. Sometimes it is conduct plus a circumstance, like sexual penetration in circumstances where the complainant does not consent. Those categories matter because they determine what the prosecution must prove and which additional doctrines come into play, particularly causation.
A foundational point in English criminal law is that actus reus normally requires a voluntary act. A voluntary act is an orderly movement controlled by the will. Involuntary movements do not normally attract criminal liability. A classic illustration is Hill v. Baxter, 1958, where the court discussed situations such as being attacked by a swarm of bees while driving or suffering a sudden medical episode, to show that not every movement is a voluntary act for criminal responsibility. Where the defendant's actions are truly involuntary, the actus reus is not established. However, criminal liability is not limited to positive acts. Sometimes an omission can constitute the actus reus, but only where the defendant was under a legal duty to act. English law does not impose a general duty to rescue strangers. Duties arise in defined situations. One common category is a duty imposed by statute. Another is a duty arising from a special relationship, such as parent and child, where failure to act can ground liability. Another category is where the defendant voluntarily assumes responsibility, and another is a duty arising from contract. A particularly examinable category is where the defendant creates a dangerous situation and then fails to take reasonable steps to avert the danger. That is the principle in R. v. Miller, 1983. Miller accidentally started a fire by falling asleep with a lit cigarette. When he woke and realized the fire, he simply moved rooms and took no action. The House of Lords treated his failure to act once aware of the danger as the relevant actus reus. That case also connects to coincidence, because it shows how an omission can supply the actus reus at the point when the necessary mental element exists. Some offences are state of affairs offences, and some involve possession. Possession offences require control and knowledge, depending on the offence definition. But for FLK criminal law, the key point is simply to recognise that the act requirement has exceptions, and omissions and possession can be criminal where the law defines them as such.
Crimes and causation. Where an offence requires a prohibited consequence, such as death in homicide or damage in criminal damage, the prosecution must prove causation. Causation in criminal law is conventionally analysed in two stages: factual causation and legal causation. Factual causation is typically tested using the but-for test. But for the defendant's conduct, would the prohibited result have occurred when and as it did? The classical authority is R. v. White, 1910. White placed poison in his mother's drink, intending to kill her, but she died of a heart attack before the poison could take effect. He was not factually the cause of death by poisoning, although he could still be liable for attempt. White is useful because it separates intention from causation. You can have a guilty mind and yet fail to cause the prohibited result. Legal causation asks whether the defendant's conduct was a substantial and operative cause of the result. This formulation appears repeatedly in case law, including R. v. Smith, 1959. The law does not require the defendant's act to be the sole cause. Multiple causes can operate, so long as the defendant's contribution remains substantial in the sense recognized by criminal law. The chain of causation may be broken by a novus actus interveniens, an intervening act that is sufficiently independent to make it unfair to attribute the result to the defendant. This is where careful reasoning is required. Acts of third parties sometimes break the chain, but not always. R. v. Paget, 1983, is a leading authority. Paget used a woman as a human shield while firing at armed police. The police returned fire and killed the woman. The Court of Appeal held the chain was not broken. The defendant's actions remained the operative cause, and the police response was not free, deliberate, and informed in a way that displaced responsibility. Medical treatment is another common issue. Poor medical treatment does not usually break the chain. The general approach is that only treatment that is so independent and so potent in causing death that the defendant's acts are rendered insignificant will break the chain. R. v. Cheshire, 1991, is the standard illustration. Even significant medical negligence did not break the chain where the original wound remained a significant cause of death.
A contrasting case often discussed in textbooks is R.V. Jordan, 1956, where the original wound had largely healed and the treatment was palpably wrong, but the modern approach tends to follow Cheshire and treat Jordan as exceptional. The victim's own actions can be raised as a potential intervening act. The key question is whether the victim's conduct was reasonably foreseeable and whether it was daft but still within the range of normal human reaction, or whether it was so unpredictable and independent that it breaks causation. R.V. Roberts, 1971, is a classic example. A woman jumped from a moving car to escape sexual advances and suffered injuries. The defendant remained liable because her response was not so unforeseeable as to break the chain. The thin skull rule is crucial. The defendant must take the victim as found, including unusual vulnerabilities. R.V. Blau, 1975, is the standard authority. The victim refused a blood transfusion on religious grounds and died. The defendant was still liable because the refusal did not break the chain. That principle matters for both homicide and serious non-fatal offences. Finally, in drug administration scenarios, the voluntary act of the victim may break the chain where the victim freely and knowingly self-administers drugs supplied by the defendant. The supplier does not cause the death for the purposes of unlawful act manslaughter. This is a frequent trap in problem questions.
Mens rea. Mens rea is the fault element. It describes what must be proved about the defendant's state of mind in relation to the actus reus. English criminal law contains both subjective and objective standards. Intention is the highest level of culpability. Direct intention exists where it is the defendant's purpose or aim to bring about a result. Oblique intention exists where the result is not the defendant's main aim, but is foreseen as virtually certain. The modern direction comes from R.V. Woolin, 1999, where the House of Lords endorsed a virtual certainty approach. Woolin builds on earlier developments such as R.V. Nedrick, 1986. For FLK purposes, you should express the rule this way. The jury may find intention if death or serious injury was a virtual certainty from the defendant's act and the defendant appreciated that. Recklessness is usually subjective in English criminal law. The leading modern authority is RVG 2003. The House of Lords confirmed that a person is reckless where they are aware of a risk that exists or will exist, and in the circumstances known to them, it's unreasonable to take that risk. This replaced earlier objective formulations associated with Caldwell. For many FLK offences, especially criminal damage and basic assault offences, recklessness may satisfy mens rea, but it must be subjective under RVG unless the statute clearly indicates otherwise. Dishonesty is objective and plays a limited role in core offences, but it is critical for gross negligence manslaughter. It is also relevant for some regulatory and driving offences, though those are not the focus here. Some offences require dishonesty. This is particularly central in theft and fraud. Historically, dishonesty in criminal law was governed by the two-stage test in R.V. Gosh, 1982. However, the Supreme Court in IVV Genting Casinos 2017 rejected the second subjective limb of Gosh and confirmed a primarily objective approach. The correct modern statement is that you determine the defendant's actual state of knowledge or belief as to the facts, and then you ask whether, given those facts, ordinary decent people would consider the conduct dishonest. This is now widely applied across criminal offences involving dishonesty.
Coincidence and correspondence. Coincidence requires that the actus reus and mens rea coincide in time, but criminal law is pragmatic. Where the conduct is continuous or where the defendant's duty to act arises later, the courts can treat the actus reus as ongoing. Fagan v. Metropolitan Police Commissioner 1969 is a classic case. The defendant accidentally drove onto a police officer's foot and then refused to move. The court treated the actus reus as a continuing act, allowing the mens rea formed after realization to coincide with the ongoing act. Miller, 1983, discussed earlier, is an omission-based route to coincidence. The defendant becomes liable not because the original act was reckless, but because once aware of the danger, the failure to act supplies the relevant actus reus at a time when the defendant is reckless. Correspondence means the mental element must relate to the relevant elements of the actus reus. Theft is a good illustration. The actus reus involves appropriation of property belonging to another. The mens rea includes dishonesty and intent permanently to deprive. If the defendant honestly believes the property is theirs, then the required correspondence between mens rea and the belonging to another element may be missing. Transferred malice. Transferred malice applies where the defendant intends to harm one person but unintentionally harms another. The intent transfers, provided the offence is of the same type. Latimer, 1886, is a classic authority. The defendant aimed a blow at one person but struck another. The mens rea transferred. But transferred malice does not operate across offence categories. In Pembleton, 1874, intention to hit a person could not be transferred to criminal damage to property because the intended harm and the actual harm were of different kinds. With the foundational principles in place, we now move through the specified offences in the SRA syllabus using the actus reus and mens rea structure each time.
Offences against the person. Common assault, assault and battery. Common assault and battery are common law offences, usually charged under the Criminal Justice Act 1988, Section 39, which provides the mode of trial and penalty. The law distinguishes assault from battery. Assault is the act of causing the victim to apprehend immediate, unlawful violence. The focus is on the victim's expectation of imminent force. Physical contact is not required. The fear must be of immediate violence, but immediate is interpreted flexibly, meaning imminent rather than instant. Authorities such as R. v. Constanza, 1997, and Smith v. Superintendent of Woking Police Station, 1983, illustrate how threats and menacing behaviour can amount to assault even without physical contact, so long as the apprehension is of violence that is imminent in the circumstances. Battery is the actual application of unlawful force. The force can be minimal. Collins v. Wilcock, 1984, is the leading authority illustrating that even touching can be a battery if it goes beyond ordinary socially accepted contact. Battery also includes indirect applications of force, as in situations where the defendant causes contact through an object or through another mechanism. Fagan, 1969, is again relevant because leaving a car wheel on a foot was treated as a battery. Mens rea for both assault and battery is intention or recklessness. The defendant must intend or be subjectively reckless as to causing apprehension of immediate unlawful force in assault or applying unlawful force in battery. Recklessness should be understood through the modern subjective approach, consistent with RVG 2003. Consent can operate as a defence to common assault and battery in many settings, because everyday life and many socially valuable activities involve contact and risk. But consent is limited by public policy. The leading authority in the limits of consent is R.V. Brown, 1993, where consent was held ineffective for injuries caused for sadomasochistic sexual gratification. While Brown is not directly about common assault, it is frequently used to explain why consent is not unlimited in offences against the person. Section 47, OPAA 1861. Section 47 of the Offences Against the Person Act 1861 creates the offence of assault occasioning actual bodily harm. The actus reus requires an assault or battery that occasions actual bodily harm. Actual bodily harm is any hurt or injury calculated to interfere with the health or comfort of the victim. R.V. Miller is the classic authority for this broad definition. It includes more than minor transient injuries, but it does not require serious harm. Recognized psychiatric injury can count as actual bodily harm, but emotions such as fear or distress alone are not enough. R.V. Chan Fook is often cited on the inclusion of psychiatric injury.
The mens rea for Section 47 is a common exam point. The prosecution does not have to prove that the defendant intended or foresaw actual bodily harm. It is sufficient to prove the mens rea for the underlying assault or battery, namely intention or recklessness as to applying unlawful force or causing apprehension of it. R.V. Savage, Parmenter, is the key authority confirming that foresight of some harm is not required for Section 47. This creates an important distinction between the mental element and the level of harm that actually occurs. Causation is also relevant. The assault or battery must occasion the actual bodily harm. That includes the normal criminal law approach to causation, so victim reactions and intervening acts can be analysed through cases such as Roberts, 1971.
Section 20 OAPA 1861. Section 20 criminalizes unlawful and malicious wounding or inflicting grievous bodily harm. There are two main actus reus routes. One is wounding and the other is inflicting grievous bodily harm. A wound requires a break in both layers of the skin. JCC v. Eisenhower, 1984, is a standard authority confirming that internal ruptures without a break in skin do not count as wounding. Grievous bodily harm means really serious harm. The courts have treated this as a question of fact and degree for the jury. Serious psychiatric injury can qualify, and R.V. Burstow, 1997, is a leading case confirming that grievous bodily harm can include serious recognized psychiatric illness, and that inflict does not require a technical assault. It can include causing harm by other means, so long as causation is established. The mens rea is maliciously, which the courts interpret through R.V. Cunningham, 1957. Cunningham established that maliciously means intention or recklessness as to causing some harm. For Section 20, the defendant must intend or be reckless as to causing some physical harm, not necessarily grievous harm. This is another crucial distinction between Section 20 and Section 18. If the defendant intends serious harm, Section 18 may be available. If they merely foresee some harm but serious harm results, Section 20 may be appropriate. Section 18 OAPA 1861. Section 18 is the most serious non-fatal offence. It criminalizes wounding or causing grievous bodily harm with intent. The actus reus is similar to Section 20 in terms of wounding or causing grievous bodily harm, but the mens rea is more demanding. The defendant must intend to cause grievous bodily harm or intend to resist or prevent lawful apprehension. Recklessness is insufficient for Section 18. The requirement of intent to cause grievous bodily harm is a specific intent requirement. The prosecution must prove that the defendant meant to cause really serious harm. Authorities such as R.V. Belfon, 1976, are frequently cited in this context to highlight that the distinction between intention and recklessness matters. Section 18 is therefore a higher culpability offence, which is reflected in sentencing and in charging decisions.
Theft offences. Property offences are heavily examined because they combine statutory interpretation, dishonesty, and careful element analysis. The SRA specification lists theft under Section 1 of the Theft Act 1968, robbery under Section 8, burglary under Section 9, and aggravated burglary under Section 10. Theft, Section 1 Theft Act 1968. Section 1 Sub 1 of the Theft Act 1968 provides the definition. A person is guilty of theft if they dishonestly appropriate property belonging to another with the intention of permanently depriving the other of it. Each word is an examinable gateway. The actus reus includes appropriation, property, and belonging to another. Appropriation is defined in Section 3 Sub 1 as any assumption by a person of the rights of an owner. The classic starting point is R.V. Morris, 1984, where switching price labels was treated as appropriation because it involved assuming an owner's right to determine price. Critically, appropriation can occur even with the owner's consent. R.V. Garmes, 1993, established that consent does not prevent appropriation. That principle was later reinforced in R.V. Hinks 2000, where the defendant obtained gifts from a vulnerable person. Even though the property transfer was valid in civil law, appropriation still occurred for theft. The lesson for SQE analysis is that appropriation is broad. You do not need trespass or lack of consent as a technical requirement. Property is defined in Section 4 and includes money and all other property, real or personal, including things in action and other intangible property. Some intangible information is not property for theft, but the statute clearly includes many intangible rights. You should treat property as wide unless a question is designed to test a specific exclusion. Belonging to another is defined in Section 5. Property belongs to any person having possession or control of it or having any proprietary right or interest. This allows theft even where the defendant is the owner in a narrow sense. R.V. Turner No. 2, 1971, is the classic example. The defendant took his own car from a garage without paying for repairs. The car belonged to another because the garage had possession and control. This aspect often appears in questions involving employees, bailees, and mixed ownership. The mens rea comprises dishonesty and intent to permanently deprive. Dishonesty is not defined in the Theft Act in a single general provision, but sections 2(1)(a) to c provide limited circumstances where appropriation is not dishonest, such as where the defendant believes they have a legal right to deprive the other of it, or believes the owner would consent, or cannot discover the owner by taking reasonable steps. Outside those statutory carve-outs, the modern approach to dishonesty follows IV versus Genting Casinos 2017. You identify the defendant's knowledge or belief as to the facts, and then apply the objective standards of ordinary decent people to determine dishonesty. Intent to permanently deprive is addressed in Section 6. It includes an intention to treat the thing as one's own to dispose of, regardless of the other's rights. That can capture borrowing, where the borrowing is equivalent to outright taking. R.V. Lloyd, 1985, is the classic example, where the defendants borrowed film reels and returned them, and the court held there was no intention to permanently deprive because the films were returned in substantially the same condition and value. In contrast, cases such as R.V. Velumail 1989 show that intending to replace money with different notes is still intention to permanently deprive because the specific notes taken are not returned.
Robbery. Section 8, Theft Act 1968. Section 8 defines robbery. It requires theft and, immediately before or at the time of stealing, the defendant uses force on any person or puts or seeks to put any person in fear of being then and there subjected to force, and the defendant does so in order to steal. Robbery is therefore theft plus force or threat of force plus the temporal and purposive link. The force can be minimal, but it must be more than mere touching in some contexts. R.V. Dawson and James 1976 is often cited, where even a small push could be force. Timing is also crucial. The phrase "at the time of stealing" is interpreted in the context of theft being a continuing act. R.V. Hale 1979 is the classic authority. The appropriation can be treated as continuing, allowing force used during escape to still qualify as being at the time of stealing. The mens rea includes the mens rea for theft, including dishonesty and intent permanently to deprive, as well as the intention behind using force in order to steal. Burglary. Section 9, Theft Act 1968. Burglary under Section 9 is a complex offence with two main forms. Section 9(1)(a) burglary occurs where the defendant enters a building or part of a building as a trespasser with intent to steal, inflict grievous bodily harm, or do unlawful damage to the building or anything in it. Here the ulterior offence does not have to be completed. The offence is complete on entry with the relevant intent.
Section 9(1)(b) burglary occurs where the defendant, having entered a building or part of a building as a trespasser, steals or attempts to steal anything in the building, or inflicts or attempts to inflict grievous bodily harm on any person in the building. Here, the ulterior offence is attempted or committed after entry. Entry must be effective, but it need not be substantial. Older authorities such as R.V. Collins 1973 and later cases like R.V. Brown 1985 illustrate that partial entry can suffice. The building requirement is interpreted broadly to include structures, and part of a building is particularly important in cases involving entering a restricted area in premises open to the public. Trespass involves entry without permission or entry exceeding the scope of permission. R.V. Jones and Smith 1976 is often cited, where even someone who has general permission to enter a house can be a trespasser if they enter as part of a plan to steal. Mens rea for burglary includes knowledge or recklessness as to trespassing and the intention regarding the ulterior offence. Aggravated burglary, Section 10, Theft Act 1968. Section 10 creates aggravated burglary. It is burglary where, at the time of the burglary, the defendant has with them a firearm, imitation firearm, weapon of offence, or explosive. The key points are that it's burglary plus being armed in the statutory sense. The weapon does not have to be used. It must be present at the time, which can include the period of entry and commission, depending on the burglary form.
Criminal damage. The SRA Syllabus requires simple criminal damage, aggravated criminal damage, and arson. The primary statute is the Criminal Damage Act 1971. Simple criminal damage. Section 1 Sub 1 Criminal Damage Act 1971 provides that a person who without lawful excuse destroys or damages any property belonging to another, intending to destroy or damage such property, or being reckless as to whether such property would be destroyed or damaged, is guilty of an offence. The actus reus includes destroying or damaging property and belonging to another. Damage is interpreted broadly. It can include physical harm, but also alteration that reduces value or usefulness. For example, cases such as Roe v. Kingerly, 1986, illustrate that smearing mud on property can constitute damage because it requires effort to clean and impairs appearance. The mens rea is intention or subjective recklessness as to damage, understood through RVG 2003. This means the defendant must be aware of the risk of damage and unreasonably take it. A key feature of criminal damage is lawful excuse set out in Section 5. Section 5 Sub 2A provides a lawful excuse where the defendant believed the owner would consent to the damage or would have consented if they knew the circumstances. This is judged on the defendant's honest belief, even if unreasonable, as established in Jaggard v. Dickinson, 1981. Section 5 Sub 2B provides lawful excuse where the defendant believed property was in immediate need of protection and the means adopted were reasonable in the circumstances as the defendant believed them to be. Chamberlain v. Linden, 1998, is often discussed in relation to reasonableness and belief, showing that the court assesses the excuse through the lens of the defendant's belief, though the statutory wording also contains a reasonableness component as to the means adopted. Aggravated criminal damage. Section 1 Sub 2 Criminal Damage Acts 1971 creates aggravated criminal damage. It applies where a person without lawful excuse destroys or damages any property, whether belonging to themselves or another, intending by the destruction or damage to endanger the life of another, or being reckless as to endangerment of life. The distinct feature is endangerment of life. It is not necessary that life is actually endangered, but the defendant must intend or be reckless as to endangerment. This offence is aggravated because the law treats damage that risks life as far more serious, even if the property belongs to the defendant. Arson. Arson is not a separate substantive offence with its own definition. Under Section 1 Sub 3 of the Criminal Damage Act 1971, where an offence under Section 1 is committed by destroying or damaging property by fire, the offence is charged as arson. That can apply to simple criminal damage by fire and aggravated criminal damage by fire. The actus reus is damage by fire, and the mens rea is the same as the underlying offence, whether intention or recklessness as to damage, and for aggravated arson, intent or recklessness as to endangering life.
Homicide. The homicide section in the SRA specification includes murder, voluntary manslaughter, and involuntary manslaughter, with unlawful act manslaughter and gross negligence manslaughter specified. Homicide is where core principles like causation, intention, and partial defenses converge in an intensely examinable way. Murder. Murder is a common law offence. The classic definition is the unlawful killing of a reasonable creature in being under the Queen's peace with malice aforethought. In modern language, murder requires the actus reus of unlawful killing of a human being and the mens rea of intention to kill or intention to cause grievous bodily harm. The intention to cause really serious harm being sufficient for murder is a distinctive feature of English law. Authorities such as R.V. Vickers, 1957, confirm that intention to cause really serious harm can supply the mens rea for murder even without an intention to kill. Intention is assessed using direct and oblique intention principles, with Woolin, 1999, as the leading authority for oblique intention. Causation is often the battleground in murder. The prosecution must prove that the defendant caused the victim's death using the factual and legal causation analysis discussed earlier. Thin skull issues, medical negligence, and victim response issues are all live. Blau, 1975, Cheshire, 1991, Paget, 1983, and Kennedy, No. 2, 2007, are among the most important authorities for structured causation arguments. Voluntary manslaughter. Voluntary manslaughter arises where the defendant has committed what would otherwise be murder, but a partial defence reduces liability. The SRA specification requires loss of control and diminished responsibility. Loss of control is governed by Sections 54 and 55 of the Coroners and Justice Act 2009, which replaced the old common law defence of provocation. The defence requires that the defendant's act or omission in killing resulted from a loss of self-control, that the loss of control had a qualifying trigger as defined in Section 55, and that a person of the defendant's sex and age with a normal degree of tolerance and self-restraint and in the circumstances of the defendant might have reacted in the same or similar way. Importantly, the loss of control need not be sudden, which was a change from provocation, and this matters in contexts such as cumulative abuse.
The qualifying triggers include fear of serious violence from the victim against the defendant or another identified person, and things said or done which constitute circumstances of an extremely grave character and cause the defendant to have a justifiable sense of being seriously wronged. Sexual infidelity is excluded as a qualifying trigger by Section 55(6) subsection C, but case law, notably R.V. Clinton 2012, shows that sexual infidelity may still be relevant as part of the wider factual context when assessing the circumstances, so long as it is not treated as the trigger by itself.
Diminished responsibility is governed by Section 52 of the Coroners and Justice Act 2009, reformulating the old defence under the Homicide Act 1957. The defendant must show an abnormality of mental functioning arising from a recognised medical condition which substantially impaired their ability to understand the nature of their conduct, form a rational judgment, or exercise self-control, and that provides an explanation for the defendant's act in killing. The recognised medical condition requirement brings the defence into closer alignment with medical classification. Case law is extensive, but the key doctrinal points for FLK are the statutory elements and the need for substantial impairment and an explanatory connection. If either partial defence is established, the conviction is reduced from murder to manslaughter, giving the judge sentencing discretion. Involuntary manslaughter. Involuntary manslaughter applies where the defendant lacks the mens rea for murder, meaning no intention to kill or cause grievous bodily harm, but the law still treats the killing as sufficiently blameworthy for criminal liability. Unlawful act manslaughter, sometimes called constructive manslaughter, requires that the defendant committed an unlawful act, that the act was dangerous, and that it caused death. The unlawful act must be a criminal offence. The defendant must have the mens rea for that underlying offence, but they need not foresee death or serious harm. The act must also be directed at a person in the sense used in the unlawful act manslaughter cases, and not merely a negligent omission unless an unlawful act is identified.
Gross negligence manslaughter arises where the defendant owed the victim a duty of care, breached that duty, caused death, and the breach was so gross as to justify criminal punishment. The leading authority is R.V. Adamako, 1994. Adamako, an anaesthetist, failed to notice and address an oxygen tube, leading to death. The House of Lords endorsed a test grounded in duty, breach, causation, and grossness, with the jury deciding whether the negligence was gross in the circumstances. A further important point, emphasized in subsequent cases such as R.V. Misra and Srivastavan 2004, is that there must be an obvious risk of death, not merely a risk of injury.
Fraud. The SRA specification requires fraud by false representation, fraud by abuse of position, and fraud by failing to disclose. The primary statute is Fraud Act 2006. Fraud is a dishonesty-based offence. It is designed to criminalise dishonest conduct intended to produce gain or cause loss, and it is structured to avoid overly technical distinctions from earlier deception offences. Fraud by false representation. Section 2, Fraud Act 2006, creates fraud by false representation. The actus reus is making a representation that is false. A representation can be express or implied. It can relate to fact, law, or state of mind. The representation must be false, meaning untrue or misleading, and the defendant must know that it is or might be false. The mens reus includes dishonesty and intention to make a gain for oneself or another, or to cause loss to another, or expose another to risk of loss. Gain and loss are defined in Section 5 and include keeping what one has as well as obtaining what one does not have. Dishonesty is assessed using the Ivey versus Genting 2017 approach. Fraud by failing to disclose information. Section 3 creates fraud by failing to disclose information where the defendant is under a legal duty to disclose. The key issue is the existence of a duty to disclose. That duty can arise from statute, contract, fiduciary duties, or specific transactional contexts. The defendant must dishonestly fail to disclose, intending to make a gain or cause loss. Fraud by abuse of position. Section 4 creates fraud by abuse of position. It applies where the defendant occupies a position in which they are expected to safeguard or not to act against the financial interests of another person, and they dishonestly abuse that position, intending to make a gain or cause loss. This often arises in employment, caring relationships, fiduciary contexts, and any scenario involving entrusted authority. These fraud offences are designed to be flexible. In SQE questions, you will often have to identify which route applies, and the route is often determined by whether there is a representation, a duty to disclose, or an entrusted position. General defences. The SRA specification lists intoxication and self-defense or defense of another as general defenses. In practice, they function differently. Intoxication typically operates by undermining mens rea, while self-defense is a justificatory defense. Intoxication. Intoxication is not a single defense with a single test. It is a doctrine that affects whether the prosecution can prove mens rea. The key distinction is between specific intent crimes and basic intent crimes. Specific intent crimes are those where the offence requires an intention to bring about a further consequence beyond the act itself, such as intention to cause grievous bodily harm under Section 18, or murder, or theft requiring intention permanently to deprive. Basic intent crimes are those where recklessness suffices, such as common assault, battery, Section 47, and criminal damage under Section 1(1), where recklessness is available. The leading authority is DPP v. Majeski, 1977. Majeski establishes that voluntary intoxication is generally not a defence to basic intent offences. The rationale is that becoming voluntarily intoxicated is itself reckless, and the law treats that recklessness as supplying culpability. For specific intent offences, voluntary intoxication may prevent the formation of the required intent, potentially reducing liability. For example, intoxication may prevent intent to kill in murder, though it might still allow a conviction for a lesser offence if recklessness suffices elsewhere, depending on the offence structure. Involuntary intoxication, such as where the defendant's drink is spiked, is treated differently. If intoxication is involuntary and it prevents the defendant forming the required mens rea, the prosecution may fail. However, if the defendant still forms the requisite intent, they can be liable.
R.V. Kingston, 1995, is the key authority. Involuntary intoxication did not provide a defence where the defendant still formed the requisite intent. A related point is that intoxication can intersect with automatism. If the defendant's state amounts to automatism and is caused by an external factor, it can negate voluntariness. But self-induced intoxication usually prevents reliance on automatism, as illustrated by R. V. Lippmann, 1970, where self-induced LSD intoxication did not excuse a killing.
Self-defense and defense of another. Self-defense is available at common law and is also reflected in statute. Section 3 of the Criminal Law Act 1967 provides that a person may use such force as is reasonable in the circumstances in the prevention of crime or in effecting or assisting in the lawful arrest of offenders. Section 76 of the Criminal Justice and Immigration Act 2008 clarifies key aspects of the common law, including the assessment of reasonableness of force and the relevance of the defendant's perception. The core test is necessity and proportionality. The defendant must honestly believe that it is necessary to use force to defend themselves, another, or property, or to prevent crime, and the force used must be reasonable in the circumstances as the defendant believed them to be. The honest belief requirement is illustrated in cases such as R. V. Gladstone-Williams, 1984, where the defendant intervened believing a person was being assaulted when in fact the victim was making a lawful arrest. The defendant's honest mistake could support self-defense. Reasonableness of force is a normative assessment. The classic statement is in Palmer v. R. 1971, emphasizing that a person acting in self-defense cannot be expected to weigh to a nicety the exact measure of force needed in the heat of the moment. However, force that is grossly disproportionate will not be reasonable. Statutory modifications for householders exist under the Crime and Courts Act 2013, allowing a householder to use force that is disproportionate but not grossly disproportionate against an intruder in certain circumstances, and this is reflected in the Section 76 framework. Self-defense is a complete defense. If it succeeds, the defendant is acquitted.
Partial defenses. The SRA specification requires loss of control and diminished responsibility. These are partial defences applicable only to murder, reducing murder to manslaughter. They were addressed above under voluntary manslaughter, but it is worth emphasizing their function as partial defences. Loss of control under Coroners and Justice Act 2009, sections 54 and 55, is structured, with qualifying triggers, an objective test, and restrictions such as the exclusion of a considered desire for revenge. Diminished responsibility under Section 52 requires an abnormality of mental functioning from a recognized medical condition, substantial impairment, and an explanatory link. In SQE problem questions, partial defences are frequently tested through factual detail, long-term abuse, fear of serious violence, mental health diagnosis, substance dependency, and whether the defendant's reaction was grossly out of proportion or within the statutory objective test. Your job is to map facts to elements and to explain whether the defence is realistically available.
Parties. The SRA specification lists principal offender and accomplices. The core statutory foundation is Section 8 of the Accessories and Abettors Act 1861, which provides that a person who aids, abets, counsels or procures the commission of an indictable offence may be tried and punished as a principal offender. A principal is the person who commits the actus reus of the offence. An accomplice or secondary party is someone who assists or encourages the principal. The actus reus for secondary liability is assistance or encouragement, which can be physical or psychological. It can include providing tools, acting as a lookout, driving a getaway car, or giving encouragement. Communication of encouragement is usually required, though the law recognizes that encouragement can occur through presence in circumstances where it is intended to lend support. The mens rea for secondary liability is intention to assist or encourage the commission of the offence, along with knowledge of the essential matters that constitute the offence. The secondary party need not know every detail, but must know the type of offence being encouraged and intend their assistance or encouragement. Joint enterprise has been a major area of reform. The Supreme Court in R. V. Joji 2016 clarified that foresight that a principal might commit a further offence is not by itself sufficient for secondary liability. Foresight is evidence from which intention may be inferred, but the prosecution must prove that the secondary party intended to assist or encourage the commission of the offence. Joji thus corrected the earlier direction associated with cases like R.V. Powell and English 2099, where foresight had become dangerously close to a standalone basis of guilt. Withdrawal is possible in some circumstances. The idea is that a secondary party can avoid liability if they withdraw their assistance or encouragement before the offence is committed and do so in a way that is timely and effective. The exact requirements depend on what the secondary party has already done. If they have merely encouraged, communicating withdrawal may suffice. If they have provided tools or significant assistance, they may need to take reasonable steps to neutralise the assistance. Authorities such as R.V. Becerra 1976 are frequently discussed on withdrawal in a joint criminal context.
Inchoate offences. Attempt to commit an offence. The SRA specification requires attempts. The key statute is the Criminal Attempts Act 1981. Section 1, subsection 1 provides that, if, with intent to commit an offence, a person does an act which is more than merely preparatory to the commission of the offence, they are guilty of attempt. This requires two things: an act that crosses the line from preparation to execution, and an intention to commit the substantive offence. The more than merely preparatory test is inherently evaluative, and the case law is designed to illustrate where court draw the line. R.V. Campbell, 1991, is a classic case, where the defendant was found near a post office with an imitation firearm, but had not entered. This was held to be merely preparatory. In contrast, R.V. Jones, 1990, involved pointing a loaded gun at the victim and pulling the trigger. The safety catch prevented firing. This was an attempt because the defendant had moved beyond preparation to doing the act that would commit the offence if not interrupted. R.V. Geddes, 1996, is another useful authority. A defendant was found in a school toilet with a knife, rope, and tape, apparently intending to kidnap. The court held his acts were still preparatory because he had not yet confronted or targeted a victim in a way that commenced the substantive offence. Mens rea for attempt is intent to commit the offence. Attempt is therefore a specific intent offence. Even if the substantive offence can be committed recklessly, attempt usually requires intention. R.V. Wybrow, 1951, is commonly cited to show that attempted murder requires intent to kill, not merely intent to cause grievous bodily harm. Impossibility is also examinable. Section 1, subsection 2, Criminal Attempts Act 1981, provides that a person may be guilty of attempting an offence, even if the facts are such that the commission of the offence is impossible. R.V. Shivpuri, 1987, is the leading authority, overruling Anderton and Ryan, and confirming that a defendant can be guilty where they believe they are committing an offence, even if the facts make completion impossible. The law focuses on culpability and danger, not success.
Conclusion. To revise FLK criminal law effectively, you should hold on to a single disciplined method. Start by identifying the offence and setting out actus reus and mens rea precisely with the correct statutory and case authorities. Then apply causation where the offence is a result crime. Then assess whether any defence operates, distinguishing between failure of proof routes like intoxication undermining mens rea and justificatory routes like self-defence. Then consider participation where multiple defendants are involved and attempt where the offence is not completed. If you apply that structure, you will not only remember the law, you will be able to use it in the SQE's problem-solving format, which is exactly what the SRA is testing. Hit that like button on your way out, and don't head into the forest after coming out the pub. You know that never ends well.
We're live on location where police are arresting the princes right here in London.
Imagine this. Within the space of a single week, two of the most recognisable princes in Britain, an actual former prince and the so-called Prince of Darkness, were questioned by police on suspicion of misconduct in public office. Former Prince Andrew was arrested and later released under investigation, and days later Peter Mandelson, Tony Blair's Machiavelli, was also taken to a police station in London in connection with the same offence. Neither has been charged, and both deny wrongdoing, but the spotlight this has shone on how police powers and criminal procedure actually function could not be clearer. Today, Dr. Yannis is going to take you inside that world, from police interviews to bail, from pre-trial hearings to evidence and trial, and what gets lawyers and their clients through the door of justice. We cover the SRA's specification for SQE FLK2 Criminal Law and Practice completely, so you get a great introduction to what you need to know if you're preparing for the SQE. And we are starting right now. Advising clients at the police station. Procedures and safeguards. The initial phase of criminal litigation occurs within the highly regulated and inherently coercive environment of the police station. The rights of the suspect, the powers of the investigating authorities, and the procedural safeguards necessary to ensure a fair process are governed primarily by the Police and Criminal Evidence Act 1984 and its associated codes of practice. A solicitor's primary function at this stage is to safeguard the client's legal rights, prevent inadvertent self-incrimination, and ensure procedural fairness, all while balancing strict professional duties to the administration of justice. Detention time limits and statutory reviews. PACE Code C, revised with effect from 20th December 2023, strictly demarcates the temporal limits of lawful police detention, reflecting the constitutional necessity that deprivations of liberty be proportionate, justified, and subject to regular oversight. The statutory framework operates on a carefully graduated scale of authorization, designed to ensure that suspects are not held arbitrarily. The fundamental principle is that all individuals in custody must be dealt with expediently and released as soon as the need for their detention no longer applies. A suspect may be detained without charge for an initial maximum period of 24 hours for most offences. This period is strictly monitored, and any delays in processing the suspect must be recorded in the custody record, with justifiable reasons provided by the custody officer. Where an investigation requires further time, Section 42 of PACE 1984 permits an extension. An officer of the rank of superintendent or above, who is responsible for the station holding the detainee, may authorize an extension of up to 12 additional hours, bringing the total pre-charge detention limit to 36 hours. This extension is not automatic. The authorizing officer must be satisfied that the offense under investigation is an indictable offense, that the investigation is being conducted diligently and expediently, and that further detention is absolutely necessary to secure or preserve evidence. Any detention extending beyond this 36-hour mark requires external judicial intervention. The police must apply to a magistrate's court under Sections 43 and 44 of PACE for a warrant of further detention, which can extend the period incrementally up to an absolute maximum limit of 96 hours without charge. Throughout the entirety of the detention period, Section 40 of PACE mandates periodic reviews by a review officer. This individual must be an officer of at least the rank of inspector who is not directly involved in the investigation, ensuring a degree of independence in the assessment. The purpose of these reviews is to determine whether the continuation of detention remains legally necessary. The statutory timeline requires that the first review must occur no later than 6 hours after detention is initially authorized, with all subsequent reviews taking place at intervals of no more than 9 hours. Solicitors representing detained clients must rigorously monitor these timelines. A failure by the police authorities to adhere to these statutory limits renders the continued detention unlawful. This can give rise to civil claims for false imprisonment and provides a strong foundation for arguments to exclude any evidence obtained during the unlawful period under Section 78 of PACE 1984. Fundamental rights in custody. Upon detention, a suspect is endowed with fundamental statutory rights that form the bedrock of a fair investigative process. The most critical of these is the right to independent legal advice. A suspect in custody must be informed of their right to consult privately with a solicitor at any time. In practice, the legal representative acts as a vital shield against improper questioning, ensuring the suspect understands the nature of the allegations, the strength of the evidence disclosed, and the implications of their responses during the interview.
Alongside the right to legal counsel is the right to have someone informed of the arrest. Under PACE, a detainee is entitled to have one person known to them or likely to take an interest in their welfare informed of their whereabouts. This right serves both a welfare function and a safeguarding function, preventing suspects from being held incommunicado. Identification procedures under PACE Code D. Identification evidence is inherently fragile and has historically been a primary source of miscarriages of justice. Consequently, PACE Code D strictly governs how the police must conduct identification procedures to ensure reliability and fairness. An identification procedure must be held if the suspect disputes their identity as the perpetrator and an eyewitness is available who claims to be able to identify the individual, unless it would serve no useful purpose or is wholly impracticable. Code D establishes a strict hierarchy of preferred identification procedures for suspects who are known and available, which investigating officers are expected to follow sequentially unless circumstances dictate otherwise. Under PACE Code D, the starting point is video identification, which operates as the primary default procedure. In this method, witnesses are shown moving or still images of the suspect alongside at least 8 other people, known as foils or distractors, who are of broadly similar age, height, and general appearance. This approach is preferred because it is logistically efficient, allows conditions to be standardized, and generally causes less stress for witnesses. If video identification is not used, the next option is the traditional identification parade. Here, the suspect stands in a physical lineup with at least 8 other individuals of similar appearance. The suspect is allowed to choose their position in the parade, but the process is resource-intensive and requires substantial coordination. Where neither video identification nor a parade is appropriate or practicable, the police may resort to group identification. In that procedure, the witness observes the suspect in an informal group, either in a public place or in an arranged setting. Group identifications are typically used when the suspect refuses the more formal procedures or when those procedures are impracticable, given the circumstances of the case. Only if all these methods fail or are impossible can the police use confrontation as a last resort. In a confrontation, a police officer directly presents the suspect to the witness. Because this is highly suggestive and prejudicial, it is only permissible where the suspect has refused to cooperate with all other identification methods and covert identification cannot realistically be carried out. A solicitor, advising at the police station, plays an active, protective role in the administration of Code D procedures. They possess the right to view the video images or physical foils prior to the procedure taking place to ensure that the resemblance is fair and does not unfairly highlight the suspect. While the solicitor may be present during the witness's viewing to observe the conduct of the identification officer, they are strictly prohibited from communicating with the witness in any way. The solicitor must maintain a meticulous contemporaneous note of the proceedings, documenting any irregularities, such as the investigating officer improperly prompting the witness or failing to provide the required cautionary warnings. These notes are critical, as deviations from Code D provide the foundation for challenging the admissibility of the identification evidence at trial via a Section 78 exclusion application or a request for a Turnbull direction.
The right to silence and the mechanics of adverse inferences. Advising a client on whether to answer police questions during a PACE interview requires profound tactical and legal judgment. While there is no general legal duty under English law to assist the police with their inquiries, the Criminal Justice and Public Order Act, CJPOA 1994, severely qualifies the traditional common law right to silence. It permits the court or jury to draw adverse inferences from that silence in highly specific, tightly regulated statutory circumstances. The framework for adverse inferences is constructed upon 4 key provisions of the CJPOA 1994. First, Section 34 permits an adverse inference to be drawn if a suspect fails or refuses to account for the presence of objects, substances, or marks found on their person, in or on their clothing or footwear, or otherwise in their possession at the time of their arrest. Second, Section 37 operates similarly, permitting an inference if a suspect fails or refuses to account for their presence at a particular place at or about the time the offence was committed, assuming the arresting officer reasonably believes their presence may be attributable to participation in an offence. Finally, Section 35 operates at the trial stage rather than the police station, allowing an adverse inference to be drawn if a defendant chooses not to give evidence in their own defence or refuses to answer questions without good cause. Crucially, an adverse inference cannot, on its own, prove guilt. The prosecution must independently establish a prima facie case to answer before a jury or magistrate is permitted to consider drawing any inferences from silence. A solicitor must carefully advise the client of the delicate balance between the risks of silence and the risks of self-incrimination. If the police have provided insufficient pre-interview disclosure regarding the evidence against the client, the solicitor may strategically advise a no-comment interview. In such cases, the solicitor should meticulously document that the silence is based on professional legal advice regarding inadequate disclosure. However, courts have consistently ruled that a defendant simply stating, "I was acting on legal advice," does not automatically provide immunity from a Section 34 inference if they later ambush the prosecution with a newly fabricated defence.
Vulnerability, interviews and the appropriate adult. Under PACE Code C, police officers must conduct investigative interviews in a structured, fair and lawful manner. Where a suspect is identified as a juvenile, under the age of 18, or is deemed to be mentally vulnerable, the Code mandates the mandatory presence of an appropriate adult during the interview, the reading of rights, and the execution of certain procedures. The role of the appropriate adult is distinct from that of the legal representative. Their function is not to provide legal advice, but rather to safeguard the suspect's welfare, assist them in comprehending the complexities of the process, and ensure that the police conduct the interview fairly and without oppression. Solicitors must be exceptionally vigilant in these scenarios. An interview conducted with a vulnerable suspect without an appropriate adult present, or where the appropriate adult is ineffective, is highly susceptible to exclusion at trial under Section 76 of PACE 1984 on the grounds of oppression or unreliability, or Section 78 on the grounds of general unfairness. Ethically, solicitors face heightened professional duties when representing vulnerable clients. The SRA principles require solicitors to act in the client's best interests, and the SRA Code of Conduct requires them to consider and take account of the client's specific attributes, needs, and circumstances. This requires the solicitor to adapt their communication style, ensure the client truly understands the advice being given, and intervene vigorously if the police questioning becomes overly complex, leading, or oppressive. Pre-trial criminal litigation procedures. Upon the conclusion of the police station investigation, the trajectory of criminal litigation shifts entirely to the jurisdiction of the courts. This phase is characterized by critical procedural decisions regarding the defendant's liberty pending trial, the appropriate venue for the adjudication of the charges, and the rigorous preparation required for case management and evidence disclosure.
Bail applications and statutory exceptions. The Bail Act 1976 constitutes the statutory framework governing the release or remand of defendants pending trial. Section 4 of the Act establishes a fundamental, legally binding presumption in favour of bail for all unconvicted defendants. This presumption is a direct reflection of the constitutional principle of the presumption of innocence, dictating that an individual should ordinarily remain at liberty until proven guilty. However, this presumption is not absolute. It is subject to strict statutory exceptions detailed comprehensively within Schedule 1 of the Act. Schedule 1 is segmented into parts based on the classification and severity of the offence. For imprisonable offences covered under Part 1 and the newer Part 1A, a court is legally empowered to refuse bail if it is satisfied that there are substantial grounds for believing that the defendant, if released, would engage in specific prohibited behaviours. When deciding whether to refuse bail, the court must identify
identify a statutory ground that justifies keeping the defendant in custody. One such ground is the risk of failure to surrender. The court must be satisfied that the defendant is likely to abscond and not attend future hearings, taking into account their ties to the community, their previous record of complying with bail, and how severe any potential sentence might be. A second ground is the risk of further offending on bail. Here, the court assesses whether the defendant is likely to commit additional offences if released, commonly by examining their criminal record and whether the current allegation arose while they were already on bail for another matter. A third ground is the risk of interference with the course of justice. This applies where the court believes the defendant may interfere with witnesses, destroy or conceal evidence, or otherwise obstruct the investigation or trial. Finally, bail can be refused for the defendant's own protection or welfare. This applies where custody is considered necessary to safeguard the defendant's physical safety and, in the case of youths, where their overall welfare requires that they be kept in secure conditions rather than released. Furthermore, highly specific exceptions exist. Paragraphs 6A to 6C apply to adult Class A drug users whose offending is demonstrably drug-related and who refuse to undergo required drug testing or assessment. A significant limitation on the magistrate's power to remand in custody is the no real prospect of a custodial sentence in Part 1A of Schedule 1 to the Bail Act 1976. Where it appears to the court that there is no real prospect of a custodial sentence on conviction, an adult defendant should not normally be remanded in custody. The Sentencing Act 2026 makes further amendments to this area in connection with short custodial sentences and presumptions in favour of suspension, but the precise impact will depend on how and when those provisions are commenced. When a court grants bail but harbours residual concerns regarding the statutory risks, it possesses the authority to impose conditions under Section 3 of the Bail Act. Crucially, any conditions imposed must be strictly necessary and proportionate to address the specific identified risk. Common conditional requirements include residence at a specified address, nocturnal curfews, electronic monitoring, tagging, regular reporting to a local police station, and non-contact orders protecting named individuals. The solicitor's role is to construct a robust bail package that mitigates the court's concerns while imposing the least possible restriction on the client's liberty. Repeated bail applications cannot be made endlessly. Following a second unsuccessful application, the defence advocate must present a genuine change of circumstances to the court to have any further application entertained.
Classification of offences and first hearings. The procedural route a criminal case takes is dictated entirely by the statutory classification of the offence charged. The law categorises offences into three distinct tiers. 1. Summary-only offences. These are minor offences such as common assault or low-level motoring violations, which are triable exclusively in the magistrate's court. 2. Indictable-only offences. These represent the most serious crimes in the legal calendar, such as murder, rape and robbery. They are triable exclusively in the Crown Court before a judge and jury. The magistrate's court serves merely as a conduit to send these cases upwards. 3. Either-way offences. These are intermediate gravity offences such as theft, actual bodily harm, or possession of controlled drugs with intent to supply, which can be tried either in the magistrate's court or in the Crown Court. For either-way offences, the first appearance involves the critical plea before venue procedure, governed by the Magistrates' Courts Act 1980. The charge is formally read to the defendant, and they are asked to indicate a plea of guilty or not guilty. If the defendant indicates a guilty plea, the matter proceeds directly to sentencing. The magistrates must evaluate whether their own sentencing powers are sufficient. If they determine their powers are inadequate to reflect the seriousness of the offence, they will commit the defendant to the Crown Court for sentence. If the defendant indicates a not guilty plea or refuses to indicate any plea, the court must proceed to an allocation hearing, historically referred to as mode of trial, under sections 19 and 20 of the MCA 1980. The allocation decision, procedure and tactics. During the allocation phase, the magistrates are tasked with determining whether the case is more suitable for a summary trial or a trial on indictment in the Crown Court. This decision is not arbitrary. It must be guided by the allocation definitive guideline issued by the Sentencing Council. The magistrates will hear representations from both the prosecution and the defence regarding venue suitability.
The general presumption under current guidelines is that either way offences should be tried summarily, unless it is highly likely that the court's sentencing powers will be insufficient. If the magistrates conclude the case is too serious, they will decline jurisdiction and send the case to the Crown Court for trial under Section 51(1) of the Crime and Disorder Act 1998. In this scenario, the defendant has no choice in the matter. Conversely, if the magistrates accept jurisdiction, determining the case is suitable for summary trial, the procedural power shifts to the defendant. The defendant is asked to elect their preferred venue. They may consent to summary trial, or they may exercise their statutory right to elect trial by jury in the Crown Court. Advising a client on this election is a profound responsibility. A solicitor must meticulously weigh competing factors. A magistrate's court trial is generally faster, less formal, and critically the magistrates are restricted in their maximum sentencing powers. However, the Crown Court historically offers a higher statistical rate of acquittal before a jury, albeit carrying the risk of significantly higher costs and exposure to the judge's much greater sentencing powers if convicted. Special statutory provision for low-value shoplifting. A notable procedural exception exists under Section 22A of the MCA 1980. Shoplifting offences where the value of the stolen goods is £200 or less are statutorily deemed to be low value and are treated as summary-only offences. This deprives the magistrates of the power to decline jurisdiction. However, the legislation explicitly preserves the adult defendant's right to elect Crown Court trial if they plead not guilty, overriding the summary-only classification.
Case management and disclosure obligations. Effective and fair criminal litigation is heavily dependent on the rigorous disclosure of material between the adversarial parties. This process is governed by the Criminal Procedure and Investigations Act 1996 and deeply influenced by the updated Attorney General's Guidelines on Disclosure 2022, updated 2024 Digital Guidance Supplements. The prosecution bears a continuing overriding statutory duty to disclose any previously undisclosed material that might reasonably be considered capable of undermining the case for the prosecution against the accused or of assisting the case for the accused. This is not a passive duty. It requires active review throughout the life of the case. The disclosure regime operates in distinct sequential stages. 1. Initial prosecution disclosure. The prosecution provides the defence with the evidence it intends to rely upon at trial. Concurrently, it must provide schedules of unused material, evidence gathered during the investigation that does not form part of the prosecution's affirmative case. This might include negative forensic tests, inconsistent witness statements, or digital communications that do not support the charges. 2. Defence disclosure. In the Crown Court, the provision of a defence statement is mandatory under Section 5 of the CPIA 1996. It remains a voluntary, tactical choice in the Magistrates' Court. The defence statement is a critical document. It must explicitly set out the nature of the defence, the specific matters of fact on which the defendant takes issue with the prosecution, the reasons for that dispute, and full details of any alibi witnesses. Faults in defence disclosure, such as failing to serve a statement, serving it out of time, or departing from its contents at trial, can result in devastating adverse inferences being drawn against the defendant under Section 11 of the CPIA. The 2024 Attorney General's Guidelines place a heightened emphasis on the management of digital material and require robust, documented pre-charge engagement between the prosecution and defence to identify reasonable lines of inquiry early in the process. Ethically, defence solicitors must navigate a complex path, balancing their duty of confidentiality and zealous advocacy for the client with their paramount duty not to mislead the court. A solicitor cannot draft a defence statement that they know to be factually false, nor can they allow a client to present a defence at trial that directly contradicts a private admission of guilt made to the solicitor.
Evidential principles and admissibility rules. A central and highly tested competency for the SQE FLK2 assessment is the ability to navigate the complex statutory and common law rules governing the admissibility of evidence. The overarching immutable principle of criminal trials is that the prosecution bears the legal burden of proof, and the standard required is beyond reasonable doubt, articulated to juries as "so that you are sure." Visual identification and Turnbull guidance. When the prosecution case relies wholly or substantially on visual identification evidence and the defense actively disputes the accuracy of that identification, the court is legally bound to apply the Turnbull guidelines originating from the landmark case of R versus Turnbull. The courts recognize the inherent dangers of mistaken identity, acknowledging that even honest, convincing witnesses can make devastating errors. Consequently, the trial judge must issue a specific, structured warning to the jury, highlighting the special need for caution before convicting based on disputed identification evidence. The judge will direct the jury to examine the specific circumstances of the identification meticulously. This analysis is historically encapsulated in the advocate mnemonic, which prompts the jury to consider the amount of time the witness had the suspect under observation, the distance, the visibility conditions, any obstructions, whether the suspect was known or seen before, any specific reason to remember the individual, the time elapsed between the observation and a formal identification, and any errors or material discrepancies in the witness's initial descriptions. Crucially, if the trial judge determines that the quality of the identification evidence is exceptionally poor, for example, a fleeting glance in dark conditions, and it is entirely unsupported by any other corroborating evidence, the judge has a duty to withdraw the case from the jury and direct an acquittal to prevent an unsafe conviction.
Hearsay evidence is generally inadmissible in criminal proceedings. The Criminal Justice Act 2003 statutorily defines hearsay as a statement not made in oral evidence in the proceedings admissible as evidence of any matter stated. The fundamental rationale for this exclusionary rule is that the original maker of the statement cannot be tested through cross-examination, thereby undermining the reliability of the evidence and prejudicing the fairness of the trial. However, the law recognizes that rigid exclusion can also defeat justice. Therefore, Section 1141 of the CJA 2003 provides 4 strict, exhaustive statutory gateways through which hearsay may be lawfully admitted. Statutory provision, Section 114A, the statement is rendered admissible by specific sections of the CJA 2003 or other relevant statutes. Preserved common law exception, Section 114B, the statement falls under one of the specific common law rules explicitly preserved by Section 118 of the Act. Agreement of parties, Section 114C, all parties to the proceedings formally agree to its admission. Interests of justice, Section 114D, the court grants leave, determining it is in the interests of justice to admit the statement, having considered a statutory list of factors, including the statement's probative value, its reliability, and the difficulty of challenging it. Key statutory exception, unavailable witnesses, Section 116. Under Section 116, first-hand hearsay can be admitted if the witness who made the statement is unavailable to testify for one of 5 strictly defined reasons. The witness is dead, the witness is unfit to testify due to a severe bodily or mental condition, the witness is outside the United Kingdom and it is not reasonably practicable to secure their attendance, the witness cannot be found despite reasonably practicable steps having been taken to locate them, the witness does not give evidence through genuine fear, and the court gives specific leave for the statement to be admitted. This requires a rigorous judicial assessment of whether admission is fair to the defendant. Key statutory exception, business documents, Section 117. Section 117 permits the admission of statements contained in documents created or received in the course of a trade, business, profession, or other occupation. This applies where the supplier of the information had personal knowledge of the matters dealt with, such as bank records, clinical medical logs, or corporate financial reports.
Preserved common law exceptions, Section 118. Section 118 explicitly preserves several historical common law exceptions that are inherently reliable. The most notable is res gesta, which allows the admission of statements made so spontaneously and contemporaneously with an event in circumstances of such intense emotional pressure that the possibility of concoction or distortion can be safely disregarded.
Confession evidence and PACE exclusion challenges. A confession, defined legally as a statement wholly or partly adverse to the person who made it, constitutes a highly potent form of evidence. However, its admissibility is aggressively controlled by the Police and Criminal Evidence Act 1984 to prevent investigative abuses. Under Section 76(2) of PACE, if the defence formally represents to the court that a confession was or may have been obtained by either of two prohibited means, the burden of proof shifts dramatically to the prosecution. A. Oppression. This encompasses extreme conduct including torture, inhumane or degrading treatment, and the use or threat of violence. B. Unreliability. This covers confessions obtained in consequence of anything said or done which was likely, in the circumstances existing at the time, to render any confession unreliable. This frequently involves offering unlawful inducements, for example promises of bail in exchange for a confession, or extreme systemic breaches of the PACE codes of practice during the interview process. If such representations are made, the court must exclude the confession entirely unless the prosecution can prove beyond reasonable doubt that the confession was not obtained in such a manner. Furthermore, under Section 78 of PACE, the court is vested with a broad discretionary power to exclude any prosecution evidence, including confessions, identification evidence, and improperly obtained physical evidence. The test is whether, having regard to all the circumstances in which the evidence was obtained, its admission would have such an adverse effect on the fairness of the proceedings that the court ought not to admit it. Section 78 represents the primary, highly effective procedural mechanism for defence solicitors to enforce police compliance with the PACE codes of practice and protect their clients' right to a fair trial.
Bad character evidence, the statutory regime. The Criminal Justice Act 2003 radically reformed the law regarding the admission of character evidence, dismantling the old common law presumptions of exclusion and replacing them with a framework of structured admissibility. Section 98 defines bad character comprehensively as evidence of or a disposition towards misconduct. Misconduct encompasses the commission of an offence or other reprehensible behaviour, explicitly excluding evidence that relates directly to the facts of the current offence being tried. Defendants' bad character gateways, Section 101 of the CJA 2003. Under Section 101 of the CJA 2003, evidence of a defendant's bad character is admissible if and only if it successfully passes through one of 7 strictly defined statutory gateways. Evidence of a defendant's bad character can only be admitted if it fits through one of 7 statutory gateways. The first is agreement. If all parties formally consent to the evidence being admitted, the court may receive it on that basis. The second is where the defendant themselves adduces the evidence, either by introducing it in their own examination in chief or by deliberately drawing it out in cross-examination. A third gateway covers important explanatory evidence, used where the material is needed to ensure the jury or magistrates can properly understand other evidence in the case. A fourth gateway concerns an important matter in issue between prosecution and defence. This is the most frequently contested route and usually involves showing a propensity, for example that the defendant has previous convictions of the same type, suggesting a tendency to commit such offences, or a propensity for dishonesty or untruthfulness. A fifth gateway applies where the evidence has substantial probative value in relation to an important issue between co-defendants, commonly in so-called cutthroat defences where each seeks to blame the other. A sixth covers situations where the defendant has created a false impression about themselves, such as presenting as peaceful and law-abiding despite a history of serious violence. The bad character evidence may then be admitted to correct that impression. Finally, the seventh gateway arises where the defendant attacks another person's character, for example by alleging that a witness or police officer has fabricated evidence or acted corruptly, which opens the door for the prosecution to rebut that attack by putting the defendant's own bad character before the court. Statutory protective safeguards. The legislation recognises the highly prejudicial nature of character evidence. Consequently, evidence sought to be admitted under gateways D, matter in issue, or G, attack on another, is subject to an express exclusionary power under Section 101(3). The court must not admit the evidence if it appears that its admission would have such an adverse effect on the fairness of the proceedings that the court ought not to admit it. Additionally, the general exclusionary power under Section 78 of PACE 1984 remains available as a safety net across all 7 gateways. Non-defendant's bad character, Section 100. The CJA 2003 also regulates attempts by the defence to attack the character of non-defendants, such as victims or prosecution witnesses. Under Section 100, evidence of a non-defendant's bad character is only admissible with the explicit leave of the court, and only if it satisfies one of 3 stringent conditions. It is important explanatory evidence, it has substantial probative value in relation to an important issue in matter in issue of substantial importance in the context of the case as a whole, or all parties agree to its admission. This presents a deliberately high threshold designed to prevent trials from devolving into unwarranted character assassinations that deter witnesses from coming forward.
Trial procedure, advocacy, mechanics and ethics. The trial phase requires exceptional procedural acumen and strict adherence to professional ethical boundaries. The architecture of a criminal trial follows an established logical sequence: prosecution opening speech, presentation of prosecution evidence, the defence's submission of no case to answer, if applicable, presentation of defense evidence, closing speeches from both advocates, and finally, in the Crown Court, the judge's summing up of the law and evidence followed by directions to the jury. Submission of no case to answer, the Galbraith test. At the close of the prosecution's case, before the defence is required to call any evidence, the defence advocate may strategically make a submission of no case to answer. This procedure argues that the prosecution has fundamentally failed to discharge its evidential burden, rendering it legally unsafe to proceed to the defence stage and requiring an immediate halt to the trial. The prevailing legal standard governing this application is the Galbraith test, derived from the seminal case of R. v. Galbraith. The test comprises 2 distinct limbs. No evidence. There is no evidence whatsoever to prove an essential element of the offence. For example, in a theft case, no evidence is presented to prove dishonest appropriation. In this scenario, the judge or magistrate must stop the case and direct an acquittal. Tenuous evidence. There is some evidence, but it is of such a tenuous character, for example because of inherent weakness, extreme vagueness or fundamental inconsistency with other prosecution evidence, that a jury, properly directed, could not reasonably convict on it. In such instances, the judge should stop the case. However, the crucial caveat is that if the evidence is such that its strength depends entirely on the assessment of a witness's reliability or credibility, a matter falling exclusively within the jury's province as the tribunal of fact, the judge must reject the submission and allow the trial to proceed. A successful submission results in an immediate, directed acquittal. An unsuccessful submission does not prejudice the defence. They retain the absolute right to call evidence, testify, or remain silent as the trial continues. Competence, compellability, and special measures. The rules governing who can testify are defined by the concepts of competence and compellability. Under Section 53 of the Youth Justice and Criminal Evidence Act 1999, the general rule is that all persons, whatever their age, are competent to testify, meaning they are lawfully permitted to testify. A person is only deemed not competent if they suffer from a deficit such that they cannot understand questions put to them and cannot give answers that can be understood by the court. Compellability, by contrast, refers to whether a competent witness can be legally forced to testify under the threat of contempt of court proceedings. Generally, all competent witnesses are compellable for the prosecution. However, the most notable exception is the defendant themselves. A defendant is neither compellable nor competent to testify for the prosecution against themselves or a co-defendant.
To ensure that vulnerable and intimidated witnesses can provide their best possible evidence, the YJCEA 1999 introduced the comprehensive suite of special measures. Witnesses may be deemed eligible for these measures due to vulnerability based on age, under 18, or incapacity, a mental disorder, significant impairment of intelligence, or physical disability under Section 16. Alternatively, they may be eligible if they are deemed intimidated due to genuine fear or distress about testifying under Section 17. The court has discretion to deploy various measures, including screens, Section 23, shielding the witness in the courtroom to prevent them from seeing the defendant, live link, Section 24, allowing the witness to testify via video link from a secure, separate room outside the main courtroom, removal of wigs and gowns, Section 26, creating a less formal and intimidating atmosphere, particularly for child witnesses. Video recorded evidence in chief, Section 27, admitting a pre-recorded police interview as the witness's main evidence in chief, reducing the time they spend giving live evidence. Intermediaries, Section 29, the appointment of approved communication specialists who assist in facilitating communication between the court advocates and a vulnerable witness, ensuring complex questions are simplified and comprehended. It is important to note that intermediaries are strictly restricted to witnesses eligible under Section 16, vulnerability or incapacity, and are not generally available for those eligible solely under Section 17, intimidation.
Throughout all phases of criminal litigation, but most visibly during trial advocacy, solicitors are bound by the SRA principles. One of these principles demands that solicitors act in a way that upholds the constitutional principle of the rule of law and the proper administration of justice. This duty to the court is paramount and can override the duty to act in the best interests of the client when the two conflict. In the context of criminal practice, this translates to stringent operational obligations outlined in the SRA Code of Conduct. Paragraph 2.4. Solicitors must only make assertions or put forward representations to the court that are properly arguable. This explicitly prohibits advancing frivolous defences, arguing points of law known to be erroneous, or making allegations without an evidential foundation. Paragraph 2.7. Solicitors have an affirmative duty to proactively draw the court's attention to relevant cases, statutory provisions, or procedural irregularities that are likely to have a material effect on the outcome of the proceedings, even if bringing such matters to light is adverse to their own client's case. Misleading the court. A solicitor is absolutely prohibited from allowing a client to commit perjury or actively mislead the court. If a client insists on giving evidence at trial that directly contradicts an earlier, clear private confession of guilt made to the solicitor is ethically bound to cease acting and withdraw from the case to avoid being complicit in deceiving the tribunal. However, they must execute this withdrawal while maintaining legal professional privilege regarding the confession itself. Furthermore, solicitors must rigorously monitor and avoid conflicts of interest under paragraphs 6.1 and 6.2 of the Code. Representing co-defendants in a criminal trial is exceptionally rare and fraught with high risk. If an own interest conflict or a significant risk of a conflict between clients arises, for example, if co-defendants begin shifting blame onto one another or have divergent interests in pleading guilty, the solicitor must immediately cease acting for one or both parties to preserve professional independence and client confidentiality.
Sentencing architecture and the Sentencing Act 2026 reforms. When a defendant either enters a guilty plea or is convicted following a trial, the procedural focus pivots entirely to the sentencing phase. Sentencing in England and Wales is governed by the Sentencing Code contained within the Sentencing Act 2020. However, this landscape is being reshaped by the Sentencing Act 2026, which received royal assent on 22 January 2026. The Act introduces significant reforms to custodial management and sentencing policy, but many provisions are subject to staged commencement. For many, the 2026 Act represents a seismic shift in custodial management and sentencing philosophy, driven by an urgent policy imperative to ease chronic strain on the prison estate while restructuring community rehabilitation and punishment. Early release and earned progression, the 2026 reforms. Prior to the implementation of the 2026 Act, offenders serving Standard Determinate Sentences, SDS, the most common fixed-length custodial sentences, were generally released automatically on licence at the halfway point, 50% of their sentence. For specific serious violent and sexual offences listed under Schedule 15 of the Criminal Justice Act 2003, release occurred at the two-thirds point, 66%. The Sentencing Act 2026 sets out a new earned progression model that, once commenced, will alter statutory automatic release points. For many standard determinate sentences, eligible offenders are intended to become automatically eligible for release on licence after serving 1/3, 33, of the custodial term, instead of the previous halfway point. For certain serious violent and sexual offences currently released at 2/3, the Act envisages eligibility at the halfway point for sentences of 4 years or more once the relevant provisions are brought into force. Extended sentences for dangerousness are not adjusted by these particular release point provisions.
Changes to suspended sentences. The Sentencing Act 2026 also restructures the power to suspend custodial sentences. It extends the maximum custodial term that can be suspended beyond the previous 2-year cap, and it introduces a strong statutory steer, in some cases rising to a presumption in favour of suspending shorter custodial sentences rather than imposing them immediately. These provisions are subject to detailed statutory exceptions and will only take effect as and when they are commenced. Courts will still retain discretion to impose immediate custody in defined circumstances. Aggravating and mitigating factors in sentencing. When calculating the appropriate sentence length before applying release provisions or suspension, judges systematically navigate the definitive guidelines issued by the Sentencing Council. They establish a starting point based on the objective culpability of the offender and the harm caused, and then make upward or downward adjustments based on specific aggravating and mitigating factors. Aggravating factors. These elements increase the severity of the sentence. Common examples include previous relevant convictions, committing the offence while on bail, targeting vulnerable victims, abusing a position of trust, or demonstrating racial or religious hostility. Mitigating factors. These elements reduce the severity of the sentence. Examples include a lack of previous convictions, genuine remorse, mental health conditions or learning disabilities linked to the offending behaviour, or voluntary restitution made to the victim. Additionally, the law provides a structured reduction in sentence for defendants who enter a guilty plea, saving court time and sparing victims from testifying. This reduction can be up to a maximum of 1/3 of the final sentence if the plea is entered at the earliest possible opportunity, usually the first hearing at the magistrate's court.
Newton hearings, resolving factual disputes. When a defendant pleads guilty to the charge but fundamentally disputes the factual basis of the prosecution's case in a way that would materially affect the severity of the sentence, the court must resolve the dispute through a procedural mechanism known as a Newton hearing, derived from R.V. Newton. For example, a defendant may plead guilty to assault occasioning actual bodily harm, but assert they only punched the victim once in a momentary loss of temper, while the prosecution alleges a sustained, premeditated kicking while the victim was on the ground. If this factual difference shifts the likely sentence from a community order to immediate custody, the judge must hold a Newton hearing to determine the truth before sentencing. During the hearing, the judge sits alone as the arbiter of fact, without a jury. The standard of proof remains the criminal standard. The prosecution must prove their version of the disputed aggravating facts beyond reasonable doubt. If the prosecution fails to discharge this burden, the judge is legally obligated to sentence the defendant on the defence's version of facts, known formally as the basis of plea. A solicitor's ethical and practical duties when drafting a basis of plea are paramount. They must ensure the document is clear, unambiguous, and signed by the defendant. Ethically, they must not assert facts known to be false. Tactically, a solicitor must deliver a robust warning to the client. If a Newton hearing is held and the judge rejects the defendant's version of events as untruthful, the defendant risks losing some or all of the sentence discount normally afforded for a guilty plea, as they have forced the prosecution to call witnesses and the court to expend valuable trial time. Appellate procedures and jurisdiction. Following conviction and sentencing, the SQE syllabus dictates a firm understanding of appellate routes, which differ significantly based on the original trial venue and the nature of the challenge.
Appeals from the Magistrates' Court. A defendant convicted in the Magistrates' Court has two primary avenues of appeal, depending on whether the challenge is factual or purely legal. 1. Appeal to the Crown Court under Section 108 of the MCA 1980. A defendant may appeal against conviction if they pleaded not guilty and/or against the sentence imposed. Historically, this operates as a full rehearing of the evidence before a Crown Court judge sitting alongside two lay magistrates. The Crown Court wields broad powers on appeal. It can confirm, reverse, or amend the magistrate's decision. Crucially, a solicitor must explicitly warn the client of the risks involved. The Crown Court has the power to increase the original sentence up to the maximum powers available to the magistrates. 2. Appeal to the High Court by way of case stated. If a defendant or the prosecution believes the magistrates made an error of law or acted in excess of their legal jurisdiction, they may appeal to the Administrative Court of the High Court. This is not a rehearing of the factual evidence. Instead, the magistrates draft a case stating their factual findings and formulating the specific legal questions to be answered. The High Court relies purely on legal submissions to determine if the lower court was wrong in law and has the power to reverse the decision or remit the case back to the magistrates with directions. Appeals from the Crown Court. Appeals from decisions of the Crown Court are directed to the Court of Appeal Criminal Division. Unlike appeals from the Magistrates' Court, there is no automatic right of appeal. The appellant must obtain leave, formal permission, from either the trial judge or a judge of the Court of Appeal. Appeals against conviction require the appellant to demonstrate that the conviction is unsafe. This frequently results from arguing a misdirection of law by the judge to the jury or the wrongful admission or exclusion of evidence, such as the judge misapplying the bad character gateways under the CJA 2003. Appeals against sentence require demonstrating that the sentence imposed was manifestly excessive or wrong in legal principle. Youth justice system in England and Wales operates on a distinct philosophical foundation. While accountability remains a factor, the system prioritises the prevention of offending and the welfare of the child, aligning closely with rehabilitative principles over pure punitive retribution. The Youth Court, a specially constituted magistrates' court, maintains primary jurisdiction over defendants aged 10 to 17.
Jurisdiction, grave crimes and allocation. There is a powerful statutory presumption that youths should be tried in the youth court, thereby avoiding the formalities and intimidation of the adult court environment. However, under Section 249 and Section 250 of the Sentencing Act 2020, this presumption is decisively displaced for grave crimes. Grave crimes encompass offences such as murder, manslaughter and other serious crimes that would carry a maximum sentence of 14 years or more if committed by an adult, for example robbery, rape, serious assaults. If a youth is charged with a grave crime and the court considers that the youth court's maximum sentencing power, which is capped at 24 months detention, is insufficient to reflect the gravity of the offence, the youth must be allocated and sent to the Crown Court for trial. Furthermore, highly complex allocation rules apply when a youth is jointly charged with an adult co-defendant. In many such instances, the youth will be sent to the Crown Court to ensure the cases are tried together in the overarching interests of justice and to prevent duplicated trials. Youth sentencing regimes. Youth sentencing options deliberately avoid adult prison terminology and focus heavily on structured community rehabilitation and reparation. Referral orders. These are the mandatory starting point for first-time youth offenders pleading guilty to an imprisonable offence unless a custodial sentence or an absolute discharge is deemed more appropriate. The order lasts between 3 and 12 months. The youth is required to attend a community youth offender panel to agree on a binding contract of reparative and rehabilitative interventions. Upon successful completion of the contract, the conviction is immediately deemed spent for rehabilitation purposes. Youth Rehabilitation Orders, YROs. The YRO is the standard, highly flexible community sentence for youths. It allows the sentencing court to attach a bespoke menu of requirements such as curfews, supervision, unpaid work, exclusion zones or intensive fostering, tailored specifically to the youth's risk profile and rehabilitative needs. Detention and Training Orders, DTOs. The DTO is the standard custodial sentence for youths aged 12 to 17. Crucially, it is only available for 12 to 14-year-olds if they are classified as persistent offenders. It acts strictly as a measure of last resort, permissible only where the offence is so serious that no community sentence can be justified. DTOs range from 4 to 24 months. The sentence is structurally divided into 2 equal halves. The first half is served in a custodial setting, for example, a secure training centre or young offender institution, and the second half is served under intensive statutory supervision back in the community to aid reintegration. Welsh language considerations in criminal proceedings. The SQE syllabus explicitly incorporates preliminary considerations for the use of the Welsh language in criminal proceedings. This reflects the fundamental legal equality of the English and Welsh languages in the administration of justice in Wales, a principle enshrined in the Welsh Language Act 1993. Under statutory provisions, any party, witness or other person has an absolute right to speak Welsh in any legal proceedings in Wales. In the Magistrates' Court, an individual may exercise this right dynamically without giving prior notice. However, the CPR and CPR practice directions specify that in any court where notice is practical, parties and their legal representatives have a duty to inform the court as early as possible if the Welsh language will be used. This advance notice ensures that appropriate simultaneous translation facilities, bilingual court staff, and potentially a Welsh-speaking judge can be arranged. From a practice perspective, a solicitor must actively ascertain a client's language preference early in the litigation process to prevent any disadvantage at trial and to comply meticulously with the overarching objective of dealing with cases justly and efficiently. Thank you for watching this video. If you are preparing for the SQE and need to refresh the other parts of the FLK beyond SQE1, FLK2 Criminal Law and Practice, have a look around Dr. Yannis's channel.